Hi, my dear buddies. How are you doing? Punarvas Jayakumar here. So, guys, finally, the much awaited marathon part 2 is uploaded now, right here. So, some I could record, some I've taken it from my, fast track batch for November 23. Some I recorded, as I told you. So, in this, generally, students miss out on a few important topics, thinking it is very small topic, but they'll miss out on it. So those areas I have covered here in this particular, marathon, which is running for almost around 11 hours. So first there will be a, important discussion about all the important areas of TDS and especially a comparison between TDS and TCS. There are a few CBDT important clarifications which have come recently, right? So let me just check that. Okay, this is the second part. I just want to check if the recording is going on. Okay, third part, my dear friends, is a very, very important new TDS section on virtual digital asset. That is the next part also, which will be covered here. Then there is a very small concept of bonus stripping, which generally they ask in MCQ, that I have covered, and very, very important areas of chapter 6A deductions. Correct? Bonus stripping and interest stripping, that is one thing. And then chapter 6 deductions, the important ones which they generally ask in MCQ. Then we have taxation of buyback and taxation of units. Then we have covered taxation of ESOPs, my dear friends. These are all small areas, 2 marks, 3 marks, 2 marks, like that they'll give. Then we have covered charitable trusts. Then we have covered religious trust. All revision, quick revision, right? And of course, we have business trust, taxation of business trust, then electoral party, electoral trust, and we have set off and carry forward. So these are the important areas covered in this video. Almost 11 hours of video, 11 to 12 hours. Very, very important. Definitely many marks will come in that. Generally, students will only think about PGBP, capital gain, IFOS. That's all. I mean, other things in assessment procedure that anybody will do. But these areas are something which you really need to, take care both in MCQ and in the normal thing. Okay. So please enjoy the video. It comes one after the other. Everything is numbered. Everything is, clearly mentioned there. Please like this video. Share it with maximum number of people. This is for November 23 attend, my dear friends. It can also be used for May 24th to some extent, but of course, this is predominantly for November 23. Okay. On that note, signing off. Take care. Love you all. Here starts the video on TDS. Take care. So now coming to the TDS portion, tax deducted at source. So TDS, as the name itself suggests, is the tax that you will be deducting at the source itself. This is a recovery mechanism by the government because people will never pay taxes. So that's why at the beginning only, at the source itself, they will recover. So the first one is what? 192. So generally everything, if we understand who's the payer, who's the payee, etc., then it will be easy. Of course, we'll do all the important areas, all the important TDS sections we'll do. So 192, payer is an employee, payee is a resident or non-resident. Rate will be slab rate. This is salary, that's why. So what all should the employer should consider what all in this? First, he should consider the house property, profit or loss, and then the income from other sources. Income will be considered, loss will not be considered. So if, for example, any employee's salary is 80,000, assume, per month, 9,60,000, the employer only has to deduct the standard deduction of 50,000 and 9,10,000 will be your income. And then his total tax for that will be, here after doing all the calculation including cess, will be 98,280. So the employer has to deduct 98,280 divided by 12 every single month. So here the person who is deducting tax will be the employer. He is deducting on behalf of the employee. And the best part is, if the employer doesn't deduct, he will be liable as a assessee in default. So it's a very dangerous provision for the employer. On the other hand, if you are, saying that, as I told you in the previous example, 7 lakh is my, in the example which we saw, in the salaries. If my salary is 7 lakh, 2 lakh is my non-monetary perquisite. And I say that I don't want to pay tax on non-monetary perquisite. I should compute the tax normally only. Overall 9 lakh minus 50,000, 8.5 lakh. For 8.5 lakh, 85,800 is the tax. Now I told you I will not pay on this 2 lakhs. I will not pay on 2 lakhs is what the employee is saying. So for 8,50,000 salary, 85,800 is the tax. For 2 lakh rupees, what would be the tax? So for 2 lakh rupees, tax would be 20,000 rupees 188. This 20,188 is borne and also paid by the employer. It is borne by the employer and paid by the employer also. So this amount of 20,188 is disallowed for the employer under BGBP, and for the employee it is exempt under 1010 CC, which we just saw now. And what should the employee take? Employee, employer, how much will he deduct? 85,800 minus 20,188, because it's 20,188 fully they will only pay. Balance 65,612 divided by 12. So 5468 will be the deduction every single month. So that is all. And what if this fellow works in some cases he will work for 6 months somewhere and then goes to the other 6 months somewhere else. So when he is doing that for 6 months only, they would have taken into account the basic exemption limit, etc. So that again benefit will not be given to the next 6 months. So that is what you should calculate. What if I am deriving salary from both two sources? That is possible. Part-time, both part-time I am working. Both of them know that I am working part-time in two companies. It's not a case where I have lied to one company. In this case, I should take the basic exemption limit, give the details only in one company, because I cannot take basic exemption limit twice. So that is all the basic deal in 192. Then let us check the important ones. So many things are there in TDS. We'll just see the most important areas. Of course, first one is definitely 192, which we have seen. All that we have checked that. Yes. Then payment of accumulated balance in EPF to employee. This is an important section because it has been amended in Finance Act 2023, which means the last part ever this can come is November 23. Which part, that also I'll tell you. This is what I told you in RPF when we were discussing. I told you that you will, all the money that you are getting lump sum will be exempt if 4 conditions are satisfied. What are 4 conditions? You are continuous service of 5 years you have done, or you are exited before 5 years only because of your ill health, or because of your the closure of business. So, or other causes due to the, beyond the control of the employee. Now, premature withdrawal, has happened. That is still okay. But if any of, for these reasons it is not happening and directly you have done a taxable premature withdrawal, then what happens? Then you will have to pay tax. That is, less than 5 years you have taken a premature withdrawal, but you are not ill, you are fine only. And then you, or the business of the SSC has not closed down, it's fine only, but you only left. Or you have not joined somewhere else and you have not shifted the balance there, then in that case it will be taxable. So that is the scene. If generally it is taxed at what time? At the time of payment only. At the time of payment. Generally TDS is deducted or rather paid at what time? It is deducted at the time of payment or credit, whichever is earlier. Either at the time of payment or credit, whichever is earlier, but some cases it is only on payment basis. One is salary. Salary is only at the time of payment, dividend, all these things, payment. TDS is always at a flat rate. There is no cess, no surcharge, etc. except salary for a non-resident. In salary for a non-resident, I will take into account, or even normal salary also, I will take into account a surcharge, etc. because I don't want the employee to pay again. Now, there is a general section. If you do not pay, if you do not furnish your PAN, then the tax rate will be 20%. But one big exception is 192A. If employee does not furnish the PAN, tax will be deducted under the maximum marginal rate, 42.74. Now, this has changed in Finance Act 23. What is the change and all? Let's not go there. But this 7th point, last time ever, it can come only in November 23. Right? They can ask an MCQ where if you don't furnish the PAN under 192A, then the tax will be, first will be double, they'll give 20%. Then they'll say double. Then they'll say 42.744%. So answer is 42.744%. For May 24 onwards, this will change. Yes, next is interest on security. Any person paying interest, and the payee here will be a resident person, rate will be 10%. This is the TDS on any interest. It says any interest on securities. So securities can be anything for that matter. That is your interest on debentures, interest on other securities, interest on government securities, etc. But TDS is not applicable for certain cases. That is, public company is giving interest on debentures to resident individual or HUF. If it is paying less than or equal to 5,000 by check, then no TDS. So they'll give you, they are paying 7,000 by check, TDS will come. They'll say 4,000 by cash, TDS will come. So it is less than or equal to 5,000 by check. Next, payment made to life insurance corporation, general insurance corporation, any insurance company. So if its payment is not made by, it is made to, mind you. And any dematerialized security, this will come. And government security, again MCQ question. Government security for state government or central government, TDS will not come except these two. 8% savings bond account, 7.75% savings taxable bond scheme account, where the interest is more than 10,000 rupees. Interest is more than 10,000, TDS will come. TDS will come. Then under 54 EC, if you remember in capital gain, we had deposited funds in some account called 54 EC. So that is only two cases there it will be exempt, no TDS. That is for capital gain bonds issued by Power Finance Corporation Limited and Indian Railway Finance Corporation Limited. So for Power Finance and Indian Railway Finance Corporation, it will not come. So those are some important areas. 92A we saw. 194 is your dividend. TDS on dividend. Earlier, dividend used to be dividend distribution tax. Corporate dividend tax used to be paid by a company, and then for employee it used to be exempt. Sorry, for the shareholder it used to be exempt. Now shareholder has to pay under 194. When I am distributing money to the shareholder, company only will deduct TDS under 194. Mind you, only if the dividend is more than 5,000. Dividend is less than 5,000, no TDS. Less than or equal to 5,000, no TDS, and it should not be paid by cash. And as we know, under 206 AA, if PAN is not furnished, then generally it is 10%, but if PAN is not furnished, 20%. 20%. (194A), any person other than individual or HUF, payee will be a resident person. Resident person. This payer of the interest. This is what, guys? Interest other than interest on securities. This will be interest on your recurring deposits, etc. This will be interest on your recurring deposits and fixed deposit and all these things. So here, generally, what is the rate? That's all okay. That is 10%, otherwise 20%, all that okay. But when will TDS not come? If it is paid by bank, cooperative society, post office, less than or equal to 40,000 rupees per annum per bank. This is for normal people. For resident senior citizen, less than or equal to 50,000 rupees per bank, per annum per bank. Mind you, it is not per branch, it is per bank. So all branches added. And if they say non-resident senior citizen, for him it is still 40K. Whether 50K limit is only for a resident senior citizen. In other cases, it is less than or equal to 5,000 rupees per annum, no TDS. Savings bank interest, no TDS irrespective of any amount. So which means this 194A is only for recurring deposit, fixed deposit, etc. Firm is paying interest on capital or interest on advance to a partner, no TDS. Interest paid to bank, cooperative society, finance corporation, LIC, no TDS, which means I am paying interest. I have taken a loan from bank. I am paying interest to bank. Will 194A come? Should I deduct? No. Minor where parents are deceased, TDS will be in the hands of the minor. This is also an interesting point. And now interest paid by income tax department on income tax refund. So refund they delayed, so they have to pay interest. Will there be TDS? No TDS. There will be no TDS. Then 194B is for lottery and crossword. 194BB will be for horse race. These cases, payer or payee. So TDS rate is given under this section, whereas chargeability is given under one more section called 115BB. So what is the rate given? 194B. How much is charged? When is it immediately deducted? That is given under 115BB. So payer or payee can be any person. Rate will be 30%. Only if the winnings is more than 10,000 rupees. If payee is a resident, then no cess. If payee is a non-resident, then cess at 4%. Plus applicable surcharge also will be there. Otherwise, generally TDS no cess. Why will I charge cess for non-resident? Because I am paying the money, will never come back later. So that's why I should deduct the cess and surcharge. However, if I have received a BMW car in a lottery and the amount is 1 crore. Now I cannot, deduct TDS. I cannot give one steering, tire and all that. So what is the government telling? You collect from that fellow only. So you will say, sir, please pay 30 lakh, take the BMW car 1 crore. As simple as that. Or if it's a cash award and other thing, then they will say, take the cash award fully, I will recover towards TDS. Extra amount you pay. That's what it is. So that is the entire thing. 194B and BB. So one more interesting thing in 194B and BB, if you see, this will also include, this is winning from lottery and crossword puzzle, okay. 194BB is for horse racing or for arranging for wager or betting in any race course. So there was confusion whether it included online games or no online games. So for online games, they made a separate section that is for Finance Act 23 onwards. So if they want to give online games, etc., this will still come under these things only, 194B and BB, because B will include lottery, crossword puzzle or other games of similar sort. So even online games will be like rummy, online rummy and all will be like online lottery in any other mode. So all that will come under 194B only for November 23 exam. For May 24 exam, they have already shifted the section with some other differences elsewhere. Right? So for November 23 exam, online games will still come under 194B. Because 194B section says lottery or crossword puzzle or other game of similar sort. So online also will be similar sort only. So insurance commission, lottery, and all these things, ticket commission. 194D is insurance commission, 194G is lottery. That is, people in Kerala will sell lottery tickets. No, that commission if they are getting, that is 194G. So both similar concept only, 5%, but the commission should be more than 15,000 rupees per annum. 15,000 rupees per annum. Then on brokerage, commission on brokerage, any person other than individual or HUF, pay will be a resident person. Again, the rate will be 5%. It should be more than 15,000 per annum. Anyway, but the real deal is 194C, 194J, 194I, 194M. All those are important areas. That is what we'll cover now. 194C, TDS on contractors. Who is the payer? Any person other than individual or HUF will be considered as the payer. Payee will be any resident person. Payee will be any resident person. So, for example, if I am giving you a contract worth 1 lakh rupees, you are the contractor, I am the contractee. When the contractee is paying the money, you should deduct TDS and pay to the contractor. Rate will be for individual or HUF it is 1%, for other persons it is 2%. TDS will be deducted either if the single contract exceeds 30,000 or aggregate contracts exceed 1 lakh. If it is like 30,000, 20,000, 20,000, 40,000, 25,000, 10,000 like that, overall it's exceeding 1 lakh. In the last payment time, I will deduct for the entire year. Now, will 194C apply to, what do you say, individual and HUF? Means if individual and HUF hires a contractor, should he also pay? It depends on he should be a big individual or HF. So, contractee, payer or deductor, individual plus HF. If the turnover or gross assets is less than or equal to 1 crore. So basically guys, here, very simple. If the deductor or payer or contractee is an individual or HF, we have to follow the chart now. If he is any other than individual like a company etc., then I should see the contract amount. Per contract more than 30k or aggregate more than 1 lakh. Now coming to individual HF, which is this chart we'll see. Now, if the turnover or gross assets is less than or equal to 1 crore or less than or equal to 50 lakhs in the profession, no TDS irrespective of the contract amount. In 194C it will not come. On the other hand, if the turnover or gross assets is more than 1 crore and or in case of profession it is 50 lakh more, then only 194C gets triggered. So, will TDS provisions apply? Should the individual or HF deduct TDS? It depends on whether he is a big individual or a small individual. Who's a big individual whose turnover or gross assets is more than 1 CR and in case of business or 50 lakh in case of profession. 194C gets triggered. Now, it gets triggered, but I need to see if he is using it for personal purposes or if he is using for official purposes. Let's assume he is using it for official purposes. Like Virat Kohli is hiring a contractor. Is he a big individual? 100% yes. So he is hiring a contractor for official purposes. Single payment more than 30k, aggregate payment more than 1 lakh, 194C. Very simple. At what rate? 1% if that pay is an individual or 2% if the pay is other than an individual. So Virat Kohli is hiring, somebody for, let's say, some training of his calf muscles. He's hiring a trainer, official purpose. He's hiring an individual. How much is deducting? 1% he should deduct. He's paying them 12 lakhs per annum. How much should he deduct? 1%. But he's hiring a company where they'll keep sending every day one trainer. So how much do you deduct? 22%. On the other hand, Virat Kohli hires an interior designer for his house. Right? Interior designer for his house. And he's paying them 20 lakh rupees for his entire, one room, not even a house. One room, he wants an interior designer fully designing his interior, his one room. His, let's say, study, library he wants to design. He is given it to an interior designer. That female is charging 20 lakh rupees. Now, payment to a resident contractor per year, is it less than or equal to 50 lakhs? Yes. So 194C also will not come. There's one more section, 194M, that also will not come. But if he is paying to a resident contractor per financial year more than 50 lakh, so Virat Kohli hires a interior designer for his room and paying 60 lakh rupees to that person. So then 194C will not come because it's personal purpose. But 194M will come. Another section, 194M, TDS will be at the rate of 5%. Now, what do you mean by contract? Contract can be contract of work, contract can work of labor, or it can be service. Service can be professional service, technical service, managerial service. Professional, technical, managerial service, etc. will not come under 194C, it will come under 194J. But as far as work and labor is concerned, it will include everything. Advertisement, it includes broadcasting, it includes telecasting. Cold storage facility, which we saw in specified business under 35 AD, that also will come under this. Carriage of goods or passengers other than Indian Railways. Anything carriage of goods or passengers, if you are hiring a lorry, if you are hiring goods carriage, if you are hiring FedEx plane to carry your stuff, goods, yes, definitely it will come. Catering services, it will come. Transportation of gas or petroleum stuff also will come. If you are manufacturing any product as per the client's requirement, that also will come under 194C. Advertisement Like, any advertisement which is hosted everywhere will come for sure. And what about telecasting, broadcasting? For example, Netflix originals you would have seen. In Netflix originals, they are only the producers. They will hire a cast, crew, etc. They will tell them, boss, this is the script. This is how I want it. I am the producer. Do it as per that. That's it. Now, is that a contract? Yes, because they are hiring everybody. Script, story writer, etc. 994C will come. On the other hand, Netflix buys the right of, let's say, RRR movie. Is RRR made for Netflix? No, but they have bought the Hindi rights of RRR movie. Is that a contract? No, it's an outright sale. So for outright sale, 194C will not come. Carriages, if I have hired a goods carriage of 35,000 rupees, can I pay cash? Yes, I can pay cash. Why? Because we had seen in 40A3 for goods carriages up to 35,000, no TD, no, what do you say? You can pay by cash also, no need of bank payment. However, now this section says up to 35,000 rupees, no problem, you can pay. If the individual is owning less than or equal to 10 trucks and is given a declaration and is furnished his PAN, then there is no TDS for that person. No TDS for that person. So for goods carriage, 3 conditions irrespective of the amount. I told the 35,000 only for cash purposes. You pay 1 lakh, 2 lakh, 3 lakh also, no problem. No TDS. No 40A3 disallowance for payer if amount paid in cash is less than or equal to 35,000. This is connecting 40A3 and 194C. Right? So if I am paying to a goods carriage guy owning less than or equal to 10 trucks, any amount paid, 1 lakh, 2 lakh, 3 lakh, no TDS. Provided he should own less than or equal to 10 trucks and he should give a declaration and he should furnish a PAN. Very, very simple. Goods carriage. Other than goods carriage, ship, airway, school bus and all those things, 194C will come. Because this is only talking about goods carriage, not about passenger. Manufacture of a product, on the other hand, if the materials are supplied by customer only, I will supply a jewel worth 10 lakhs and I will ask you to work on that. Designing. I will give you a hard jewel. You will have to work designing and give me. When you give me the bill, people used to give 14 lakh, 15 lakh bill. 5 lakh is the working charges, 10 lakh is the jewel. TDS had to be applicable on the full amount because you had not separated it. That's why the government told kindly separate. Material cost separate, work cost separate. If you separate like that and give, you will only be charging TDS on the work portion. In my example, 5 lakhs. To avoid this, this is materials supplied by customer. To avoid this, what people were doing, they were asking the related party to supply the jewel. If I want a jewel, I'll ask my father to supply the jewel. If I am a company, I'll ask my holding company to supply the jewel. Like that, I was doing cheating. Because in that case, no TDS. Why? Because materials are not supplied by customer. It is supplied by somebody else. So an amendment came. Even if it is supplied by an associate of the customer as defined under 40A2, then it is deemed to be material supplied by customer and same provisions will apply. But if it is supplied some random third party, so I will go to Tanishq and say I want this design. So they will buy from somebody else, they will get it designed from somebody else and they will sell it to me. What TDS? When I am paying Tanishq, should I deduct TDS? No, it's an outright sale. So that is regarding 194C. As far as gas or petroleum is concerned, let's say Indian Oil Corporation is sending the producing gas and sending the gas till your factory. Now the question is, I have hired some trucks to transport the gas. If I own the trucks, then it's sale. But if I hired the trucks, even though the trucks, I have rented the trucks out every day, but those trucks are in my premises always, they'll be in my factory always. It's as if I own the trucks, but I've taken it on a contract. Hence, the law in the court case it was there, they said it is 194C. It is 194C. Next, coming to 194I, rent. Any person other than individual or HF, but individual or HUF, that is big individual also has to pay 194I. Individual turnover is more than 1 crore, gross receipts in a profession more than 50 lakh, TDS is required. Payee will be a resident person. What is it? Rent for building, land or both, or furniture or fixtures 10%. Plant and machinery and equipment 2%. Aggregate amount should be more than 2,40,000 rupees per annum. Aggregate amount more than 2,40,000 rupees per annum. Rent. What are the adjustments in the exam? Rent can be lease, sublease, tenancy, agreement, arrangement, everything. Rent can be maintenance charges. It can be municipal taxes. Municipal taxes paid by tenant, no TDS. Municipal taxes paid by owner or included in rentals, everything 194I will come. Because municipal taxes is paid by the owner here and included in the rentals. So 194I will come on that because it's part of the rent. But municipal tax paid by tenant himself, no TDS. Then if you want to take warehousing charges, cold storage units, I already told you it will come under 194C. It will not come under 194I. But normal warehouse will come under 194I. If I have partly hired a building or land, lawmaker uses the word any land or any building, hence 194I will come. If I have paid an advance rent for 3 years, let's say every year is 6 lakh, I have paid advance rent of 6 lakh into 3, 18 lakhs. 3 years. So 1.8 lakh TDS will be apportioned across 3 years, 60,000 per annum. If rent, joint owner, rent is paid 3 lakh rupees, but it is paid 1.5 lakh to one person, 1.5 lakh to the other person, Mr. A and Mr. B, no TDS. Why? I should take per person there. Deposit, refundable deposit if I have taken, interest bearing deposit, 194I will not come, 194A will come because interest is given there. Non-interest bearing deposit, no TDS. If it's a non-refundable deposit, then 194I will come because again it is non-refundable as such, it is deemed to be rent. Airport, mall, all these, food people who hire like for example, Subway has or California Burrito has hired a space in an airport or a mall to sell their stuff, food stuff, that is 194I. On the other hand, the airlines have to pay some landing charges, parking charges to Airports Authority of India. Is that rent of land? Yes, it was D, or is it like 194C or 194I? So they said, since it involves many things, traffic services, safety services, your aeronautical communication, navigational services, it will come under 194C and not 194I. Similarly, from the passenger, they will collect something called CUTE fee, common user terminal equipment fee, then passenger service fee, metal detectors, escalator, conveyor belt, all these things. In Jet Airways case, they told it is 194C and not 194I. I am not renting the space, I am giving all these services. Similarly, there will be a house, on the house there will be a telecom tower, right? So on the telecom tower, that telecom tower is, some company owns that tower, they will be paying rent to the owner. Is it 194I? Yes. But this telecom tower, that passive infrastructure facility, they will give it to various people. They will give it to Airtel, Jio and all these people. Now is that 194I or 194C? It went to the court. They said it is renting of machinery and it will come under 194I. What rate? 2%. It will come at 2% rate. These are all the various examples you can give. Then any long-term lease, 20 years lease, 30 years lease, where you have to refund that after 20 years, then that is not rent, no TDS. Hotel accommodation. If I fix 2 rooms for 8 months at a fixed rate, regular rate, whether I come there or not come there, it's already fixed. 2 rooms already ready for me for 8 months. 194I because regularly hired. On the other hand, if I strike a deal with you, whenever I come, you should give me this rate. I may come, I may not come also, but I will assure you I may come for around 1 month, but it's not sure. But if I come, you should give me this rate. That is arrangement for a discounted rate. No 194I will come because it's an arrangement at the end of the day. You would have seen a lot of hoardings, billboards, etc. outside. If I had made a direct deal with the owner, then it's an advertisement contract under 194C. Otherwise, it will be like a subletting. Basically, I have taken on rent that particular billboard and I'm renting it out to you. then it will be under 194I. Zoom car, etc. Drive C without chauffeur, without driver, without fuel, whatever self-drive vehicle if I am taking, 194I will come. On the other hand, if I am hiring Ola Cabs taxi agency, so a company enters into a contract with Ola Cabs for supplying, what do you say, some 10 cabs every day to ferry their employees. That will come under 194C. Now 194IA is there. That is what? If you are buying a house in the future and if it is happening to be more than 50 lakh rupees, then you have to deduct TDS. This will be at 1% of either the sale consideration or SDV. And it should be more than 50 lakh rupees. It should be more than 50 lakh rupees. And in immobile property, rural agricultural land is not covered. Rural agricultural land is not covered, but urban agricultural land, if it is more than 50 lakh rupees, then it will be covered. 100% it will be covered. Coming to 194J. 194J is for professional, technical and managerial services. Professional, technical and managerial services. What is the rate of tax in 194J? What percentage? Let me come to that. Yeah. 2% in case of technical services, not being professional services. If it is royalty for sale, distribution or exhibition of cinematographic films, 2%. If it is engaged in the business of call center only, 2%. In any other case, 10%. So 2% only in 3 cases. Technical services, not being professional services. Second one, royalty for sale, distribution or exhibition of cinematographic films. And third one, business of call center. Then it is 2%. In all other cases, 10%. But if you see, it is also applicable for a person. 194J is also applicable for a person, deductor, whose income is more than 1 crore turnover or profession 50 lakh. So interesting to know, if he is hiring professional services, if he is providing professional services, hiring professional services, aggregate value less than or equal to 50 lakh, 194M will not come, 194J also will not come. But if it is more than 50 lakh, 194J will not come. But since he is a big individual, 194M will come. But if he is hiring technical services, if it is less than or equal to 50 lakh also, more than 50 lakh also, 194M will not apply. 194M will not apply. If the value of the service is more than 30,000, then 194J will apply. Because in professional service, technical service, etc., it is what? 30,000 is the amount. 30,000 in a year. Mind you, 194J is for the following payments: fee for professional services, fee for technical services, royalty for that movie, etc. Non-compete fee. Non-compete fee we had seen in 28(5)(a). That is, do not share the know-how, do not work elsewhere, work only here, be a full-time consultant. That is called non-compete fee. 28(5)(a). And any remuneration or fee or commission to a director of the company other than those covered under the head salary. This is your sitting fee. Sitting fee. What should be the amount, guys? More than 30,000. One interesting question they can ask you. Director got a sitting fee of 29,000 rupees. Will TDS apply? Director got a sitting fee of 29,000 rupees. Will TDS apply? TDS will apply because that 30,000 rupees limit is only for 1, 2, 3, 4. That's it. No TDS if the amount does not exceed 30,000. Above limit is only for 1 to 4. For sitting fee, entire sum will be subject to TDS. without any limits. Without any limits. Entire sum shall be subject to TDS without any limits. So professional services means legal, medical, engineering, architecture, or any profession of accountancy, etc. Will also include sports persons, umpires and referees, coaches and trainers, team physicians, event managers, etc. The payment to Arsha Bogle will be under 194J. Payment to Matthew Hayden will not be under 194J because 194J is only for residents. So payment to Matthew Hayden will be under 195 foreign taxation. Sports person, payment to Virat Kohli 194J. Payment to Josh Butler not under 194J. Payment to an Indian umpire 194J. Foreign umpire 195. So all that you need to see. So any payment made to software etc. there will be no TDS if you have just bought the software and selling it to India. When I bought the software, I would have paid anyway TDS. Then I'm selling it to other people. But if I buy the software, make some changes in it and then sell, for both the transactions, TDS will come. One, buying from abroad. Second, selling it to you, TDS will come. So that is regarding software. Then for third-party administrators like insurance companies, if HDFC Ergo is an insurance company, there will be a third-party separate service provider in the hospitals. So if you fall sick, you will have to go to the third party administrator. They will directly settle payment to the hospital. Because hospital cannot wait for longer. No, you will have to be discharged. Only if you make payment, you will be discharged. So the third party administrator will directly make payment to the hospitals. And they will take money from HDFC Ergo later. The question is, when the third party administrator is making payment to the hospitals, will 194J come? Because hospital has provided what service? Professional service. This is medical service. The issue went to court, then a lot of circulars came. They said yes. Instead of insurance company, who is giving? Third party. So third party administrator has to deduct TDS while making payment to hospitals. They have to make payment to hospitals. That is regarding 194J also. Very, very simple. Then we will see certain things here. This is my $194O. Very simple. E-commerce operator, you have Amazon, etc. And in Amazon, you will have both seller as well as buyer, as we know. Seller is called as e-commerce participant. Amazon is the e-commerce operator, can be resident or non-resident, and buyer can be anybody. Now the question is, seller is selling goods and services to the e-commerce operator and then going to the buyer. Buyer will pay money and issue is closed. When the e-commerce operator is giving money to the seller, should he deduct TDS is the question. Answer is yes under 194O. Mind you, seller must be a resident in India and he is the payee. What should be transferred here? Goods and services. And e-commerce operator can be resident or non-resident. What is the TDS rate? 1% of the gross amount of sales. 1% of the gross amount of sales. Not net amount, nothing. Full. Whatever amount is sold, that full amount will come under this. So Sony India is selling TVs to Chroma and Chroma is selling to buyer. And when Chroma is making payment to Sony India, 194O will come. Sony Japan is selling TVs through Chroma. When Chroma is selling to buyer, when Chroma is making payment to Sony Japan, 194O will not come because the payee must be a resident in India. So here 195 will come. Sony India is selling TVs to Walmart USA. Definitely 194O will come because Walmart USA can be resident or non-resident, doesn't matter. But individual, if is selling less than 5 lakh rupees, 194O will not come. So if an individual is selling some perfume through Amazon and it's 4,95,000 rupees, payment made to individual 4,95,000, it will not come. On the other hand, if you are a partnership firm, the exemption is only for whom? Individuals, not for partnership firm. That is the gist of 194O. Next is 194Q. 194Q is for the big buyer of the goods. For the big buyer of the goods. So, payee is a seller, is a resident. He is selling goods, not services, selling goods to value more than 50 lakh to a buyer. Who's a buyer? Who's a deductor? He can be a resident or non-resident who has a permanent establishment in India. And I told you 194Q is for big buyer of goods. So turnover or gross assets from business should be more than 10 crore in the immediately preceding financial year. Big buyer. So if the seller is selling more than 50 lakh to a big buyer, TDS has to be deducted under 0.1% of the sum exceeding 50 lakh. 0.1% of the sum exceeding 50 lakh. At the time of payment or credit, whichever is earlier, 0.1% of the sum exceeding 50 lakh rupees. That is one part of the story. On the other hand, if you see TCS provisions, TCS is what? Tax collected at source. Tax collected at source. In this, when the buyer is buying and paying money, the seller has to collect then and there only and remit to the government. So we have 206C1, 1C, 1F, 1G, 1H. So 206C1 only talks about TCS at specified rates. Buyer will be any buyer except state government, central government, public sector, company, etc. Seller will be any seller, CG or SG, local authority, corporation, any company, or big sellers. Individual HF whose turnover exceeds 1 crore. Same dialogue. Now these rates you have to remember. Alcoholic liquor for human consumption, 1% if pan is furnished. Pan is not furnished, 5%. Tendu leaves, 5%, 10%. Timber obtained under a forest lease, 2.5%. Scrap, 1%. Minerals, 1%. You have to remember the rates and the amounts and the nature. 206C1C, this is on certain contracts. What contracts? Parking lot. Nature of contract or license, parking lot. So I will give you parking lot license to you. When you are paying the money, I should collect extra TCS. How much? 2%. Toll plaza, 2%. Mining and quarrying, 2%. Motor vehicles. Every person being a seller receives any amount as consideration for sale of motor vehicles, value exceeding 10 lakh rupees. Value exceeding 10 lakh rupees. So buyer will not include state government and all that. Now, TCS applicable only at all retail level sales. So a Mercedes manufacturer is selling to luxury motor car dealer at 400 crore. TCS under section 2061F will not come. Luxury motor retailer is selling to Mr. PJ 80 lakhs vehicle. So yes, TCS at 1% will come for more than 10 lakhs. On the other hand, TCS is applicable on sale of any motor vehicle. They never say luxury motor vehicle. Any vehicle exceeding 10 lakh, ordinary or luxury. TCS is applicable on each sale of motor vehicle and not the aggregate value of sale during the year. So if I sell 7 lakh, no TCS. If I sell 6 lakh car, no TCS. It's not on the aggregate value, it's on each sale. But if I sell 60 lakh car, if I buy, but I give different payments, 5 lakh and 55 lakh, will TCS come on each payment? Yes. Even though this is less than 10 lakhs, you should not say TCS will not apply. TCS will apply. But if I buy different cars of less than 10 lakhs, TCS will not come. (2061G) important. Why? Finance Act 23 has changed it. So last time ever these provisions can come is November 23. Remittance outside India and overseas tour program package. Every person being an authorized dealer who received an amount for remittance outside India from the buyer under the LRS, Liberalized Remittance Scheme of the RBI, is responsible to collect tax from the buyer. So basically guys, you are an authorized dealer. Somebody will come to you and say, I need 10 lakh rupees INR converted to US dollar. I want to go abroad. Fair enough. Up to 7 lakh, no TCS. Exceeding 7 lakh, 5% of such amount in excess of 7 lakh. I have to collect TCS, extra amount. Exceeding 7 lakh out of education loan from financial institution, then 0.5% of amount of 7 lakh in excess of 7 lakh. So I will go to this authorized dealer, that is Western Union money transfer, etc., and say, give me 20 lakh education loan. In that 7 lakh, no TCS. Extra 13 lakh. Then how much TCS you have to pay? 0.5% TCS for educational loan. I am a overseas tour program package seller. I am Thomas Cook. I am Kesari Tours. I am Chariot Tours. So for them, no threshold limit. For any sum, you will give me 5 lakh rupees for your world tour. I will add 5 lakh plus 5% on it. TCS. I'll have to pay. Will you get TCS credit? Yes. This is just to government should know where you are traveling. That's why they are collecting TCS. That's all. Then comes 206C1H. 206C1H is also selling of goods, but here you have a big seller, not big buyer. If you see the other section was big buyer. 194Q was big buyer. Here it is big seller. Seller is exporter of goods are not covered. Seller to collect TCS. Seller can be resident or non-resident. Buyer can be resident or non-resident. Value is more than 50 lakh. There also value more than 50 lakh only. Here if you compare, here buyer was resident. Seller was resident, sorry. Buyer can be resident or non-resident. Value more than 50 lakh, goods. And big buyer. Here it is big seller. And seller can be resident, non-resident. Buyer also can be resident, non-resident, no problem. Value should be more than 50 lakh, same thing, goods. Here, who is a seller? Gross receipts or turnover from business should be more than 10 crore in the immediately preceding financial year. Buyer should not be an importer of goods. Buyer should not be state government, central government, etc. Buyer should not be local authority. Buyer can be resident or non-resident. TCS value is 0.1% of sale consideration more than 50 lakh. If TDS provisions are already applicable, then TCS will not apply. Applicability of transactions carried through various exchanges. I told you, stock exchange transactions, none of these sections will come. 194O will not come, 2061H will not come, 194Q, nothing will come. Sale of motor vehicles, you see. CBDT has clarified that this will come under 2061H. Manufacturer and luxury motor retailer. Whereas the second transaction will obviously go to 2061F. In case of sale to a consumer, receipt of sale consideration for sale of motor vehicle of value exceeding 10 lakh rupees would not be subjected to TCS under 2061H if such sales are already subjected to TCS under 2061F. This only 80 lakhs. Now it's coming under 1F also, 1H also. Specific section will override the general section. In case sale to consumer, receipt of sale consideration for sale of motor vehicles of 10 lakh or less to a buyer would be subjected to 2061H. The receipt for such vehicles exceeds 50 lakhs. Same example here. Check it out. Dealer 80 lakhs, TCS. 2061F will come and not 1H as discussed. On the other hand, April, May, June, July, August. In June, I bought 2 cars. April, I bought 1. May, I bought 1. July and August, I bought one car. Each of these values less than 10 lakh. So obviously, 1F will not come. But overall, if it is exceeding 50 lakh. So 2061H will come. Then, if it is sales return or discount or indirect tax related, no adjustment, guys, because everything will be all inclusive, right? Whatever I pay, whatever I collect will be all inclusive anyway. So no adjustment of sales return or discount or indirect tax including GST required to be made for collection, since the collection is made with reference to receipt of amount anyway. In TDS, you had to do the adjustment because that was on credit or payment, whichever is earlier. So there, if I have just credited now, I should make the payment and then adjust. Here, no adjustment is needed. If I supply fuel to a non-resident flight, Qatar Airways coming and parking in Bangalore, I am supplying fuel. Is it exporting? Was a question raised. It's not exporting. So obviously TCS will apply. So if I am selling fuel to Qatar Airways, it is not exporting. But will TCS apply was the question. So here 2061H shall not apply on the sale consideration received for fuel supplied to non-resident airlines at airports in India. 206C1H shall not apply to sale of goods to a person being a buyer who is exempt from tax. Obviously, if you are exempt from tax under any law, why will you collect TCS if you don't have to pay tax and you will not get the credit anyway later? No point. This is what we discuss now, my dear friends. Check these examples. Coolly, again. Seller sold 2 crore to e-commerce operator. E-commerce operator sold this 2 crore to the buyer, that is Mr. PJ. And the amount was given, and in this 1.5 crore net of TDS under 194O and net of commission. Net of commission. Commission and TDS subtracted, 1.5 crore I sent. Check it out. 194O applies. Flipkart to deduct TDS at 1% on 2 crore, full sale value of consideration. 194Q will not come. Why will it not come? Because 194O already applies. We saw in 194Q, if other TDS provisions will apply, then this will not apply. 194O will prevail over 194Q anyway, because 194O rate is also higher, plus it is specific. 206C 1H will not come, because in 206C 1H there is a proviso. If TDS has already been deducted, then the section will not come. So 206C 1H will not come. Now, that's what they say. In spite of the above, this is the clarification. Ideally speaking, 194 should apply. It may be 194O, 194Q, whatever. But in spite of the above, if seller collects TCS of Flipkart under section 206C 1H, then should I do or not do? Yes, the clarification says then also Flipkart is still liable to deduct TDS under section 194O at 1% on 2 crore. Important CBDT clarification. I am telling you, don't put dive, bro. Don't do that. Correct. I am telling you, 2061H is telling. I am telling you, don't put dive, bro. I have to put dive to you. You are the bigger person. No. I'll put 194 will tell. 2061H. Okay, put. Are you happy? No, I'll also put. Means what? Both will apply. Both will apply. Right? These are all CBDT clarifications. Next. See here. Seller directly 2 crore to buyer, Mr. PJ. If 194Q applies, 194Q applies, then 206C1H will not apply. We have seen that already as per proviso to 206C1H. If TDS is applying, then 206C1H will not apply. But as per section 194Q, 206C1H does not override 194Q. I told you confusion. 206C1H does not override 194Q. Does it mean 194Q overrides 206C1H? We don't know. Confusion. Hence, if 206C1H applies first, then 194Q shall not apply. If 206C1H applies first, then 194Q shall not apply. Important. Guys, the problem is only between 206C1H and 194Q, because we have not been told who overrides who. That's why whichever applies first will apply. Ideally 194Q shall apply, but by mistake if you have done this, it says no problem, both are the same rate, no, leave it. But this little relaxation is not available here, kindly note. It is not available between 206C1H versus 194O. Even if you deduct TCS under 206C1H, 194O also will apply. In this case, if 194Q will put one dive to 206C1H, 206C1H will okay, leave it, close. But in 194O case, if 194O puts a dive to 206C1H, 206C1H also should put a dive to 194O. Do not get confused. That time I was talking about this section. I repeat, 206C1H and 194Q only, that is a problem, because 194Q talks about 206C1H, 206C1H talks about in any other case. So there's a problem. We don't know what overrides what. So generally, general rule, 194Q will override 206C1H. But if you have by mistake applied 206C1H, then 194Q will not apply. On the other hand, as regards 206C1H and 194O, Even if you have applied 2061H, 194O will also apply. You have to collect it TCS and TDS. Very, very important areas. Last case. Very easy. If I am selling 2 crore to a buyer, PJ, whether it is 2061, 2061C, 2061F, 2061G, these are all your relatives, elder relatives. When elder relatives are included, 194O will not come because it is not through e-commerce. 194Q will not come because 194Q clearly says 2061, 1C, 1F, 1G overrides 194Q. Overrides 194Q. 206C, 1H also will not come. 2061H also will not come because 2061H clearly tells this is for the goods which are other than all these four. So ultimately is an easy one. What will apply? These things will apply. These things will apply. There are some other CBDT clarifications. If I am doing some e-auction services, like SBI hired an e-auctioneer to sell Kingfisher logo. Actually happened. Base price was 50 lakhs. One person also didn't buy. Anyway, the job of auctioneer is only to sell the Kingfisher logo. He will invite applicants to come, sell the logo, take some commission, give it to SBI, rest to SBI. Commission or brokerage. Guys, here, e-auctioneer will not fix the price also. It is just the starting point for negotiation. And it may end in a conclusion also. Why? Opening bid, 50 lakhs. Negotiation, 55 lakhs, 56 lakhs, 58 lakhs. Bidding will start. Finally, one fellow will say, yes, 62 lakhs, concluded. Whatever rate you get, at that some percentage commission I will get. Where TCS here? Or where TDS? Will it be 194O? Is it 194O? No. Clarification. Client will deduct tax under 194H. In fact, the amount will go to SBI. SBI, after getting the amount, will pay the auctioneer after TDS under 194H. E-auctioneer is not like e-commerce operator. Do not get confused. So O will definitely not come. Departments of CGST, Forest Department, Karnataka Forest Department, etc., they are not considered as sellers under 194Q. However, for PSUs, public sector undertaking, or government controlled corporations, jungle lodges and resorts is a government controlled entity. For them, 194Q shall apply. Definitely. So if they are selling any goods, for example, then this will apply. 2061G will not apply to non-residents visiting India. So any non-residents visiting India, reverse, me going abroad covered, them visiting India not covered. They want to see one full tour of India and go back, not covered. For goods used for manufacture or power generation, TCS is not applicable. Correct? These are the goods used for power generation. I have to give a benefit, no TCS. Hence, buyer is liable to deduct TDS under 190. Buyer is liable. TCS will not come, but TDS will come under 194Q. If I am selling goods, TDS will come under 194Q. A very, 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 very important concept today from Finance Act 2022. A short question. You know, if you ask me in the 2023 examinations, be it May or November, 100% they should ask because it's a brand new amendment. It's trending, so to speak. Yes, it's about virtual digital asset. So let me take you through the memorandum explaining the finance bill. So this is revenue mobilization. Nirmala aunty gave her speech. If you remember, Nirmala madam's speech. So if you see, scheme for taxation of virtual digital assets. So VDA, virtual digital assets, have gained tremendous popularity in recent times, and the volumes of trading in such digital assets has increased substantially. Further, a market is emerging where payment for the transfer of a VDA can be made through another VDA. So guys, before we go into all these things, obviously we need to understand what is a VDA, virtual digital asset. You would have heard of many things, right? Cryptocurrency, which has, Bitcoin, Dogecoin, and so many other coins, correct? Deso, Monero, so many things are there. Thousands and thousands of coins are there. Then you would have heard of, metaverse, something called as metaverse. You would have heard of land on metaverse. You would have heard of something called NFT, non-fungible tokens. So we need to understand what these things are. As I told you, short question, because the income tax department is now ensuring that a completely unregulated sector like VDA is going to be regulated to some extent in terms of taxation, correct? So there may not be a regulator like SEBI is there for stock markets, or RBI is there for the banking industry, but at least through tax regulation, they are trying to bring things under control, correct? So they have inserted sections 115 BBH. It's what we're going to do today, and also they have released 194S, introduced 194S, that is TDS, tax deducted at source, on these cases, along with various things. Plus other things also are there. Very, very, very important, guys, very important. And they have defined what do you mean by a virtual digital asset. This is the entire memorandum. What do you mean by a virtual digital asset? Everything. Anyway, come to our notes, to VDA notes. Come to our VDA notes, my dear friends. In that, two clause. So basically, this is applicable from assessment year 23-24. So extremely important for the May 23 and November 23 examinations, my dear friends. I expect a short question, maybe 4-mark question, right? They should ask. It will be awesome. So they have defined clause 47A defines what do you mean by a virtual digital asset. So you will see 100% nothing you will understand if you read the definition. But of course, I'm going to explain to you, don't worry. So this is just probably like a 1-hour video. What a short video. Please listen in. 4 marks in your pocket for sure. Pocket only is not there. Anyway, 4 marks. Okay, guys? Cool. So what do you mean by virtual digital asset? Any information or code or number or token, not being Indian or foreign currency. No mugging up in our classes. No bloody mugging up. This only you read this and go. Exam will come. Question. Even if you do not know virtual digital asset definition, you will still probably be able to write the question. But that's not what we are here for. Correct? We are here to what? Ensure that not only we write the answer and get full marks. Tomorrow, if any chartered accountant, if any person asks you, sir, what is VDA? Sir, that one thing I wrote, I left it as choice in the exam, sir. In fact, except the definition, other things you ask me, sir, I've mugged up everything. No, that is not what we are. You all know. We all know how we are studying this particular tax paper. Correct? We are bringing about a revolution in DT education. We are doing it the way nobody else has ever done, nobody else can ever do. Okay, that's the intention of these classes, my dear friends. Come on, no mugging up, pure concept. Okay, yes. Any information or code or number or token generated through cryptographic means, brilliant, providing a digital representation of value exchanged with or without consideration, the promise of representation of having inherent value, or functions as store of value or a unit of account, including its use in any financial transaction or investment, can be transferred, stored, or traded electronically. Sir, mother promise. Nothing I understood, sir. Excellent. Very good. No problem. So for that, my dear buddies, what we need to understand is what the hell is a cryptographic means. What do you mean by cryptographic means? How does this cryptography work? What is it exactly? What do you mean by cryptography? And what, because of this cryptography, what exactly is a blockchain? My dear friends, all these things work only through blockchain technology. So let's take 10-15 minutes to understand what is blockchain technology quickly with a simple example. And then later we will get into this, We'll get into deep waters with this virtual digital asset. After this session, I can assure you, because CBDT has released many circulars, will you read it? Your head will go topsy-turvy. So I am going to make it very simple for you. If you see, this is the entire note, 3 pages notes, that's it. I have made everything in charts. Becomes very, very simple CBDT guidelines, where my character, oops, sorry, my character is also there. Correct, PJ, right there. It's me only. Yes, yes. Okay, and one more character is there, KG, right? So 2 characters we have played around and we have understood what the CBDT has given only, that only in a very understandable format I have given. Okay, it's an understandable format. If you study this much and go 3 pages, I can assure you, whatever they give, 3 marks, 4 marks, it's in your pocket. I can assure you that, my dear friends. Okay, but before that, this VDA means VDA. Now let's go next. No. Let's understand, dear friends, what do you mean by VDA, virtual digital asset, shall we? Let's go ahead. Come on. Cool. So let me just, open that for you. Right. So let's take an example, guys. We have Virat Kohli, Rohit Sharma, and KL Rahul, right? These 3 are there. Now, this you leave it. Okay. So basically, this Bitcoin protocol is used where? Everywhere. In mobile and, in other currency, it is credit or debit card. But here, if you see in Bitcoin, technology, the main protocol is called as Bitcoin protocol. Protocol means rule. Okay, protocol means rule. Just remember that. Okay. Whereas in other currency, if it's debit card, credit card, etc., the underlying system will be banks. But basically in Bitcoin, when you transact using your mobile, whatever the case may be, the underlying system is called Bitcoin protocol. Protocol means a set of rules. Just remember that. Okay. So I already have released the basics of blockchain. If you want, you can watch it. It's there, on YouTube. You can check it out. You can watch that. Otherwise, you can, if you don't watch that also, it's okay. You can directly see this, because I'm using a practical example to understand. But if you want a little bit more basics, you can go check that video. Right. So let us assume that these 3 friends, were going every month, and at the end, they're just for fun, having fun, going for movies, having drinks, enjoying. So one particular month, VK paid 1000 rupees, KL paid 650, RS paid 750 rupees. That other number you leave it. Okay. So these 3 they paid 2400 rupees. They paid. At the end of the month they have to settle. No. At the end of the month they have to settle. How much is it? 1000 plus 650 plus 750 is 2400 rupees. 2400 rupees divided by 3. Each person share comes up to 800 bucks. So at the end of the month, VK says, bro, please pay 800 rupees. So now this ledger is maintained by Virat Kohli also. This ledger is maintained by KL Rahul also. This ledger is maintained by Rohit Sharma also. Basically, in Excel sheet, they maintain a ledger. This month, this much spending we have done. Okay, cool. Now, at the end of, what is the rule of this, guys? What is 2400 divided by 3 is how much? 800 rupees, sorry. Now, which means KL Rahul has to pay Virat Kohli 150 rupees, because Virat Kohli was supposed to spend 800. He has spent 200 more. KL Rahul had to spend 800, he has spent 650. So 150 has to pay to Virat Kohli, and Rohit Sharma has to pay 50 rupees. There ends the matter. So what is the entire scene? We have seen. Rahul has to pay Kohli 150 bucks. Sharma has to pay Kohli 50 bucks. Now, what are the rule? Any person can add lines to the ledger. No? Assume this was maintained in the Google Sheet. Assume it was maintained in Google Sheets. Anybody can add, whoever those 3 people can add to the ledger. Everyone will settle real money at the end of each month. So first VK said 1000, then Rohit Sharma spent whatever, that 750 rupees, and then he added it. Where did he add? He added it onto that ledger, Google Sheets, for example. Now the beauty is, what if this Google Sheet ledger is made public, where the entire public can write whatever they want? Deadly. Who verifies it? God only knows. Who authenticates it? God only knows. It's an open file, assume. Doesn't it question your trust on the ledger? Yes. Sir, what has this got to do with blockchain, sir? Hold on, right? If you don't understand the blockchain technology, you will never be able to understand virtual digital asset. And if you are not able to understand virtual digital asset, how the hell will you understand taxation? And if you don't understand the taxation part of the underlying asset, which is the VDA, how can you understand, how can you even guide your clients, my dear friends. Think of the future. Of course, the examination in mind, but think of the future. Tomorrow, you should be a chartered accountant where people will come to you and say, wow, you're extremely knowledgeable. Are you a CA? Rather than people coming and asking you, bro, how did you clear CA exam? Correct? Worst possible thing that you can ever hear from anybody, right? Yes, come on, guys. Who validates it? God only knows. There's no regulator for validation, right? So that's why the problem was the fourth question. Who validates it? Don't know. That's why Nirmala madam said tax everything. No, not this, not the Excel sheet. Come to it. I'm coming to it. Now, guys. So basically, everything works through. You would have heard of the digital signature (DSC). So one private key will be there and one public key will be there, right? So basically, when you sign something as digital digital certificate, when you sign, correct? Let's say you sign some. You have a DSC, director's DSC will be there. You will sign. After you sign, obviously, who authenticates it? There, the ROC's office will authenticate it because they will have something called as a public key. So this private key would be in encrypted form, and that will be decrypted by whom? By the ROC's office. That's a simple way there. Now, if I take the same concept and work on this particular simple transaction between three people, three friends, Virat Kohli, KL Rahul, and Rohit Sharma, what happens? Basically, that ledger, if you add that cryptography is what I told you, this digital signature, where it uses that concept of cryptography. Cryptography is a mechanism. So once that mechanism is used whereby it cannot be changed, or rather it creates a trial of the entire transaction, that is called as your cryptocurrency, your Bitcoin, all these things. It is nothing but it creates a trial. But now let's figure out this word cryptography, because that is what is there in the definition 2 clause 47A, which says through cryptography. Through cryptography, all these things, a virtual digital asset is created. Cryptocurrency, my dear friends, is a virtual digital asset because it uses cryptography. Now, what is this cryptography? Very, very simple. General rule, anyone can add lines to the ledger, but only signed transactions are valid. Using this cryptography, Virat Kohli will sign saying that, yes, I made the change in that example. Rohit Sharma will sign saying, I made the change, right? That's how it is. Now, let's take an example of Mr. Nax. Mr. Nax is also joins the party. He said, hi, I'm Mr. Nax. So he said, I haven't paid anything. Basically, what he does, no, he also enters the party. 600, 600, 600, 600, everyone has to pull in. Let's assume 2400 is the pool. Correct? Now, Mr. Nags, what if he refuses to pay and what if he runs away? What if he runs away? Correct? So, if you see, if this is the ledger, VK paid 1000, KL paid 6500, RS paid 7500, Mr. Nags paid 0. What happens? Everybody is putting into the bucket, but the thing is, Mr. Nags is not putting anything into the bucket here. If this happens, that is why, guys, we need protection, and that protection is called cryptography. Cryptography. I'll explain. So now the question is, where is this ledger maintained? What is this Bitcoin? Can you see Bitcoin? No. What is this exactly? Basically, Mr. A will maintain it. He will transfer to Mr. S. Correct? Any transaction like that, the entire general public, whoever has this data, assume that Excel sheet as public data. Anybody can add, anybody can do. Where is the protection? Where is the cryptography involved? That is why, my dear friends, we need something called as blockchain technology. The foundation of blockchain is the art of cryptography. To ensure that, okay, there are so many documents here. Which one is correct? Simple transaction, Mr. A transacted something to Mr. S. Mr. A sold his Bitcoin to Mr. S. Mr. A sold something to Mr. S. Everybody is telling the same thing, but amounts, they are changing. Just like Mr. Nax made it of 0. Where is the control? Correct? How do you verify this transaction? Who is maintaining this ledger? There is no regulator. Is there any regulator? No. So guys, that is why That is why it is very important that the entire series of transactions has to go through something called the Bitcoin protocol rule. Bitcoin protocol, I told you that protocol is called SHA-256. SHA-256 is called as the protocol. Once you apply this protocol, correct, it's a coding mechanism. Once you apply this coding mechanism, the transaction gets protected. How? With this example only, I'll tell you. So basically you have a set of transactions. VK paid 1000, KL paid 650, RS paid 750. That number I told you to forget that time. No. The moment this is entered in the ledger, a specific number will be generated using the protocol called SHA-256. SHA-256 is a protocol, my dear friends. A rule. Once that rule is applied, what happens? A specific number will be generated. Now that specific number, important to understand, is called as POW, proof of work. Proof of work. Okay, that is called as proof of work. Once this is set, it's called proof of work. This proof of work is the most important thing in Bitcoin in cryptography. Correct? Cryptography, which will help us. That's called blockchain protocol. Correct? Blockchain protocol. So even in Bitcoin, it's called Bitcoin protocol because in Bitcoin also this is used. In everything this is used, SHA-256. If you want a Doge coin, that's also one type of coin, that is called Dogecoin protocol. Monero coin protocol. Correct? Anything. NFT protocol. For all protocols, what is the underlying rule? How do you create a trail of transactions? Through SHA-256, and that is called as proof of work. Now let me tell you. If you see, for example, see, VK has maintained this, KL has maintained this, and Rohit Sharma has maintained this. Which ledger to rely on, we don't know. That's why we should create what? Rely on something called as proof of work. How does that work, guys? As I told you, the moment I enter into this transaction, each ledger will be organized into blocks. There are only 3 friends, but the entire Excel sheet is public. Anybody can enter whatever they want. But how do I know only 3 entries are correct? How do I know that Virat Kohli's entry is correct, Rohit Sharma's is correct, and KL Rahul's is correct? Through this blockchain protocol called SHA-256, that unique number it generates, right? So if you see, for each block, proof of work will be found. For each block, proof of work will be found. A block is valid, an entire block is valid only if it has proof of work, which means that number has to be found out. Who will find out the numbers? There are people called blockchain miners. They'll mine, they'll keep on searching, they will find the proof of work. For example, guys, you see these 3 numbers that you see, right? This is called as the proof of work. This is called as the proof of work. For each particular transaction, there will be a unique number. Virat Kohli will have a specific set of numbers, his proof of work. KL Rahul will have something, Rohit Sharma will have something. Now the beauty is how it is connected is, my dear friends, check it out. When Virat Kohli makes the entry first, a proof of work is created by applying what, guys? SHA-256. And that gets automatically attached to the next transaction, which is entered by Rohit Sharma and then by the other guy. If you see, this number will get attached to this number will get attached to this. So this entire thing plus SHA-256 will give you this number. Now this number plus whatever has been entered into plus SHA-256 will give the third number, and the third number will get attached to the next transaction, whereby all other people who write whatever they want, it will not get attached. Only the authentic, chain of transactions get attached through this wonderful concept. One block, second block, third block connected through SHA-256 protocol, and that, my dear friends, is called blockchain technology. Blockchain technology. Did you understand? Blockchain, chain of blocks connected through cryptography. If this is the secured level that we have, that is why many assets are created, right? Many assets are created. So if you see, these ledger blocks are chained with hash function. Hash function is that only. SHA-256 is called as a cryptographic hash function. Correct? CHF. That's called as a blockchain. Very, very simple. Let me not go more in depth into it, but using this blockchain technology, we can do many things. For example, practically, you have seen the Splitwise app. I use Splitwise app whenever I go on trip with my friends and all those things. Splitwise app is this only. Whatever I just told, that's how Splitwise works. In Splitwise, you can add payment, and it will be shared among all the things. Use that app. It's not a paid promotion. Use it. It really helps. Ola cab, Swiggy. Swiggy also uses blockchain. The moment you order, that it is using a hash function, order number is generated and it is attached to you. Tomorrow you cannot say I never ordered, right? Everything, my dear friends, your UPI app, your all UPI apps, Paytm, everything works on blockchain technology. And now assets are being created using this. Assets are being created. What assets are being created? I can create my own digital avatar. Nobody can use my avatar. How do I create my avatar? Again, using this blockchain technology. Correct? I am a musician. I'll create one piece of music. And that piece of music, in real life, I own it. But I will digitize it. And the digital version also can be sold. That is called non-fungible token. Fungible meaning only is that which cannot be what? Manipulated. Non-fungible. Non-fungible means which cannot be manipulated. So non-fungible token. So if I am Virat Kohli, I can sell my bat to you right there, bat. But I can create a digital version of that bat through this blockchain technology. Hundreds of Virat Kohli bat can come online, but which is the original Virat Kohli bat created by Virat Kohli's team using what technology? Blockchain technology. It can never be manipulated. NFT, right? That's the thing. So basically, this is the beauty of blockchain technology. With this, my dear friends, the what do you say? Possibilities are endless. Possibilities are endless. Right? So how will I find all this? How do I know that is owned by Virat Kohli? That's why these people who create, like Virat Kohli's team, will create the block, right? And the others will search for that block, and that is called as mining. Now this mining, etc., this is all taken from my blockchain course that I have done. In the sense, I have recorded a 3 to 4 hour blockchain in-depth course, which talks about the basics only, but in-depth, exhaustive basics. So there I've taken. Let's not go ahead. This much is enough to understand what, guys, blockchain technology. Now, come back to other areas. Now this, is there a tax on land owned? Is land an asset? Is one more question. Metaverse is a, alternative reality, my dear friends. And a couple from Tamil Nadu actually created their avatars, imagine, in the metaverse, and they got married there. They even asked people to come to their marriage in their own avatars. All this is the reality, my dear friends. Correct? All this is the reality. Nike recently released, their own Nike land. And you can actually buy, for example, you can buy those sneakers if you want to, right? Yes. They launched 20,000 virtual sneakers, out of which 98 were limited edition. Yes, you can buy. Now when you buy, my dear friends, Nirmala madam says, bro, cheating. You are buying there. What about tax? Tax. The buyer has to pay tax. But then, can Nirmala madam control if I buy Nike, which is in USA, assume? No. She is telling, let us regulate what is there in our country. If you buy any NFT, anything by an Indian resident, basically, a resident company, resident, individual, whatever it is. If a person from abroad buys, will it be covered? Yes, of course. Why not? Anything that is accruing or arising in India, I am going to tax, is what Nirmala madam says. Correct? Because all these things were outside the tax net. Now it has come inside with this amazing concept of taxation on VDA, which we are going to discuss the tax provisions. First, we need to understand the basics. Okay. So if I buy a Nike shoe, USA, taxation will not apply. But if I create something and if somebody else from outside buys, it will apply. So one Indian only buys my product, it will apply. Correct? Yes. Land, I can buy land also, my dear friends, because metaverse are measured in tiles. I can buy each square feet. It's in tiles. I can buy one tile. And that one tile also is protected using what? Blockchain technology, SHA-256, cryptographic hash function I'll add, and that tile. It's a unique ID is created and that ID belongs to me. I have to buy. Now an Indian company, as I told you, that Indian company is already launching these land, etc. I want to buy 1 square footage, 1 square feet of land. I want to buy in the metaverse. Will TDS apply? Yes. Got it? So if you see the meaning of this, you leave it. Okay. Running an e-commerce business or hosting an event also, definitely. You can host events. Like one of the companies in Chennai already has a convention hall digitally created. I can hire that. Think about it. I'm the buyer. I'm hiring the service. Is it allowed? We will see that. I mean, should I pay TDS? Yes. That 47A is what is inserted. Now the question is, capital asset, 2 clause 14, capital asset means property of any kind held by an SSE, whether or not connected with his business or profession, we know that. CIT versus Tata Services said land. The word property is obviously a huge meaning can be given to the word property. Any right which can be called property will be included in the capital asset definition. Now, virtual digital asset. The biggest question was before the government, land in the metaverse, for example, if it is not a capital asset, will it be a virtual digital asset, or are virtual digital assets only capital asset? Was the big question. Our government has made it so easy. Government has made it so easy. Let me just come to that now. Yeah. Government has made it so easy. Check it out. Hope you got the point. Now let's read the notes, dear friend. Now you see. Cryptographic means providing digital representation of value exchanged. I have created an artwork. Mickey Mouse I have drawn, guys. Awesome. Yes, Mickey Mouse, one fat Mickey Mouse I have drawn. If I print this and sell you, this is art. But using SHA-256, if I create using blockchain technology a unique ID, this will be called as a non-fungible token. Can I buy this? Yes. Let us say an Indian artist creates this. That art can be directly, he can do some art or he can use artificial intelligence, and then he converts that into a non-fungible token. NFT in 2021 was a super hit. 2022, everything crumbled because NFT for a particular, I own a MG Hector car. MG was the first ever automobile company to come out with NFTs of merchandise. But the thing is, they started, all people, we are Indians, guys. What we started doing was we went on Google, search for a picture, Mickey Mouse picture came. Some stolen picture, that is. Using that stolen picture, which is actually copyright is held by Disney. I said, on this also I'll create an NFT. Indians, we have amazing engineers. They created using blockchain technology on a stolen image. Imagine. And then they started selling. Yes, please take it. People started saying that, oh, this is a unique thing available, let's buy. Later they came to know of all the things, only some 15-20 things were original pieces. Everything was copied. So the entire NFT market came down. In simple words, I'm explaining. There was a lot of turmoil. People started losing money like crazy. Elon Musk came and told, yes, I'm going to take payment in Bitcoin. Bitcoin prices rise. There's no, what do you say, market. There's no regulator. Then he said, no, I will take Dogecoin. So Dogecoin, it went up. So when there is zero regulation, some regulation is there, and that is this particular thing. Now, And guys, you'll be shocked to know that we Indians have always, we are happy to know that we Indians have always been very, very skeptical about these things. Even during the 2008 subprime mortgage crisis, all banks started, selling these collateralized debt obligations across the world except India, where they said nothing doing. We will not sell any of these things. That's why we were protected by that recession that happened. Market collapse, economy collapse. Forget about market in USA. But you will also be, find it interesting to know that a country called El Salvador has accepted Bitcoin as legal tender, my dear friends. They have accepted Bitcoin as legal tender, and they have now opened a national Bitcoin office. Imagine this fellow. This guy is the king of El Salvador. See, cool fellow. But imagine, deadly it is. He's opened it. President Nayib Bukele has done it. See here, the verse token sale is live. All these now is a problem. If I'm buying any Bitcoin, buying any cryptocurrency, buying any NFT, buying any land, what to do? Check now. Cryptographic means providing a digital representation of value exchange. Yes. So if you see, the CG may exclude any digital asset from the definition of virtual digital asset by notification. They have included one. Non-fungible token shall be a digital asset, paintings, music, whatever it is, within 2 clause 47A, as specified by the CG, but think about it, does not include a non-fungible token whose transfer results in transfer of ownership of underlying tangible asset, and such transfer is legally enforceable. Guys, I make one painting like this, which is tangible, and using SHA-256, I create a NFT. If I buy that NFT, I am going to own this tangible asset. Is it virtual digital asset? No. That's why I did all this. I actually drew a painting, converted that painting's originality title using VDA, and said if you buy that, that digital asset, you will own my painting. That painting is tangible. Is it a VDA? It is actually a VDA, but is it VDA as per Income Tax Act? No. Hope you got the point. On the other hand, this shoe that I showed you, I'm just saying, if an Indian company, this doll, if an Indian company wants to sell this shoe for $130,000, it's a virtual shoe. It is not a real shoe. I'm buying virtual shoe. People bought it for $130,000 per pair. I'm not joking. I'm not making it up. If I buy that shoe, not real, virtual shoe, this is a virtual digital asset as per Income Tax Act. Hope you got it. Right? If I buy a real shoe is there, only token is sold in Nike land. I buy the token virtually. Then using that token, it's a code here, I can go scan the code saying that I am the owner, they'll give me the shoe. Is that a virtual digital asset? No. That is what they are trying to tell. Correct? Specified, but does not include a non-fungible token whose transfer results in transfer of ownership of underlying tangible asset. Underlying tangible asset. It is not. Okay? So if you have any QR code, which is again linked specifically, you can scan that and you will get that particular item, tangible item, not a VDA. Though it is technically VDA, government has excluded it through the notification. Then like that, my dear friends, when I go and swipe a card in my credit card, I get points. Cred, for example, I have for some 10 lakh, assume 10 lakh cred coins. Is 10 lakh cred coins actually a virtual digital asset? Can I redeem those coins for something? Yes. Can I redeem those coins for buying, some item? Yes. I want to buy a speaker. Can I redeem 5 lakh cred coins? Yes. Will I get an asset? Yes. But those coins, are they virtual digital asset? Yes. But government says no. See? Gift card, voucher, mileage point, reward point, loyalty point, etc. are now excluded from subscription to websites, platforms, any app. Subscription to app is a VDA. It is excluded from the definition of VDA. Subscription to app is an actual VDA, but government says no. So for examination purposes, income tax purposes, what is not VDA? Tangible asset is there. I've created a token. You give the token, I'll get the tangible asset. I'm an artist. I've created the painting, Mickey Mouse. That is not VDA. Then loyalty points, gift card, mileage points, reward points, all this, not VDA. Not VDA. Right? Then what about land? Now, is this a capital asset or not a capital asset? What about capital asset like land? Correct? Or is it a capital asset? Not a capital asset. Beautifully. They have inserted two sections, 115 BBH, 115 BBH and 194S. Okay. So first of all, they have defined it under, they have defined it under 2 clause 47A. Next, they have written 115 BBH. This is taxation. Then 194S. 194S. This will be taxation. This will be TDS. This is the chargeability. This is the TDS. Chargeability and this is the TDS. Chargeability, this is the tax. While computing your income, just like lottery, etc., you need to collect this. Correct? If you are doing this lottery, horse race, etc., chargeability is different. And then you have to pay. TDS also is different, if you know. So lottery, chargeability is also 30%. TDS is also 30%. But here it is different. Chargeability is 30%. But TDS will be 1%. Remaining, you have to add it to your income and later pay tax. So they are regulating it. Please note. Now, the question was, I had released a video on metaverse on land before. That time they had not defined. Now I am asking, land, is it a capital asset or not? Whether everything is included? Whether everything is transfer? You see, 115 BBH, whether total income of an SC includes any income from transfer of any virtual digital asset. Income tax payable is what? See here. Purpose of this section, the word transfer as defined in 2 clause 47 shall apply to any virtual digital asset, whether capital asset or not. Deadly. Whether it is a capital asset or not, let's not go into the definition only. Whatever I have told as VDA, whether it's a capital asset, not a capital asset, I don't care. Taxation will apply. Hope you got the point, my dear friends. So tax on income on transfer of VDA 30%. Expenses or set off of losses is not allowed at all while computing income on transfer of VDA. No expenses will be allowed, my dear buddies. Deadly. No set off of losses. I have business loss, I don't care. I have any other head loss, I don't care. See? No deduction as part of any expenditure other than cost of acquisition, if any. First, cost of acquisition has to be allowed. Or allowance or set off of any loss shall be allowed to the SSE under any provision of the Act. No set off of loss from transfer of VDA computed under A of subsection 1 shall be allowed against income computed under any provision of this Act. And such loss shall not be allowed to be carried forward to succeeding assessment years. I made loss by selling Bitcoin 10 lakh rupees. Can I carry forward? No. No. I made loss of 2 lakh rupees. Can I set it off from income from business? No. Capital gains? No. Anything else? No. Not possible. I made loss from sale of Bitcoin. I made profit from sale of NFT. Can I set it off? Answer. No set off of loss from transfer of VDA computed under clause A shall be allowed against income under any provision of this act to the SSE. Against income computed under any provision of this act to the SSE, and such loss shall not be allowed to be carried forward. It doesn't say any other provision. This will open up, litigation will open up. Right? But practically, I mean, I've done a couple of cases. My friends are fully into this. So there we have set it off because they are here talking about what? Income. Under 1A. Income tax will calculate transfer of such virtual digital asset. So ideally, if there's a loss overall year, I will take all the VDAs and whatever income on that. If there's a loss, overall loss cannot be set off. Mind you, here it doesn't say any other provision of this act. If it said any other provision of this act, then you could have clearly interpreted it as loss from this VDA can be set off against profit of VDA. Correct? So this will definitely open up into litigation. Examination they'll not ask. This part you leave it. Okay? Yes. So basically in the exam, what? No set off of losses. No set off of losses. So inter-head set off not possible. In my regular batch, we will discuss this more in depth. Leave it because I'll have to talk about this one word. Such means what? What is such? Later, not now. Not in the fast track premium batch. Okay. Next. Not needed also, guys. Okay. Only cost of acquisition, of course, is deductible. 100%. So if I sold Bitcoin for 10 lakhs, I had purchased it for 8 lakhs. 2 lakhs is the income on which 30% is what? No carry forward. Here I have given, see, transfer shall apply to any virtual digital asset, whether capital asset or not. Then one more deadly thing. What if I gift my Bitcoin to my wife? If I gift my Bitcoin to my friend, sir, girlfriend, no da, friend, right? Beautiful. Nirmala madam. 56.210 also she has amended. And she has inserted VDA there also. So gift of anything is also covered under 56.210. Gift taxation there it will come. Income from other sources. Deadly. Right? So if you see the gist of the entire thing, I have added it here in this. So the material is designed in such a way that you need not read the bare act. In the class, you will read the bare act, analyze each and every word, then come to the material. Then exam, one day before the exam, and for everything else, only this. It has a lot of thought has gone into creating this, material. Let us see the clarification still, right? Now guys, coming to the taxation. Taxation. I am buying an NFT, non-fungible token from an artist. And mind you, that token doesn't represent any painting. That token is the digital version. Basically, I am buying the digital version like that Nike shoe. I am buying that digital shoe. Okay. Now, the primary liability is on whom is the question. So you see, very important section 194S TDS. Chargeability is 115 BBH. Taxability, the TDS portion is 194S. Any person responsible for paying to any resident. So this will not actually apply to Nike Land shoes sold in USA. It applies to everything that is sold to by payment to a resident. Asset can be somewhere else also. Let's say one of my friends is selling a painting which was where the NFT was created in USA or anywhere across the world, but the payment is to a resident. That is what this covers. Any sum by way of consideration for transfer of VDA. VDA may be capital asset or not, we have seen. At the time of credit to such sum of the resident or the time of payment, whichever is earlier, same dialogue like all TDS sections, deduct an amount equal to 1% of such sum as income tax. So my dear friends, here if you come read with the CBDT guidelines, most important thing, section 194S, primary liability is the buyer. So Miss KG is a seller and owner of a Bitcoin or a painting, digital painting, which is an NFT, whatever the case may be. And when she is transferring it to me, Mr. PJ, who's the buyer, has to deduct TDS. Whatever amount I am paying minus 1% under 194S. Sir, but one doubt, sir. What if, sir, PJ and KG, they do it, sir, but through a e-commerce operator? For e-commerce operator, 194O will apply, sir. 194, O will apply. What if KG is selling to PJ goods, is NFT, VDA, for more than 50 lakh rupees, for more than 50 lakh rupees. And PJ is a big buyer. His turnover is more than 10 crore rupees. What I am asking is, my dear friends, I am asking this, for example, if the VDA happens through a e-commerce operator, I am linking it to other sections. These sections have already been completed in class with charts and have made it very easy for you, if you remember. So if this entire VDA transaction is going through 194O, what to do? Or if I am seller, KG, selling it to buyer, where buyer is a big buyer. My turnover in the last year was 10 crore. What to do? Should I go to 194Q or 194O? Can be asked in the exam. Or should I stick to 194S? Check this. Notwithstanding anything contained in 194O, this section overrides 194O. Very clearly given. In case transaction is the provision of said section are also applicable, tax shall be deducted under 194S only. Correct? It will be under 194S and nowhere else. Got it, my dear friends? That's what. So, and also, if you see, if any difficulty arises in giving effect to provisions of this section, board, that is CBDT, with prior approval of CG, issue guidelines. These one deadly line is only these guidelines. Most important for the examinations, which we are going to do. Right? They had this doubt also. What about 194Q? CBDT said, bro, general rules of interpretation, bro. Specific section will override general section. If there is VDA, don't go to OQS, OQT, whatever section you want, come to 194S only. So those 2 points are covered. No need to read the Bare Act, that we'll do in class, only this material. Check if provisions of both 194O and S apply, you should deduct tax under 194S. Point number 8. Point number 9. 194Q is not applicable when TDS is deducted under this section, discussed already. Point number 10. CBDT may approval of CG issue guidelines. Guidelines you have to do here. All this is there down. Important. Anything they can, 2, 3 to 4 marks, 6 marks also they can ask. You never know. Payer any person. Payer any person can be resident, non-resident. Can be resident, non-resident. Can be any person, guys. You see, If virtual digital asset is transferred to a non-resident, provisions of 195 also shall apply. Obviously, 195 is non-resident taxation. So if it is given to a non-resident, 194S read with 195, which we will cover in international taxation module. If it is to a resident, then of course 194S will come. Who is this fellow? Buyer. Pay will be resident only. I am Nirmala madam is controlling things that are happening in our country. Let the other people die. I don't care. All in other US and all, $1 billion company has been, it's zero now. 1% of the consideration at the time of payment or credit, whichever is earlier. Have not paid, have credited yet. Yes, whichever is earlier. Amount is 1 crore, of which I have paid only 50 lakh. I should do it on 1 crore or 50 lakh. See, deadly guys. I can ask so many questions. Consideration payable, payable, payable. Correct? At the time of credit of such sum, any person paying, they are not telling, responsible for paying. So if you put 1 crore as credit, full amount you have to pay, not the amount that you have actually paid. Hope you got it. Either some credit or at the time of payment, whichever is earlier, they should do it. Consideration for transfer of VDA, it can be a capital asset or otherwise. Now, if you think about it, guys, at the end of the day, he is just a simple buyer. He has to deduct TDS. Should he take TAN number now for one simple transaction? If you remember previous discussions, 194O, 194Q, in all these are peculiar, 194Q especially, not O, Q especially, peculiar transactions, 194M, in which a normal individual, 194IB, rent, normal individual I am, 194IA, transfer of immobile property. So individual, when I am purchaser of immobile property or a payer of rent more than 50,000, why should I take TAN? TAN not needed, right? So you see, even for this, I am just buying one Bitcoin. Why TAN? See here, provisions of 203A will not apply. Provisions of 203A will not apply. Then one brand new section was there. Non-filer of return, brand new section. If you are a non-filer of return, means what? This also they can ask you. This can be an exam question. Just give you here. Mr. A has not filed the return for 21 and 22, not filed. And in that TDS, return of income not filed. TDS of 60,000 was there. He has not taken credit also, has not filed the return also. This year, he has transferred he has bought a VDA. Correct? Or let's say he sold a VDA. Sold a VDA. The buyer, tell me one thing, guys, in this example only. I'll come to this example only to make it easy. Miss KG is a person who has not filed the return for 2 years. TDS is more than 50K pending, in the sense not claim credit. Miss KG is a non-filer. For such non-filers, a brand new section had been introduced in the previous Finance Act 21, Finance Act 21 from 1st July 2021 to be precise, 206 AB. Under 206 AB, she has to pay double the rate or 5%, whichever is higher. What is the rate here? 1%. Double the rate is 2%. 2% or 5%, whichever is higher. Let me show you that. See here, twice the rate, 5%, whichever is higher. You have to pay. Now tell me practically, will PJ individual buying one Bitcoin, will I know whether KG filed return or not? Whether she has TDS balance of 50,000 or not? How will I know? Why should I care? Why should I care? Tell me. So guys, beautiful. Every line means a lot. I'm not joking. Don't take it lightly. Anything they can ask. See here. Provisions of 2038 10 and 206 AB at 5% thing shall not apply. Means what? No need of higher rate, deduct 1% only. No need of higher rate, deduct 1% only. Got it? Here. Here. Shall not apply. Now, nature of payment, yes. First, if the consideration paid, in this example, if PJ is paying the consideration, buyer is an individual who does not have any income from business or profession. Let's say I'm a salaried employee, I want to buy one Bitcoin. In my life, one objective I have is buying a Bitcoin. I buy. Let's say I buy it for 40,000 rupees. Should I deduct TDS for one transaction? Just assume. Should I deduct TDS? What do you think? Government said not required. They said specified person who's an individual or HF, not a company, individual or HF. All very, very important points. 100% they'll ask. Any income from business, he doesn't have any income from business or profession. Point number one. Or let's say I'm a businessman, but I'm a chaprasi. What do you mean by chaprasi? My turnover or gross receipts from business in the previous year does not exceed 1 crore, or from profession does not exceed 50 lakhs. I am either a salaried employee, or I have other, apart from business, I have income from other sources. Or if I am into business also, I'm a chaprasi businessman, chaprasi professional. Means what? Turnover in the previous year 1 CR, or this thing, profession less than 50 lakhs, less than or equal to 50 lakhs. Then I can pay consideration up to 50,000 without TDS. I can pay consideration of, without TDS. Very, very clearly they have given yes. No tax shall be deducted in a case where consideration is payable by a specified person. I told you. Who's specified person? Salaried person, or this. They can ask you in the exam question, they can ask you. A salaried doctor who is working as an employee in Manipal hospitals, earning 1 crore salary, 1 or 2 crore salary per annum. 2 crore salary per annum. Exam question they can ask if they want to make it tricky. Earning 2 crore per annum. Doctor, salaried employee, earning 2 crore per annum, buys a VDA worth 30,000. What do you think? Will you see this? No, it is not income from business, not income from profession. He's a salaried employee, as I told you. He's a doctor working as an employee in a company, not a consultant. Employee. He has a contract of service. 30,000. What do you think? It will come under the first one. Does not have any income from business or profession. Very clearly given. See? Specified person. Does not have any income from business or profession. So yes, for him also 30,000 will apply. When will you see, the 50,000 will apply? When will you see that 1 crore? Only if he is in the business or profession. I hope you got the point. Anything they can ask to play around with you. Other cases, I'm a big businessman. My turnover is 5 crore in the previous year. I am buying one NFT worth 15,000. Should I pay TDS? Yes. You see, no TDS if consideration is less than or equal to 10,000 during the financial year other than specified person. For specified person up to 50,000, no TDS. Who is a specified person? Either is an employee or he has others, apart from business, he has other income, or not and, or if he is into business, previous year less than or equal to 1 CR should be his turnover, or gross assets from professional less than or equal to 50 lakh. Then limit is 50,000. Is 50,000 basic exemption limit? No. For example, if that fellow buys an asset worth 60,000, will he pay tax on 10,000? No, on full amount. Please don't, again there get confused. Correct? It says does not exceed 50,000 during the financial year. No tax shall be deducted where it does not exceed. Value of such consideration does not exceed. What if I pay 20, 20, 20? No, it's not exceeding 50,000. Aggregate value. Hope you're getting the points, guys. Aggregate value they have given. 20, 20, 20. Sir, it's less than 50,000, sir. No TDS. Bro, aggregate value. So you should add all the transactions during the year for that such consideration, whatever he has done for that digital asset. Is it per asset or all put together? Is it per asset or all put together? Oh, virtual digital asset, per asset. How many questions an examiner can ask you in MCQ? I hope you are able to understand and appreciate. Forget about appreciation. I hope you are able to understand. VDA 50,000, 10,000, 1%, section over. You will exam your sitting. They are giving. Oh, you will tick something. Macha, dead easy paper. Result easy dead. 65-70 guaranteed. In the exam, divided by 2. In the result, divided by 2, divided by 3. Chaprasi faculty didn't teach properly. Blame number 1. Blame number 2, book was bullshit. You will tell. Right? That's the problem, guys. Please. DT is no joke, but DT is easy. Correct? DT is easy. All we need is not shortcut methodology. All we need is a proper detox. Detox. DT. Detox. We need a detox. Not the stupid way we've been studying. We have to change the way we study. Hope you got the point. Right? Next. Done. 7th point I'll cover through guidelines. Now, if I buy 40,000 asset, let's say I'm a specified person. 40,000 I buy. GST I will add, assume. Some 15,000 GST will come. Now, 55,000. What do you think? Or let's say 49, it shouldn't exceed, no, 49,000 plus some 6,000 GST. Is it exceeding 55,000? Should I pay? See here. Any GST, any commission, etc. shall not be included to deduct tax on the consideration. Will not be included at all. See the examples and then we'll do the CBDT guidelines. Income from salary 1 lakh, income from other sources 50,000, income from transfer of VDA 50,000. In this case, income of the individual other than income from VDA shall be below the basic exemption limit and that shall not be subject to tax. Obviously, 1,50,000 is below exemption limit, but no exemption here. Tax on VDA will be 30,000 into 50, 15,000 plus higher education says 4%, 15,600. Other income separate, this separately you have to pay. Sir, everything comes under basic exemption limit, no relaxation. Absolutely no relaxation. There is no relaxation whatsoever. You have to pay. Sir, I will not credit the person. I will not pay also. Correct? Here NFT I am getting the asset. No. NFT to KG I have to put and KG to bank. I will not put NFT to bank. I'll not put NFT to KG. I'll say NFT to suspense account. In our balance sheet, when I was not tallying suspense account, Nirmala madam is looking at you like this. Hey, cheating. You'll put suspense account and then you'll tell, I didn't credit to the buyer. I didn't credit to the seller. Sorry, I didn't pay. Nirmala madam will say, when did you put it to suspense account? That day only I put, madam. Then that day only I have to pay. Huh? Yes. This point is there in all the sections anyway, you know that. Where any sum referred to in subsection is credited to any account, whether called suspense account by any other name in the books of PJ, such credit of sum shall be deemed to be credit to KG. Deadly section, deadly. Okay, next. In the above example, instead of income from salary, X had furnished loss from business 4 lakh. In this case, loss of business can only be set off against income from other sources. Remaining business loss 3 lakh 50 can be carried forward for the next year. Tax on VDA will be calculated as above. No loss can be set off against income from transfer of VDA also. You have seen that. No set off of loss from transfer of VDA. And no other allowance or no set off of loss shall be allowed. You have VDA income set off against loss of any other head, not possible. You have any other head income set off against loss under VDA, not possible. Nothing is possible. Second chart. Now, VDA transaction can also happen through exchanges, guys. Coin switch Kuber, you would have heard, right? Then Wazirex, you would have heard. Coin is one more exchange. Coin switch Kuber, all these people are coming up now. Wazirex is the largest platform in India. Now, if Mr. PJ transfers money to the exchange, all CBDT guidelines. Miss KG gives the Bitcoin through the exchange, which I can trade now. Ideally, who will take the, TDS portion? I will deduct or exchange will deduct? CBDT says it is better if exchange will take it up. Exchange will have to deduct. Exchange will deduct 1% TDS and then give it to the Miss KG. Whatever amount, Bitcoin is what I bought, right? Give it here. So if it is happening through an exchange, see, it's not regulated sector. So that's why you can do it directly also, or you can do it through the exchange. It's happening through the exchange. The liability falls on the exchange where they have an option. All the platforms, I've used them, they actually do this. Now, because buyer, why will he do? This is just on paper. Why will he do this? It will be through an exchange. Got my point? First basics. Now slowly we are adding layers to it. Next. This is the case where seller and owner is Miss KG. If you read the guidelines on your own, you will go mad. This is the gist of it. Anyone can be picked directly in the exam and given. Miss KG is the seller and owner. But what if exchange only is the owner? Now, if exchange is the owner, yes, it is possible. Exchange will be selling it. I don't know who is behind it. I don't know whether KG is the owner, exchange is the owner. I don't know, boss. Government understands this. I am buying through the exchange. Where is the coin going and to whom? I don't know. Then a question will come. Should I deduct TDS because you are the seller? I am the buyer, you are the seller. I am buying from you. Are you the real seller? Or somebody else is there from behind? I don't know. So if you see, Mr. PJ has to deduct TDS. Correct? If coin is the owner. But I don't know. Mr. PJ may be confused if VDA is truly owned by coin or somebody else. I don't know. That's why, again, one more dialogue. Mr. PJ and Unocoin, that is exchange, will enter into an agreement whereby gross amount is transferred to Unocoin without TDS. And Unocoin themselves will pay tax. And they will file a form called 26QF. And the best part is, will Mr. PJ be called as SSE in default? Because if you do not deduct TDS, two things. If you have deducted but not paid, second, if you have not deducted only, generally you will be called as an SSE in default under 201. And you will have to pay 1%, 1.5% interest in different scenarios. Finance Ministry clarifies in this scenario when Unocoin is the owner. In the exam, they can ask you anything. First one. Second one, what is the, explain the VDA transaction through an exchange. Third one, what if the exchange only is the owner? I don't know. So again, Mr. PJ and Unocoin will enter into an agreement. The moment you procure an agreement and gross amount you have transferred without deducting TDS, Finance Ministry clarifies Mr. PJ is not an SSE in default. Important. Deadly. Still not over. They can ask minimum 4 to 6 marks in the exam, guys. If they want to play around with this section. Next. What if I do it through broker? There are brokers also now. You see, PJ, step number 1, will transfer money to the exchange. Exchange will now sell that to the broker by deducting TDS. Broker will keep his commission and again further deduct TDS and give it to the final owner, Miss KG. Miss KG will transfer this Bitcoin here, Bitcoin here, Bitcoin here. 2 times TDS will definitely come. Finance Ministry understands this problem. So they say, kindly enter into an agreement. Unocoin and broker. Merging step number 2 and 3. Merge. The broker to deduct TDS. An exchange again will file quarterly return under 22QF. You getting my point? Form numbers not important. Content is important. Yes, all these are clarifications, guys. Came sometime in circular, through circular in June 22 or something. Got it? 3 done. 2 more to go. The form number is, 26QF here. 26QF is also 26, guys. Sorry. Typo. 26QF. Next. Exchange of VD or transfer in kind. I told you, this I will explain. Partly in cash, partly in kind, or generally in kind. What happens, guys? See, I am Mr. PJ. I am buyer of Dogecoin, seller of Bitcoin. Miss KG, buyer of Bitcoin, seller of Dogecoin. Now, Bitcoin and Dogecoin values are different, keeps on changing. So, if I am buying one Bitcoin, I may have to give hundreds of Dogecoins, correct? If I am buying a Bitcoin, I may have to give hundreds of Dogecoins, plus I may have to give cash also. So, when it is like that, what to do? Both are buyers, both are sellers. PJ has to ensure that I am deducting tax and giving to KG. KG has to ensure that she is deducting tax and giving to Mr. PJ. Finance Ministry says both are buyers, both are sellers. So each of you has to give proof. For example, if you see here, I am obviously buying Dogecoin and selling Bitcoin. So I'll have to, since I'm the buyer, I have to deduct TDS. and then give a tax challan. This is theoretical. I'll tell you why it is not practical. And what is the practical scenario, I'll tell you. Finance Ministry has thought a lot. They are telling Mr. PJ, step number 1, first makes a takes a tax challan for payment of tax by Miss KG. Similarly, tax challan for payment of tax by Mr. PJ. PJ, you have to give a tax challan to KG saying that you have deducted tax and paid already to the government. KG has to give a tax challan saying that, look, I have already deducted tax and I have paid. Only after it is collected, then this transaction can happen. Guys, practically, how is this possible? How much tax will I pay? Correct. How much tax will I pay? You see, 1 Bitcoin is 1,70,890 Dogecoin. Let us suppose I do something about it. Then at what rate will I deduct? Let's say I'll figure it out. Then what rate will I convert? Practically impossible. That's why this is the actual one. So here there is an option given to be exercised by the exchange, important. And this option will be exercised by exchange, otherwise nobody will buy Bitcoin and all those things. This I have taken DESO and Monero coins, which CBDT also has given the same example. That's why they have given it in paragraphs. I have converted, visualized, and made it a chart. Becomes very easy for you to understand. So if Mr. PJ, who's a buyer of DESO, seller of Monero, this is Monero, this is DESO. Very simple. Buyer of Monero, seller of DESO. Nothing, guys. He will sell Monero to Unocoin exchange. Miss KG will sell DESO to the exchange. That will be transferred to PJ, and this Monero will be transferred to KG. Unocoin exchange will have an agreement. They will file that form 26QF quarterly. Now, they will see that day's market trend. They have both there. They have both there. They will convert it. This DESO and Monero doesn't have a market in India. It is not easily tradable. They will, using average rates, which is not relevant for the exam, convert it to Ethereum. Ethereum is something which can be converted to INR. Bitcoin can be converted to INR. Ethereum can be converted to INR. DESO Monero cannot be converted. Very difficult. It has to go through various foreign fluctuations and then come to India. So I will convert to Ethereum at a one formula is there, average rate, that you leave, not important. Then that is converted to INR. And the TDS is then remitted to the CG. Who will remit TDS? Unocoin. This is what it is. So that's what it says here. If you see, when the consideration is wholly in kind or partly, then the payer should, before releasing, ensure that the tax has been deducted and paid. Now that cannot happen practically. They only realize it. So this clarification they brought about. So my dear buddies, this is the most important discussion on VDA. 100% question. May 23, November 23, 4 to 6 marks. I hope they ask. I hope you understood. The only way to study DT is through a DT detox, and that is the Buyback methodology. And as you have seen, whatever was in the Buyback completely concised into just 3 pages. If 3 pages can give me 4 marks to 6 marks, think about it. On that note, thank you so much, guys. Hi, my dear friends. How are you doing? I hope you can hear me. Hello, mic testing. Yeah. My throat is gone. So let's do slowly and as much as possible. So today we will be doing some Miscellaneous topics, my dear friends. Let us come to, if you remember, we had done bond washing transactions in one of the earlier classes. There are other two small things. This is, I am reading page number 05. So we'll finish off these two areas. And then if you remember, in deductions, chapter 6 deductions, I told you ATC, ATD, etc. You can probably, we can see it later or you can revise. So I'll at least do the important areas. See, we had finished the income based deductions fully, if you remember, but the what do you say, expenditure based deduction, so to speak, ATC, ATD, ATC, CD, all those things, in that important areas we will cover. These are the areas which will only come in the exam, because other things are all covered in CA Inter. CA Inter portions they will not ask. What they will ask is some hidden points which will also come in international taxation. So today's class will be only focused on deductions under chapter 6A, and of course bond stripping, interest stripping transactions will finish it off. Bond washing transactions already done. This is in 05, and this deductions will be H onwards. So these two miscellaneous areas if we finish, then in the next class onwards we can start off with capital gains. So next set will be around 4-5 classes, whatever it takes will be capital gains. Capital gains also will not be going, whatever was taught in Inter. Of course, we'll be telling everything. I'm not saying that we are skipping anything. But what I'm trying to tell is we'll concentrate more on what can come in the exam rather than going everything full in depth into the area which you already would have studied in Inter. Having said that, if you say, sir, I have not touched anything in Inter, don't worry. Still, the classes will be extremely relevant and you'll be understanding everything. That is my promise. So we'll be going with the basics itself, going from the basics. But what I'm trying to tell is, in Inter, the concentration will be something else in capital gains. And capital gains is a very important chapter in CA Inter. Then CA final, it may come for around 4-5 marks as different adjustments. But let's not concentrate on CA Inter syllabus, which will only give you like, oh, if this is a capital asset, is that a capital asset? No. Let us discuss more on the CA final aspects. But as I again repeatedly am telling you, even if you haven't studied Inter or even if you have forgotten Inter, capital gains, you would have cleared. How you cleared, how I cleared, I only know, sir, and all. If you tell also, what I'm trying to tell is it will become very easy, don't worry. Okay, so these two will finish off in this session today. Come to page 05. Bonus stripping, bond washing, and tax-free interest stripping transactions. Let's just do the interest stripping portion once, because bond washing is already done, guys. 94.1 we had done a few classes ago. Interest stripping transaction 07. So guys, think about it. What I'll do for tax planning is, there'll be a date called as the record date. What is the record date? It is the date on which interest is paid. So basically there are many bonds, debentures, etc. So wherever interest is paid, just on that day, that is called as the record date. So I know on which day interest is paid, and the bond value, let's say I bought something at 1 lakh rupees at let's say 4% interest. Just around the record date, the value would be around 1,04,000. Obviously, it is including interest. So what I'll do is, at the time of this, I will purchase this just before the record date, and immediately after the record date, guys, immediately after the record date, the bond will lose its value because interest is already accrued. So this, let's say, will be selling at 1 lakh rupees immediately after record date. So what I used to do, I buy at 1,04,000 and sell at 1 lakh. So what will my short-term capital loss? It will be 4,000 rupees. This 4,000, I will use it to set off against my long-term capital gain. This is the thing that I used to do. Apart from that, guys, this interest that I am getting, 4,000 rupees extra interest, that is also tax-free. So now let us assume that this is 99,000. So what will be my loss? 5,000 rupees. And here, this is also interest-free income. Plus this loss also I get to set off. Super tax benefit. So to curb this from happening, what section was inserted? Check this out. 94.7. According to 94.7, in certain cases, loss arising from transfer of any security or units is not allowed to be set off against other income. If any person buys or acquires, see, around the record date I will buy, no? So this had to be stopped. This tax planning had to be stopped. How did they stop this tax planning? Very simple. They said in and around the record date, 3 months. 3 months is a good enough time. Plus or minus 3 months, if anybody buys or sells any securities, then they are not allowed to set off the income versus the expense. We'll see it with an example, you'll understand. Any person who buys or acquires any securities or units within a period of 3 months prior to the record date. Such person sells or transfers such securities within the period of 3 months after such date, or such units within a period of 9 months after such record date. Right? Interest stripping transaction. So certain units, units of your mutual fund, etc., 9 months time for that. Whereas securities, 3 months time. Securities, 3 months time. So securities will be 3 months, and units in mutual fund, etc., will be 9 months. But let's just stick to the securities here. Securities means what? Your interest filled securities. It could be anything for that matter. It could be your bonds, debentures, etc. Whereas this units would be units of mutual fund. Anyway, in the mutual fund, when we are discussing those other trusts, etc., again we will check that later. But yeah, buying or acquiring any security or unit within 3 months, or selling or transferring securities within 3 months, or such units. Units would be prescribed units, as like mutual fund units, etc., within 9 months. So buying or acquiring 3 months, selling or disposing of 3 months for securities and 9 months for units is exempt under income on which or units is exempt under Income Tax Act. Then the loss, if any, arising on the transfer of such securities, in my example, loss of 5,000 or 4,000 initially in my example, shall be ignored to the extent of income therefrom for the purpose of computing his taxable income. Purpose of, taxable income. Right. Then you can write down one dialogue. If loss is less than or equal to income received, it says what? Such loss shall be ignored. Correct? If loss is less than income received, if the short-term capital loss is less than the income received, then 94.7 will not apply. Basically, 94.7 will only apply if, the set off, etc., will not be allowed to you. They are saying that the loss will be ignored only when the loss is greater than the income received. The loss is greater than the income received. When we do a sum, you'll understand, guys. Very simple. So guys, if you see, 94 covers holding of securities both as capital asset as well as stock in trade. Hence, interest stripping transaction will apply both to investor as well as trader. Investor also, trader also. Check it out. Nimit acquired 10,000 securities of Nomura Private Limited for 400 per share on 18/11. Company fixed recorded as 112 and granted interest of 20% per 20 per security. This interest is notified for exemption at 10:15 by the CBDT. It's a interest-free, tax-free interest income. Securities were sold by Nimit for 410 per security on 1 after receiving interest. See, Nimit had acquired and sold tax within 3 months. Net result is a short-term capital gain because he's selling it at 410. This will not come. I told you. Is there a loss is less than income received? It's not even a loss, it's a gain. the section will not apply. As there is no loss, section will not apply. However, that 2 lakh rupees interest, it is completely exempt. But if he had sold it for 370 per security, then you see guys, what is the sale price per security? Let's make it in lakhs. So 370 per security into 10,000. Correct? So it is 37 lakhs. Sale price is 37 lakhs. Cost only is 40 lakhs. Why? Because I had bought it at 400 rupees. 400 rupees. Correct? 40 lakhs. What is the short-term capital loss? 3 lakh. What is the income that you have earned, my dear friends? You have earned 20 rupees per security. So 20 into 10,000 is 20 lakh. As I told you, if the loss is less than or equal to income generated, section will not apply. But in this case, loss is greater than the income. Hence, to the extent of the loss, to the extent of the income, it will be allowed to be set off, which means this 3 will be used to set off against this income 2, but this one will be ignored. This one will be ignored. Balance to be carry forward means it will be ignored. It will not be taken into consideration for any computation. I will not reduce the, income further. Moreover, I will not use this loss, this 1 lakh loss, 1 into 10, 10 lakh loss, not allowed to be set off. One lakh will not be allowed to be set off. That's what. When it said it shall be ignored for the purposes of computing tax, means it shall not be allowed to be set off. Next year, if I make any other gain, then I'll be allowed. Only under this head I'll allow. I'll not allow it under any other heads. For example, long-term capital gains can be used to set off the short-term capital loss. This short-term capital loss will not be allowed to be set off against any long-term capital gain. That's what it means. So balance 10 lakh will be carried forward. This is called as interest stripping, my dear friends. Very, very simple. So important. For here and there, for MCQ, etc., they can ask you. Next, let's come to another interesting area, bonus stripping. Bonus stripping. All right, guys. So we will be discussing bonus stripping. So guys, this is important because there has been a very important amendment as per Finance Act 2022. What is this bonus stripping transaction? Very simple, guys. Let's say there are around 1 lakh. I have around 10,000 shares, okay, of some company. Let's say I have 10,000 shares of Infosys. I know that every year Infosys declares dividend, and Infosys, I also have a notion. I'm a market, researcher. I keep an eye on the market, assume, and I know that when Infosys will declare bonus, etc. Even if you go to any website, your NSE, BSE, you can check all the companies that have declared bonus and what are the dividend, bonus rates. There are X bonus rates and bonus rates. That is, after the bonus, whatever it is, the rates obviously will shoot up, as you know. So let us say Infosys declared 1:1 bonus, and the bonus rate is around 500 rupees per share. So let's say 2,000 rupees. Let me make it a little higher, 2,000 rupees. So now I will buy 10,000 shares. Well, let's say I'll just buy 1,000 shares, right? So I pay 20 lakh rupees and buy 1,000 shares. This is bonus amount. That's why the per share amount is high. Immediately after issuing bonus, I will buy this. So now 1:1 bonus, right? So how much will I get? I will now get 2,000 shares. Initially, I got 1,000 shares at 2,000 rupees. 2,000 rupees because it's a bonus rate. So as of now, I have 2,000 shares. Because it is 2000 shares, the market value becomes obviously 500 rupees. Sorry, market value becomes from 2000 it becomes 1000 rupees because I've got 1:1. So now I have 2000 shares and the market value slowly has decreased to 1000 rupees per share. Now what I'll do, guys, I will sell the original 1000 shares that I bought. The original 1000 shares that I bought, I will sell. So I will sell obviously at a lesser rate, correct? So what happened was initially I selling price of those original 1000 shares at 1000 rupees per share would be 10 lakhs. Cost of acquisition is how much? I bought initially with 20 lakhs. So what would be my short term capital loss, guys? It will be 10 lakhs. Short term capital loss will be 10 lakhs. The beauty is only 1000 shares have gone out. 1000 shares had come in, but that extra 1000 shares I still have with me. So this also, whenever I want, I can sell, or next time when they issue bonus, I can sell it, I can play around. But here also same thing has happened. This short term capital loss of 10 lakh will be set off against some long term capital gain. This is what planning I generally do. I buy 1000 shares, I wait for the bonus, 1000 will become 2000 shares, then I sell the original 1000 shares. So at the end of the day, I will have retained 1000 shares, but I also have a loss of 10 lakh rupees. This 10 lakh will be set off against some income. That is long term capital gain. Many people used to do this. That is why the concept of bonus stripping came. The bonus stripping can happen in shares, that is securities, or it can happen in mutual fund units, just like the previous one, interest stripping. That was interest stripping. This is bonus stripping. My dear friends, till 2022, people could have still played around with this. Bonus stripping was restricted only for this. From Finance Act 2022, and that too from a date which is 1st April 2023. 1st April 2023. This is the amendment. What they have done now is they have also extended the restriction to what? Shares as well. So now any share, that is security, or any units of mutual fund that you buy, how many months before? 3 months before. 3 months before the issue of the record date, the date when which the company issues bonus, 3 months before or 9 months after. They have streamlined it with 94 subsection 7. 94 subsection 7 also told the same thing. 9 months. So 9 months was for only for securities units there. Here it is for both 9 months. 3 months before you buy, 9 months after you have sold. See here, person who buys or acquires any units or securities for a period of 3 months prior to the record date, such person is allotted or entitled additional units of securities bonus without making any additional payment. He sells or transfers partly or fully the original units or securities while continuing to hold all or any of the additional units. What have I done scam here? I have got a short-term capital loss of 10 lakhs while I still continue to hold 1000 shares. While continuing to hold all or any of the additional units within a period of 9 months from the record date, then the loss, if any, arising to him on account of transfer of original units or securities shall be ignored. The loss, when whatever is arising, will be completely ignored, and the amount, but I'll give you one benefit, the amount of loss so ignored shall be deemed to be the cost of acquisition of such additional units. So guys, this generally, what is the cost of acquisition of bonus shares? Nil. But I'll give you some benefit. Instead of taking nil cost of acquisition, take 10 lakhs as the cost of acquisition of 1000 shares. That's it. Benefit is given. But This I will not allow you to set off this. Setting off and all I will not allow. I will not allow you to set off this short-term capital loss against any long-term capital gain. But one benefit I can give you, I can ensure that this loss, whatever you have made, will be taken as cost of acquisition of the additional units and securities balance as at held by him on the date of such transfer. So if I sold, this is assuming I sold 1000 shares here. 1000 I bought, 1000 I sold. What if I purchased 1000? What if I sold 1500 at let's say 25 lakhs? Then here the remaining 15 lakhs is the loss. Remaining shares are 500. So guys, remaining 500 shares, cost of acquisition will be deemed to be 15. Cost of acquisition will be deemed to be 15. What if I purchased 1000 shares and I sold not only that 1000 plus the entire remaining bonus 1000 also. 10 lakhs I purchased, I sold it for, let us say, 28 lakhs. Then, my dear friends, entire set is sold, right? So what is the loss? 18 lakh is the loss. So in this case, 94 subsection 8 will not apply. Concept of bonus stripping for this will not apply because bonus shares are not there only. I am not stripping the bonus of anything. I am not making use of the bonus shares. I have sold the entire bonus share. This is a genuine capital loss. This for this section will not apply. When will section apply? First of all, there should be a loss. Second most important thing, there should be some bonus shares pending. Basically, whatever bonus you got, if you have sold everything, then no problem. But there should be some bonus shares pending, not additional this thing. What do you say? Not original shares, but bonus shares. You see, while continuing to hold all or any of the additional units. What if I don't hold any additional units? Then no problem. Then the section will not get attracted. Why is this important? Because the amendment is from what? Finance Act 2022. That is the amendment. Securities also added. Till now you could have played around with securities. Now not possible. Record date means the date fixed by a company, mutual fund or UTI, business trust or any alternate investment fund for the purpose of entitlement of the holder of units to receive dividend. Dheeraj acquired 10,000 shares of Chota Beam Limited on 250 per share on 23/9. Chota Beam allotted 5,000 bonuses on the record date. All original shares were transferred at 200 rupees. There's a loss. He subsequently transferred 3,000 bonus shares also on 10/2. Remaining 2,000 on 14/4. Within how many months? Yes. Original shares were acquired within 3 months. Original shares were sold within 9 months. In this case, loss on sale of original units shall be ignored and it will become the cost of acquisition of bonus shares held by. Record date is 15/11/2022 and I've sold the original shares when within 9 months. I've sold it within 9 months. You see, even till the year end, I have sold it. So you see here, for example, computation of capital gain, consideration received is so in 200, law cost of acquisition is 250, short term capital is 5 lakh. This 5 lakh is deemed to be the cost of acquisition of the remaining units. It cannot be set off or carried forward. It has cost of acquisition of the remaining, that is 5,000 bonus shares. However, I sold the bonus shares also. How much will it be? See, cost of acquisition, I will take it as 5 lakh. 3,000 into 150 rupees is what I sold. So here I will take it as cost of acquisition 3,000 by 5,000. Overall 1,50,000. Remaining next year 2,000 I sold. Again 5,000 is the 5 lakh is the cost of acquisition into 2,000 shares by 5,000 shares. But as I told you guys, because on 10/1/2023 while continuing to hold all or any of the additional units, mind you, while continuing to hold all or any of the additional units. What if on 10/1/2023 only I had sold all the units, that is 10,000 shares plus 5,000 bonus shares. Full 15,000 if I sold, will this section attract? That is this point. If Dheeraj had transferred all original shares and 3,000 bonus together, 3,000 bonus together. So here, if Dheeraj had transferred all the shares, original bonus together on 10/1/2023, 94.8 will not apply. But what if I had sold only 3,000 out of 5,000? Then the same thing, the loss of 5 lakh will be the cost of acquisition for the remaining shares, 2,000 shares. So what would be the capital gain for the 2,000 shares? 2 lakh into 90 rupees minus 5 lakh. Very simple. In this example, I told you all if I have sold, then no tension. That's all. So this completes 2 marks MCQ. They can ask you bonus stripping, bond washing, interest stripping. Now let us get back to the chapter 6A, guys. Chapter 6A. Payment based deductions. Come to page H1, H2, H2. Yes, guys, come to H2. Payment based deductions, ATC. Now, why are we doing this? Because when we do section 91 in international taxation, there they'll give non-resident fellow invested in is paying interest on loan for buying house property or has taken a life insurance policy, etc. Like that adjustments they'll ask, correct? So predominantly the basic adjustments will come in CA Inter, but these extra adjustments, heavy duty the adjustments will come in CA Final. So we will only concentrate on those adjustments. So ATC, what is it? Reduction in respect of life insurance premium, contribution to PF, etc. is one of the most basic exemptions, deductions that you will be getting. ATC. Eligible SSA is what? Individual or HUF. Maximum amount of reduction, as you know, my dear friends, if you have made the payment to this extent, you will get 1,50,000 worth of deductions. What are the investments, eligible investments? Life insurance premium. Actual amount paid towards premium on life insurance policy. Actual amount paid, not payable. Actual amount paid. You should have made the payment during the year. Who are the specified persons? It will include for individual, self, spouse, and children. For HUF, any member. Spouse means, sir, step spouse and all covered, sir. Some people have 2-2-3-3. In one area, one people they would have maintained 8. There is only actual legal spouse and children. And for HUF, any member will be covered. Life insurance premium, the restriction on deduction will be this itself. If policy issued before 1/4/2012, then entire policy premium paid or 20% of the sum assured, whichever is less. If it is on person with severe disability, but if it's a normal person, same 20%, whichever is less. Policy during financial year 2012 or 13, it is 10%. Anyway, for us relevant stuff is this, guys. If policy issued on or after 1st April 2013, premium paid or 10% of sum assured, whichever is less, is what the amount which is what? Actual amount paid that is allowed. Premium paid or 10% of the sum assured, whichever is less. The sum assured is 1 crore, 10% is 1 lakh, and you are paying 80,000. So 80,000 or 1 lakh, whichever is less. If you are paying premium 1 lakh 10,000 and your sum assured is 1 crore, that much nobody will pay. I'm just saying. And in that case, 10%, 1 lakh or 1 lakh 10,000, whichever is less, so 1 lakh. So, but for severe disability, I'll give you some benefit, 15%. And my dear friends, of course, in 1010D also, linked to this is 1010D. Any income, any sum received from these policies on the death of the insured also will not be taxable. So, on death, sum received, not taxable. Except, however, Keyman insurance policy. This is an additional point. In Keyman insurance policy, if I pay premium, then of course that premium etc. will be allowed to you in business. We have seen that. But what about the amount received on death of the keyman? In that case, any amount received will definitely be taxable. That also we have seen in PGBP. Contribution towards deferred annuity plan of LIC, contribution towards ULIP of UTI, LIC, etc. All these things. Life insurance policy, if the SSC terminates his contract of life insurance policy or fails to pay premium of 2 years or unit linked policy for 5 years, no deduction shall be allowed in respect of the premium paid in the year of termination. That year he will not be getting. Also, the deduction allowed in the preceding previous year shall be deemed to be the income of the SSC for the previous year in which the insurance policy is terminated. So, previous year also will be added. These other funds you would have studied in Inter, you can just go through. RPF, you know, approved, we have seen this. Sukanya Samriddhi account scheme, notified savings, and NSC, notified units of mutual fund, and all those things. Term deposit for a period of not less than 5 years with a scheduled bank. That is also there, any term deposit, but this should not be pledged as a security. Then bonds issued by NABARD, National Bank for Agriculture and Rural Development, that also will be there. Deposit in senior citizen savings scheme. Amount withdrawn from post office time deposit scheme or in senior citizen savings scheme before the expiry of 5 years shall be liable to tax. Where a legal heir or nominee receives such sum on the demise of the SSC, as I told you, same shall not be subject to tax. Again, housing, this can be one more important area. Repayment of any loan borrowed from financial institution or bank for the purpose of purchase or construction of residential house property, not commercial house property, residential house property. Deduction in respect of any expenditure incurred towards stamp duty, registration fee, and other charges, etc. is also available. Deduction is not eligible in respect of payment made toward costs towards any addition, alteration, or renovation or repair. No, it's only for construction, minor renovation, repair, etc. You will not get any deduction on repayment of any loan. Any expenditure in respect of deduction is allowable under section 24 of house property. Property under construction you will not get. Only after it's constructed, so you will get that pre-construction interest also, which you would have seen in house property. Principal repayment on loan borrowed for acquiring commercial property is not eligible for deduction. Similarly, residential property under construction for which principal has been repaid also does not qualify for deduction. It's only after construction. Repayment of loan borrowed for housing from relatives, friends, non-specified employees are not eligible for deduction. Interest paid will be deducted anyway under section 24. If the SC transfer the house property before 5 years from the end of the financial year in which possession was obtained, and all deductions allowed will be deemed to be income of the SSC, that we have seen. Tuition fee is there, then others. Tuition fee for full-time education respect of 2 children and other things. Contribution to this PPF, etc. Guys, I am reading it like some what you would have probably seen on other YouTube videos where people read and go. I'm reading like that only because all that we have covered in CA Inter. And moreover, these things will not come. What will come in this, I'll tell you. As I told you, what may be will be important is this: life insurance and housing. And that too, not from a normal point of view. They'll ask non-resident taxation. I am just doing this now so that when we reach non-resident taxation, I will connect it there. That time I'll ask you questions, then you will be able to answer in a better way. Okay. Yes. So let's see the other important ones. 80CCC, reduction in respect of contribution made to certain pension funds. Who is the eligible SSC? An individual. What are the eligible investments? Contribution made to any annuity plan of only 2. One is LIC of India and any other insurer approved by the IRDA. So it covers almost everything, because without IRDA's approval, you anyway cannot run any insurance company. What is the amount of reduction here under 80CCC? 1,50,000. There is any annuity plan thing. Where the SSC or his nominee surrenders the annuity before his maturity, surrender value including bonus interest shall be taxable in the year of receipt. So till maturity you cannot surrender. Amount qualifying for reduction under this section shall not be eligible for reduction under ATC, because it's a different section. annuity plan, ADCCC. ATCCD we will combine with other sections and do it right now. That will be the last part of the discussion. Others will finish it off. This will discuss, guys. CCD. So it's cover everything is I've made it here. That will be easy for you. We'll come to that. Health insurance premium, ATD. Eligible SSC, individual or Hindu undivided family. Eligible expenditure, medical insurance premium, central government health scheme, preventive health checkup, and medical treatment for specified persons. Who are the specified persons, guys? For individual, mind you, it is self, spouse, dependent children, parents, whether dependent or independent, mind you. And for HUF, any member. It should be dependent children only, dependent financially to the with the parent, for the money, for their money, financial dependency on the parents. So these are the things which are eligible. One is Mediclaim insurance premium, contribution to the central government health scheme, notified scheme, preventive health checkup payment, maximum 5,000 rupees, aggregate for what? Self, spouse, dependent children and parents, and general deductions. Overall, guys, these three are eligible. CGHS for parents, individual paying for the parents, it is not eligible. And for HF only, this medical insurance is eligible, not other things. What are the general deductions? 25,000 each. On the other hand, if your parent is a senior citizen, if your parent is 58 years of age, then obviously you will not get any additional deduction. Maximum deduction you will get is 25,000. For example, Prithvi Shaw, he is around 23, 24 now. He is paying for his father 58 years. So for him, how much will it come? 25,000 is a general deduction. What all will come? Mediclaim insurance, contribution to CGHS, and they do some health checkup. Health checkup, he will spend some 5,000 rupees for his dad. Will it be covered? Yes. But if you are giving to a resident senior citizen, mind you guys, this is where they'll play around in section 91 international taxation. They will say a person paid 5,000 rupees for his 62-year-old father who is residing in United States of America. Will this extra 25,000 come? No. This is where we need to be alert. This is important. Mediclaim, if it is taken by whom? Resident senior citizen, additional deduction of 25,000. You have taken a Mediclaim insurance and you have paid this amount. For you 25,000, your parents 25,000. Will it 50,000 be allowed? Yes. Here also allowed, here also allowed. In all the three cases, it will be allowed. Medical expenditure on the health of a senior citizen if Mediclaim insurance is not paid on such senior citizen. In all the three cases, it's available. Overall amount of reduction is 50K. Medical expenditure, guys. If Mediclaim insurance is not taken, extra expense you have to give, no? If it is not paid, extra. If insurance is not paid, but extra you have to pay. Those out-of-pocket expenses, extra expenses. See, for example, in the Mediclaim, only 3,000 rupees. For example, only bed worth 3,000 is taken. But you have, what do you say? Admitted him in a super luxury hospital where the bed is 8,000 rupees per day. So 5,000 rupees extra you have to pay, right? So up to that additional deduction of, amount of reduction 50,000. But mind you, this 50 plus 50 overall maximum 50 only you will get. This is all up to 50K. So overall deduction you will only get up to 50,000. That's all it is. Some interesting things. Deduction of medical insurance allowed for parents will be allowed even if parents are not dependent. We have discussed. The concerned parent is entitled to separate deduction in respect of amount of premium independently paid by them also. This is children paying for the parents. Apart from that, they themselves can pay separately. That is covered for them. So there is double benefit. Payment for the above expenditure to be made in any other mode other than cash. Cash payment if you go wrong, over. No deduction if you pay cash. But one extra thing is there. Only payment towards health checkup can be made in cash. This one. Only this can be made in cash. Nothing else, guys. Only health checkup. Important. So there was a problem when I used to pay, for example, this policybazaar.com. I remember when I got COVID, I had some stupid health insurance policy and the hospital bill for 6 days for some 3,75,000. Yes, I had my insurance covered only some like bloody 60,000 or something. Remaining, whatever I had saved up money, I had to pay from that. And in the first thing that I did after coming out of the hospital was to go for a 2 crore health policy. No, not 2 crore, 1.5 crore or something. But today, if anything happens, 1.5 crore, up to 1.5 crore, it's covered. So even if the payment is high, yes, the insurance, the premium only was, if I'm not wrong, around some 80, 90, 1 lakh rupees per annum is the premium. I took a 3-year premium policy. So 3 lakhs, instead of 3 lakhs, they gave it to me at 2,80,000, 20,000 rupees discount. Now, if I pay 2,80,000 for 3 years, can I claim 2,80,000 this year? No. Should I take it proportionately? The Bear Act was unclear. So Arun Jaitley, before of course his passing away in his last budget, he did all important things and he unfortunately passed away. This was an amendment brought in by Arun Jaitley ji. He said if you have paid your premium in lump sum for more than 1 year, reduction shall be allowed in each such year in which the insurance shall have effect or be in force. So you can take it yearly. So see the example, it's important. An individual paid premium in lump sum towards health insurance amounting to 1 lakh on 1/8/2022. Insurance policy shall expire on 37/7/2027. So guys, from the day you pay till the expiry, 6 years in this example, you will get every year 16,667 depending on the duration. Person with disability, you will get for again resident individual or resident HF, not for non-resident. If they ask you, the SSE is living abroad, for him and he is paying for a person with disability in India, not allowed, because it's only for resident individual. Any expenditure incurred for the medical treatment, training and rehabilitation of a dependent person with disability, amount paid or deposited in a scheme framed by LIC or insurer or approved institution. How much, guys? 75,000 with disability, 1,25,000 with severe disability. Flat deduction this is. This is a flat amount. Flat deduction. This is irrespective of any amount. Any amount deposited. It's a flat deduction of so much. Dependent means for individual what? Self, spouse, children, parents, siblings, for HUF any member. SSE must nominate either a dependent with disability or a trust or any other person to receive the payment. If the disabled dependent dies before the SSE, amount deposited or paid shall be deemed to be the income of the SSE in the previous year, and the amount is received. Yes, if the dependent only dies. The SSE claiming a reduction under section shall furnish a copy of the certificate issued by the medical authority along with the return of income saying that this is the person with disability. An annuity or lump sum will be paid with disability in case of death of the SSE or the dual condition of SSE attaining 60 years of age and payment to such scheme has been discontinued. Guys, these are all amendments. Point number 2 and 4. If the disabled dependent dies before the SSE. So I have paid for a dependent, he dies before me. Then amount deposited or paid shall be deemed to be the income of the SSE. If you take an insurance, they will pay some lump sum, no, that will be deemed to be my income. On the other hand, an annuity or lump sum will be paid on the person with disability in case of death of the SSE. SSE only dies means either that or dual condition of SSE attaining 60 years and payment to such scheme has been discontinued. Both conditions should happen. Because in the scheme, it will be written that if you turn 60, the scheme will be discontinued. So if SSE attaining 60 and payment to such scheme has been discontinued, amount is received by whom? It shall not be deemed to be the income of the SSE and no tax will be charged. So in two cases, there will be no tax charged. Which are those two cases? This is important, guys. Amendment. In two cases, income will not be charged to tax. First one, the SSE only dies before. SSE only dies before the disabled fellow. Second case, SSE is alive, but he attains 60 years of age, and there's a term in the contract which says once you turn 60, the payment to the scheme will be discontinued. Basically, you are not paying anymore. And since you have, the scheme only is discontinued now because you have stopped paying. Ideally, I have to penalize you, but since you have turned 60, you see, any amount that is received shall not be deemed to be the income of the SSE and no tax will be charged. So, what are the two conditions where no tax will be charged? First one, an annuity or lump sum will be paid to the person with disability in case of what? Death of the SSE, or dual condition of the SSE attaining 60 years of age and payment to such scheme has been discontinued. So that lump sum, that whoever receives it, that will be tax free. That will be tax free. These two are additional things. Disability means blindness, low vision, leprosy cured, hearing impairment, etc. Person with disability means 40% or more of the disabilities. Person with severe disability means 80% or more of the disability. Yes. So guys, now let's go into this new pension scheme, ATCCD. This one is ATCCD. Let's make one nice chart whereby all the things are given. This is the new pension scheme. New pension scheme master chart. Important. That's why I told you, wherever I feel that my contribution is required, I'll give. Other things you are just reading and telling the overall things. That's enough. Because simply bringing around inter-syllabus and again repeating it doesn't make any sense. So wherever in final adjustments will come, I'm gonna do that like this. We are gonna do it like this. So guys, earlier this new pension scheme, right? Generally your PPF scheme is always the EEE concept. That exempt at the time of investment and exempt returns as well and exempt at the time of maturity. Whereas the new pension scheme was always exempt taxable. Means exempt at the time of investment, exempt income, whereas taxable at the time of maturity. That's why nobody used to invest in NPS. But Arun Jaitley again removed many restrictions and then ensured that you will also get a lot of exemption. So basically from EET it almost became EE only, but with many, it's not, I'm not saying it's not at all taxable, but restrictions are removed. So based on that logic, let us just check a few areas. So the first section is 10 clause 44. 10 clause 44. They say income of new pension scheme trust. Income from new pension scheme trust is exempt from taxation. So any income you will get would be exempt. Then we have 1012A. 1012A, which says that if you close the account, closure of account. But then again, if I again divide it into two parts, closure of account if the person SSE is alive. One more is closure on death. If it is closure on death, not taxable to the nominee. Not taxable in nominee's hands. Whereas if the SSC is alive, 40% is exempt. 60% is taxable. 40% exempt, 60% taxable. You just study this and go, more than sufficient. I am combining all sections, that's why it's a master chart. Then if I see 1012B, this 1012A, mind you, this is for either a central government employee or any employee, guys. So this is anybody also, or not just any employee, anybody who wants to go into NPS. It is for employee as well as non-employee. So can others also invest in NPS? Those who are into business also, can they do it? Those who are having other income also, can they do? Yes. Whereas this 1012B on the other hand, this is only for employee, nobody else. Only for employee. So this is partial withdrawal. Partial withdrawal. So any payment where you have withdrawn partially, 25% of the overall contribution is exempt. 25% of the overall contribution is exempt. 25% of the overall contribution would be exempt. For example, and where will you do the contribution, guys? Contribution will be done in 80 CCD. So, for example, the scheme till date, you have contribution you have made under 80 CCD, let's say, is around 5 lakh rupees. Partial withdrawal will make partial withdrawal of 2 lakh rupees. So what is exempt, guys? Exempt is 25% of 5 lakh, which comes up to 1,25,000. This is exempt. How much is taxable? 2 lakh minus 1.25 lakh. 75,000 would be taxable in the new pension scheme. Right? Amount received on maturity. Amount received by individual or nominee on maturity is definitely taxable, but as I told you, there are certain different exemptions sort of a thing that they have given. But if annuity plan is purchased the same year, if annuity plan is purchased the same year, you buy an annuity plan immediately, then it is not taxable. So I am giving you benefits that was okay, you withdraw, it's matured, but immediately invest somewhere. This is to again ensure that you keep on investing, then it is not taxable. Apart from that, two other things. 1013B. This is only for employee. Only for employee. Transfer from approved superannuation fund. So you will get some money from superannuation fund. And if you transfer that money from approved superannuation fund to NPS, approved superannuation fund to NPS, then what? It will be, what do you say, exempt or not exempt? So just for transferring, etc., guys, it will be exempt. There will be not taxable. It will be 100% exempt. Then last but not the least, guys, with this basics, now we'll have to come to ATCCD. So if you just see, this is what we did. Finally, ATCCD. ATCCD. All leads up to this only, ATCCD. Now, ATCCD, it depends, are you an employee or you are a non-employee? For non-employee, very, very simple, guys. You will get 1,50,000. 1,50,000. Ceiling 1,50,000 along with ATC. It is along with section ATC. Apart from that, you will also get an additional 50,000 rupees deduction. Additional 50,000 rupees deduction for any amount deposited by him in the National Pension Scheme. Apart from that, you will be, the ceiling limit would be 20% of gross total income of that person. 20% of the gross total income of that person. An overall limit of 1,50,000, which is along with his ATC deduction, an additional 50,000. As far as employee is concerned, whether employee's contribution will come or employer's contribution. Employee's contribution or employer's contribution is what we need to see. Employee's contribution, it is 10% of salary. 10% of salary. Basic plus DA and other allowances, if it forms part of the contract, it is allowed. 10% of the salary. 1,50,000 rupees is the ceiling along with ATC. Along with ATC. And of course, guys, you will get additional 50,000 rupees. Employer's contribution, my dear friends, employer's contribution. Employer's contribution, it is taken as employee salary. It's taken as part of employee salary. And again, 10% of salary is what is given a deduction here. Only for central government employee. For central government employee, it is CG employee. Non-CG employee, CG. For CG employee, it is extra 14% is taken. 14% of salary is taken as far the employer's contribution is concerned. But This most important here is, it is what? Not subject to. This is not subject to. Contribution, I mean, this is entire thing is not subject to rupees 1,50,000 ceiling. Not subject to 1,50,000 ceiling. It is over and above that. It is not subject to that ceiling limit. It is not subject to that ceiling limit. So this is extra you're gonna get. ATCCD. Check out here. Eligible SSE and individual eligible investment. I am reading, guys, page number H4. Contribution to pension scheme notified by the CG. Eligible deduction for contribution ATCCD1. In case of individual employed by central government or other employer, salaried employee, employer's contribution are 10%. In case of any other SC being an individual, 10% of GTI. We have seen all that. Basic plus DA if the terms of employment so provide. So rather than other allowances, you can just make it basic plus DA. So basic plus DA if allowed. 1 second. Basic plus DA if allowed. Additional deduction of 50,000. This additional deduction is allowed irrespective of whether deduction is allowed under ATCCD1 or not. No additional deduction shall be allowed in respect of amount already claimed under ATCCD1. Yes. The employee contribution of 1,60,000 and his salary was within the meaning of ATCCD1 was 10 lakhs. Deduction eligible under ATCCD1 is employee contribution or 10% of salary, whichever is less. 1,60,000 or 1 lakh, whichever is less. So 1 lakh. Employee can claim deduction 1 lakh under ATCCD1 and remaining deduction of 60,000 can be claimed under ATCCD1B, but up to maximum of 50,000 rupees. Maximum of 50,000 rupees. Deduction towards employer's contribution, as I told you, for central government employer it is 14% of salary, or any other employer it is 10% of salary. Employer's contribution to pension scheme shall be chargeable as salary. It should be taken as employee salary, as I told you. Amount qualifying of deduction will not be eligible for deduction under section ATC. It is extra, separate. So all that we have discussed already. This entire thing, refer the chart. Refer the chart. So ATC 1,50,000, ATCCC 1,50,000, CCD 10%, other employee 20%. But guys, ATCCD says, CCE says, sorry, everything put together overall 1,50,000. But ATCCD1B, that 50,000 rupees is extra. ATCCD1 and of course CCD2 we have already seen. 14% and 10% is the limit on sections ATC, CCC and CCD. Very, very simple. So this is done. So guys, moving on, and ATD done. DD done. Specific ailments. There are certain other ailments. Similarly, for 60 years or above, 1 lakh rupees. Others, 40 years. Other ailments. Loan for higher education. ATE, you will get interest on loan for pursuing higher education. These are all CA inter, guys. In final, generally they will not give, but it's a, they can just go through this. Simple. Interest amount for a period of 8 consecutive years, starting from the year in which the SSC starts paying interest, will be given here. Yes, you see ATE. Remember in the ATIA section, for builders, there was, for a residential property which is value is, stamp duty value is around 45 to 50 lakhs. There were benefits given for builders. But what about the buyers? What about the customers? So for customers and buyers, allottees, this section is there. Interest on loan taken for residential property. This one, certain house property, EEA. This one, EEA. ATEEA is for such people. Whereas normal home loan, ATEE. Residential house property, ATEE. But for those, lower middle class residences where stamp duty value doesn't exceed 45 lakhs, as we have seen in ATIA, ATEEA will come into the picture. ATE is CA inter, sorry, ATEE is CA inter, Whereas CA final, you may also get 80 EEA. But this also will just go through. Eligible SSC will be what? Individual. Amount of reduction maximum 50,000. This is for normal house. It can be stamp duty value 1 crore also, doesn't matter. Conditions for applicability. SSC has taken a loan for the purpose of acquiring residential property from any financial institution. SSC does not own any residential property on the date of sanction of the loan. No other residential property you should own. Value of the residential property should not exceed rupees 50 lakh. Amount of loan sanctioned for the acquisition of residential property does not exceed 35 lakh. The value should be 50 lakh and amount of loan does not exceed 35 lakh. The loan has been sanctioned by the financial institution from a period during from which one? 1/4/16 to 31/3/70. So that is no longer there now. Deduction shall not be allowed in any other provision of the section. So this is one. But what is more relevant than this? I told you 1 crore etc. Can it be there? It cannot come under this section. If the house property value is 1 crore etc. it will not come under this section. This section is almost like replaced by this one 80 EEA. Now this is important for CA final. You should not be eligible to claim under 80 EE. Maximum deduction is 1,50,000. The SSC should have taken a loan from bank, banking institution or housing finance company. Yes. This is from 1/4/2019 to 31/3/22. This will be more important for us. Very important for us. Stamp duty value of such residential property does not exceed 45 lakhs. The SSC does not own any other residential property. Interest is payable by the SSC. A reduction under this section is allowed for any interest. Deduction shall not be allowed in respect of any other's provision. Combined notes EEA. It is deduction of other in addition to, mind you. Guys, under house property, normally we can claim interest 24B. Interest on loan borrowed for the purpose of construction of house property. So Mr. X has a SOP for which loan was borrowed as with the condition of 80. Interest paid was 2,30,000. 2 lakh he can claim there, but 30,000 he can claim here because it doesn't. It says where deduction is again allowed for any other interest shall not be allowed in respect of such interest and any other provision of Income Tax Act, but of course subject to 24. Deduction will be available whether the residential, and mind you here, no deduction will be allowed. But this will not cover standard deduction at 24. That especially more than standard deduction, I would say 2 lakh loan deduction. Deduction would be available whether the residential property is vacant, self-occupied, I don't care. Benefit of interest should be available till the repayment of the loan. So EE is not too relevant now. EEA will come into the picture. And for loan value 1 crore, 2 crore, house property value 1 crore, 2 crore, anyway we have section 24. This is an additional benefit to ensure housing. This is predominantly one of the sections introduced by BJP for affordable housing schemes under the affordable housing scheme. 80 EEB, electric vehicles. 80 EEB. Guys, if I buy an electric vehicle in the name of my business, anyway depreciation I can claim, anyway interest on that. If I take a loan on that buying the vehicle, I can claim interest. Then why do I need special deduction? So if you read the section, you will come to know that this would be for predominantly salaried class, not for businessmen. Businessmen anyway can take cover under the respective section that we know. That is, your basic 30 to 36 you can claim, 37 if not. Eligible SSC individual, amount of deduction maximum 1,50,000. Conditions for applicability, yes, taken a loan for purchasing electric vehicle during 1/4/19 to 31/3/23. 1,50,000. This is deduction on for what? Repayment of interest. Such loan should have been sanctioned by banking company. Interest is payable. Where interest is allowed as a reduction, no other reduction. That's a common point. Electric vehicles means a vehicle which is powered exclusively by an electric motor whose traction energy is supposedly exclusively by traction battery, blah, blah, blah. Guys, basically, it means a vehicle. Vehicle means what? Two-wheeler also covered? Yes. You can buy a two-wheeler also on loan. And the interest that you pay, you will get a deduction. For the entire period of the loan, there is no restriction on the cost of the electric vehicle. Does not matter if the car or the vehicle is used for personal or official purposes. If interest is availed as deduction under this section, the same shall not be capitalized as part of the actual cost for the purpose of availing depreciation. So, because that's what I'm saying, it is not For depreciation, it is not covered, which means this is predominantly for salaried class. Business class will anyway take the deduction, full deduction there. ATG, it is your charitable organizations, etc. This you already know, guys. In CA Inter, though, you study this really well, so you leave that. The Swachh Bharat Kosh Clean Ganga Fund, we have seen that very clearly in CSR. So I'm not going to do all this. You can go through. ATGG. ATGG. This is reduction in respect of rent paid. This is for people who do not get HRA. So eligible individual, rent paid is allowable as a deduction to the extent of least of the following: actual rent, or 10% of the minus 10% of the adjusted total income, 25% of the adjusted total income, or 5,000 rupees per month. Least of the following calculation you have to do. Adjusted total income for the purpose means gross total income as reduced by deductions, LTCG, STCG, income from lottery, specified income of non-resident, and other sum, share of AOP, BOA, everything you should subtract. This should be a self-employed person or a salaried employee who is not in receipt of HRA. SSC should pay rent for the residential accommodation, and accommodation should be occupied for the purpose of his own residence. SSC, his spouse, minor child, HUF, who is a member, should not own any other residential accommodation, including minor child, at that place where he ordinarily resides. Should not own any other self-occupied property also in any other place. Basically, it is for giving benefit for those people. This only if they ask also, only in MCQ they can ask, guys. Otherwise, you leave it. Only in MCQ they can ask for 2 marks, if at all they ask. Otherwise, I don't see any question being asked. I hate doing these chapters because I have to go fast. And there is no value addition from my side. Horrible. I hate it. But what to do? Correct. I am also seeing, I am chumma reading, like on shit I am teaching, I also know. Because these are useless provisions. I don't want to waste time on this. I can teach each of these for 2 hours. History when it came, geography, science, social studies, everything. But guys, there's no point. Wherever I have paused and I have given you examples, go through that. Master chart of that new pension scheme, go through that. Barring that, guys, it's a huge subject, guys. Cannot sit and study, I mean, everything in depth. Sit and study everything, but not everything in depth. I hate doing such chapters because I cannot go in depth. It is my problem. I want to go in depth, but it is not needed for exam. Everything we cannot go in depth. I am feeling ashamed teaching this. Not because of the chapter, it's because I cannot go in depth and teach. That's why. So I am reading like one chaprasi fellow, but what to do? This chapter only is like that. Read. Nothing can be done. Who will remember all this, guys? Actual rent minus 10%, 25%. In 10 days, you ask me, I'll also, I don't know, like this, I will scratch my head. I don't know how you will remember. God bless you. Namaskaram. Yes, thankfully I passed. I cannot remember all this bullshit again. Horrible, guys. Like, who will sit and you ask any chartered accountant, I can assure you, sir, can you please tell me the limit of ATGG? ATGG section is also there. ATG was there in the syllabus. ATGG is also there. Nobody will know also this one. Anyway, horrible sections. I don't know why they'll keep all this. Anyway, come guys. Deduction in respect of, we'll finish off. I'm feeling irritated seeing this. Appa, thankfully 3 more sections over. But yeah, it is there. We will see. No, but we also have in non-resident taxation, we will add those ATTTA, TTB and all that. Again, we will see that in a different way. GGA, GGB, GEC. GGA is for donations for scientific research and rural development. ATGGA. All SSCs except those having income chargeable under the head profits and gains of business. Amount of reduction 100% of the donations you will get. To approved research organization, institutions, university, college whose object is undertaking. Yes. So guys, for those who are undergoing this, who are profit and gains of business, they have 35(1). We have 35, 35(2)(ab), all those sections. We have, this is for others. If I am an individual, I'm a salaried person, I want to invest in Tata Memorial, then Tata Cancer Research, yes, then I will get deduction 100% of the donation. The only important thing here is no deduction shall be in respect of donation exceeding 2000 paid in cash. Up to 2000 only we can pay in cash. And deduction cannot be merely denied if approval granted is withdrawn. It's an approved institution, but at the time of filing the return, it was not approved. MCQ question. At the time of paying, it was approved. At the time of filing your return, it was not approved. No problem. We'll get deduction. Political parties, the greatest people on earth, Indian company, 100% eligible as a Indian company. So Reliance Space. This 80 GGB already discussed in CSR. 100% of the donation, political contribution, it should be in, not in cash. GGC or any person except Indian company. If you and I want to donate to BJP, Congress and all those people, yes, 100% of the donation. So apart from that, you have 80 TTA and TTB, which you will see in international taxation, which becomes important. 80 TTA in respect of interest and deposits on savings bank account. This is savings bank account. And 80 TTB. This is savings bank account plus FDR interest plus FD interest. This is, mind you, only for resident. Whereas 80 TTA, this will be for resident or non-resident. Resident or non-resident. Check this. TTA. Any individual other than resident, senior citizen or IHF. TTA. Other than resident in 80 TTB. So if you see, TTB is what? Resident, senior citizen. This is any individual other than 80 TTB fellow. If you see, 80 TTB is for resident, senior citizen. TTA is for resident and non-resident other than the TTB fellow. Savings bank income from a bank, actual interest or 10,000, whichever is lower. Time deposit, recurring income, fixed deposit shall not be eligible. Whereas in this case, actual interest 50,000, whichever is lower. Savings bank, recurring deposit, fixed deposits are also eligible for reduction. They will ask for non-resident covered in 80 TTA. Will he be covered? Yes, he will be covered. That will be asked in MCQ. They'll ask. They'll give you scenarios. 63-year-old person living in United States of America is earning savings bank, recurring fixed deposit interest, 40,000 rupees. Exempt or not? No. Why? For them, TTA will come. That's all. Medical authority disability ATU 75,000, severe disability 1,25,000. All that you can go through this. ATP and all we have done. That's all, guys. Very, very simple. Done. So this chapter is also over. So the next class will be starting with an interesting area which can come for 4 to 6 marks, but then it will come in MCQs or it will be linked with total income problems, etc. Capital gains, which will start in the next class. See you. Sorry guys, if you felt bad little bit, I have to go fast because these areas I do not want to waste time. It is a criminal waste of time. Wherever it's important, I have discussed. Other things, it's going to be like that only. Okay. Capital gains and all we have to discuss in depth. Here, these small chutku chapters, if it is not important, I am not going to waste your time. Okay. See you. Mic testing. Hi guys, how are you doing? Yes. So let's begin. So today we will be doing an interesting area of buyback and ESOP taxation. Okay. These are very interesting areas, both buyback and ESOP taxation. So let's get on with it. All right, guys. So buyback, come to page 02. if you remember the previous time we had done liquidation when we did 46.1, 46.2. And then we'll say we'll come back to this later, I told you. Now we are coming back. Please come to O2, right? And yeah, all this intercorporate dividend, all that we previous class we finished, guys. Buyback O2. Guys, buyback of shares is governed by Section 68 of Companies Act, right? Section 68 of Companies Act. So before we go into the tax part of it, let's see, how a company can buy back, what it can do. Many companies have bought back, Infosys, Wipro, TCS, regularly they do buyback shares. Why do they buy back shares? Basically, if they have adequate funds and they have already given dividend, and also the fact that they have invested everywhere and still they have excess funds. So of course they are going to buy back the shares in such a manner that, people will obviously feel that the company is doing so well that even after, so much money also they have the funds with them. So that's how it works. That's why they're buying back the shares. So obviously eventually what will happen is the share prices will go up. So guys, in Companies Act, Section 68 talks about it. In the previous class only we discussed, notwithstanding anything contained in this act, which means what? This section overrides all the other sections. So I told you this section overrides the reduction of capital section also, right? So if you buy back shares, ideally it will be reduction of capital, no? Like for example, I have 1 lakh shares. I bought back 20%. So now it is 80,000 shares. Isn't it reduction of capital? Yes. But Section 68 says it will not amount to reduction of capital. But subject to the provisions of subsection 2, that so company may purchase its own share. Shares here means what? Equity and preference. But it is not preference, because for preference shares, another section is there, 55.2 in Companies Act. 55.2 is redemption of preference shares. So this predominantly is what? Equity shares. Since there is a specific section for preference shares, 55.2 in Companies Act, for equity shares it will be section 68 or other specified securities. From where can I take out? I can take out from free reserves, I can take out from security premium account, or proceeds of issue of any shares or other specified securities. So guys, if I have free reserves with me, free reserves, I can take it out from there, or I can take it out from securities premium account. Securities premium account is like a quasi capital. So if a share is valued at 100 at the premium of 80, 20 rupees is, let's say, the face value and 80 rupees is the premium. So basically it's like you're paying something extra for the shares. That is called as securities premium account, as you know. So I can take it out from my free reserves or from securities premium account, or the proceeds of any of the issue of any shares or other specified securities. I can make a fresh issue of shares, is what they say. Provided that no buyback will be made out of proceeds and early that you leave. So the buyback should be authorized by the Articles of Association. You should pass a special resolution at a general meeting. So before that, of course, since you're buying back shares, you should also pass a board resolution. Then it should be mentioned in the Articles of Association that buyback power is given. Then you should pass a special resolution. Special resolution means 75% majority. Then all those things, 25% of the aggregate capital should be maximum. Ratio of the secured and unsecured debts after buyback should be, maximum 2. This talks about the debt equity ratio. Debt equity ratio must be maximum 2. Then all other shares should be fully paid up. Buyback of shares or other specified securities listed on a recognized stock exchange in accordance with the SEBI regulations. And the buyback in respect of shares or other specified securities other than those specified, all those things must be given. That other things you leave, that's what it is. Now, where can I buy back from? I can buy back from existing shareholders or security holders on a proportionate basis. I can buy from the open market, from the stock market. And we've always been telling, no, stock market, off the market, stock market. Off market transactions means without the market being there. Then by purchasing the securities issued to employees of the company pursuant to a scheme of stock option or sweat equity. So those people who have already got ESOP, stock option or sweat equity, I can buy back from them also. So in this session, we'll be doing both ESOP taxation when you give stock option and when you buy back also. Can you buy back from the same guys to whom you have given ESOP? Yes. Or can you buy back from other people also? Yes. That's what this section says. That's all is there to it. Now, for our income tax purposes, there are two sections. One is 46 capital A. Other one is 115 QA. 46 capital A is one, then 115 QA is the other one. So if you see guys, 46 capital A. Capital gains on purchase by company of its own shares or other specified securities. The same wordings that you saw in section 68 of Companies Act. That's why I take you to Companies Act also, because it becomes easy for you to understand. Where a shareholder or a holder of other specified securities receives any consideration from any company for purchase of its own shares or other specified securities held by such shareholder or holder of other specified securities, then subject to 48, the difference between the cost of acquisition and the value of consideration received by the shareholder or the holder of other specified security shall be deemed to be the capital gains. So the cost of acquisition and the value of consideration received by the shareholder. So whatever the cost of those shares minus the actual value that is received by the shareholder will be the capital gain. Now guys, this was section 46A. If you see specified securities, if you see, it is similar to section 68 of Companies Act. That's what we had seen now. This will be as per the MCA, whatever they prescribed. So guys, earlier, no, this section was there for listed companies. And for unlisted companies, we had 115 QA. See, tax on distributed income for in case of domestic company. Notwithstanding anything contained in any other provisions of the Act, in addition to income tax chargeable in respect of total income of a domestic company, any amount of distributed income by the company on buyback of shares. Now you see here, not being shares listed on a recognized stock exchange was there. So 46A was for listed companies. 115 QA was for unlisted companies. That has been removed when? From Finance Act 2019. Which means from Finance Act 2019, 115 QA also will be there, 46A also will be there. To ensure what will apply, they have made it very clear in the proviso. Provisions of this subsection shall not apply to such buyback of shares, being shares listed in respect of which public announcement has been made on or before 15th July 2019. So guys, even though section 46A has not been deleted, it is still there. But because of this insertion in 115 QA, because of this proviso, section 46A has lost its significance. Yes or no? Yes. That's why if you remember there, I didn't even do it. I just read it. I didn't even actually teach. I just read what is there. Because as of today, though the section has not been deleted, because of another proviso in some random section 115 QA, what has happened to section 46A? It has become redundant. There are many such sections in Income Tax Act where because of this section that has been redundant, that has become redundant. So that's what we need to understand. Right. Let's see. Same if you see, many means purchase of a company by buyback of its own shares with the provisions of any law for the time being in force related to companies, which means Companies Act only, section 68. So if the share issue price is, let's say, 1000 rupees and the company had initially issued it at 300 rupees, so what would be the tax? Tax will be on 700 rupees. Very simple. That's how it works in 115 QA. There is a fixed percentage, 20% plus surcharge, etc. That is the percentage that is given. That's it. Very simple. And this income would be exempt in the hands of the shareholder. Because the company is paying tax, at the hands of the shareholder, it will be exempt. Now, is this deemed dividend? Tell me, is this deemed dividend? No. In the deemed dividend section, we had clearly seen in the exclusion that buyback. Remember guys, deemed dividend. Sir, when you did deemed dividend, sir? I don't remember only. Hey, nonsense fellows, we are done, guys. Come on. Section 222. In that 222, dividend includes ABCDE. Then dividend does not include ABCDE. In that ABCDE, this thing was there. Swami Nityananda Swaha. It's not working. Swami Nityananda also is not able to do anything with this today. Okay. The sun was sleeping. Just like that internet was sleeping because Swami girl was walking. That fellow I told in one of those videos. Today I came 5 minutes late. That's why the sun also came 40 minutes late. Like that one dialogue he had put. Yes. Dividend includes ABCD. Then dividend does not include. There. Any payment made by a company on purchase of its own shares in accordance with this. So basically this is not deemed dividend. So the gist of the story is, my dear friends, gist of the story is what? Buyback. Company will pay tax. Company will pay tax. Very, very simple. At what rate? 20% on distributed income. 20% of distributed income. Plus 12% surcharge. Plus 4% health and education cess. So overall comes up to 23.296%. It is fixed. Company will pay tax undoubtedly. Next, what will happen? Exempt in shareholders' hands 1034 capital A. Distributed income is same, that is given there. Generally the buyback price minus issue price. And not deemed dividend. It is clearly given in the exclusion. It is not deemed dividend. That's the gist of the story, guys. Check it out. So this is 46A, 115QA, both for listed and unlisted. And listed is from 2019. So amount received by the company in respect of issue of share, the share issue price, etc., will be determined as per Rule 40 BB. So the most important thing in this particular thing is nothing but Rule 40 BB. How it works and all you should see. That's it. Come back, guys. Come to this page, page number 0.2. Where a company purchases its own shares or other specified securities, the difference between the cost of acquisition and the value of consideration. Yes, so we have seen here 23.296%. You should remember this part. as referred to in section 1 QA, and then shareholders 1034A. PJ Limited issued 10,000 shares at 110, face value 50. On 14/7/2017. On 25/6/2022, PJ Limited decides to buy back 5,000 of its shares at 500 rupees per share. In this case, how much will it be? 5,000 shares I'm buying. 500 minus 110 issue price into 23.296%. So 4,54,272 capital gain will arise. Shareholders will be exempt from tax in case of a buyback. If the listed shares obviously are held for more than 12 months, then the benefit of indexation is available. In this case, I have not considered it, but yes, benefit of indexation is available. Specified securities include employee stock option also, another securities notified by CG. The company is required to pay tax to the government within 14 days from buyback. Very simple. As per section 115 QB, if the tax is not paid within 14 days, then the company will be required to pay an interest at the rate of 1% per month or part thereof for the expiry of 14 days. As per 115 QC, the company fails to pay the tax, company will be treated as SSE in default, and all the provisions of SSE in default which we had seen will come to this particular case. Very, very simple. Now, this is the thing. 40BB, determination of issue price. Scenarios under which issue price can be determined for the purpose of buyback. So this is important. They can ask you an MCQ and all those things. How will you determine, etc. This can come. First, share issued by a company by way of subscription. So issue price shall be the amount received by the company including securities premium account. So ABC Limited issued shares of face value at 10 at a premium of 80. In this case, what will be the issue price? Obviously, it will be 90 rupees. Including premium, I should do it. So basically, today buyback price was 300. So what will this be? 300 minus 90. Very, very simple. 300 minus 90. And one thing to understand here is, guys, this surcharge, etc. has to be paid even if the company's total income is nil. So I told you, surcharge 12% and 4%. You can write down here only. I'll write here actually. This one. This has to be paid. It is mandatory. It does not depend on total income. Doesn't depend on total income. So if this company has taken some, ATIA deductions and all, it has gone to Northeast and built one hotel, all this, the total income is nil, then and now it's buying back shares, then will surcharge not apply? 100% it will apply. So instead of this, you can just remember 23.296%. Please remember the rate, 23.296%. So come to this. This is sub rule 1. Rule 40 VB 1. I'll write here 1 so that example will be for 1. So for instance, PQRS. For instance, let's take PQRS. P. So the company issued these shares, 10 lakh shares at 10 each. For Q, 10 lakh shares at again 10 each. 10 lakh shares at 10 each. Premium of 20 each. 10 lakh shares at 10 each. Premium of 20 each. Company is buying back how much? 1 lakh shares each at 50 rupees per share. So what will be 115 QA? PQRS. 1 lakh into 50 minus 10 here. 1 lakh into 50 minus 10. 1 lakh into 50 minus 20 plus 10, 30. 1 lakh into 50 minus 30. So it is 40 lakh, 40 lakh, 50 minus 30, 20, 20 lakh, 20 lakh. Overall 1.2 crore. This 1.2 crore into that percentage, 23.296%. Tomorrow, if this is before this buyback, if company reduced 10 rupee share to, let's say, 8 rupees and 5 was bought back, then what should I do? If they reduce the capital, it's possible, no? Face value of 10 each has now become face value of 8 each. Correct? They have reduced the capital. Reduction of capital has happened. Very much possible. Then they have made it 5 rupees was bought back. Then what to do? Will it become here 50 minus 5, 50 minus 5, 50 minus 25, 50 minus 25? Will it become like that? We'll see. We'll see this. So guys, check that next rule, you'll understand. Issue price, see this, sum out of amount received returned by the company prior to buyback. There is a reduction of capital. Then issue price shall be reduced by the amount returned by the company. In the above example, if the company returned 10 rupees prior to buyback, issue price will be 90 minus 10, 80. If the company has paid additional income tax under 1150 on returned amount, then it shall not be reduced. This, I'll give you a better example than this. Same, all these things. 8 rupees it has become, and then 5 rupees we have given. Now, it all depends on one thing, as you know. If reduction of capital has happened, fair enough. What is the distribution that has happened? What is the distribution? Value of shares, they have reduced from 10 rupees to 5 rupees. So what is the distribution? 5 rupees has been distributed. 5 rupees has been distributed into what would be the shares? 4 lakh, correct? 4 lakh. The shares are actually, one second. Sorry guys, 40 lakh I told you, no? 40 lakh. 1, 2, 3, 4. What I am saying is 40 lakh shares were there. 5 rupees cash has been paid. 2 CR. 2 CR. Now I need to see. I have already distributed to shareholders. If reserves and surplus of the company is greater than or equal to 2 crore, then what happens, guys? This will become deemed dividend. If you remember, deemed dividend is always to the extent of the reserves and surplus. So if the company has reserves and surplus greater than or equal to 2 crore, then this entire 2 crore will be deemed dividend under 222D, taxable in the hands of the company. Sorry, in the hands of the shareholder. That is done. And here, capital gain for company would be what? There would be no change. There would be no change. It will be the same. Because the person has already paid the tax, because shareholder has already paid the tax, here I will not subtract that amount. Think about it. If I subtract here, then this will increase. If this will increase, it will result in double taxation. That is not, preferred. So, if taxable in the hands of the shareholder, CG for the company will be same as discussed. I'll put one star. Which star here? This star. Same. No change. But if reserves and surplus are, let's say, nil, if reserves and surplus are nil, then there is no deemed dividend, no tax for shareholder, capital gain for company. So guys, tax has not been collected from shareholder. So don't you think so? These people should pay more tax. Which company should pay more tax? Yes. How will the computation look? It is not taxed only. What is not taxed? Deemed dividend is not taxed. So for PQRS, for P, it will be what? 1 lakh shares, 1 lakh shares, 1 lakh shares, 1 lakh shares into. Initially, a buyback price is 50, but now I will not take it as 10 rupees. I will take it as 5 rupees. Because here I am reducing, the difference will become more. The difference will become more, tax will become more, obviously. So this will become, instead of 40 lakhs, 45 lakhs. Same. This is what? 50 minus, instead of 30, 50 minus 25 it will be. This will become 25 lakh. And this also will become 25 lakh. Overall, how much, guys? 1.4 crore. See? $1.2 crore has increased to 1.4 crore. On this, there will be tax. 23.296%. So the reduction will happen when? When will the reduction happen? What is the thumb rule? If prior to buyback, company had given money to shareholders and it was charged to shareholder as deemed dividend under 222A, B, C, D, E. Then in 115 QA, do not reduce issue price. Do not reduce issue price. But if it was not charged to tax, that is no deemed dividend. under 115 QA need to reduce issue price. This would be the thumb rule. This would be the thumb rule. Very, very simple. Okay, come on, fist pump, come on, guys. Did you understand? Thumbs up, all of you. Great. Easy, easy, easy. Don't do heavy duty stuff. Yeah. Shares issued under ESOP or sweat equity scheme. So issue price shall be the FMV of the issued or amount credited to the share capital including security premium account, whichever is less. The ABC Limited issued sweat equity share of face value 10 at a premium of 80. FMV of such shares on the date of issue was 100. In this case, issue price shall be FMV of the shares 100 or the amount of share capital including security premium 90, whichever is less. So therefore it is 90. So I would have issued whichever is less, I should take FMV or the other one. So in ESOP, what happens? Though we will be doing ESOP taxation next, but just for the thing, ESOP. So obviously it's a stock option plan. So initially they will ask you to, they would give you the option that if you work for 2 more years, then you will be eligible for the shares. And then you can choose either to buy or not to buy at that predetermined rate. If you choose to buy, finally we will allot the shares. So this eligibility, this waiting for 2 years is called vesting period. Eligibility is on the date of vesting and then allotting. FMB will be here also at the date of the option. FMB of the shares, let's say, is 1000 rupees. Here it becomes 1200 rupees. The day of allotment is 1400 rupees. What should I take is the question. So you see, so that will be as per rule 3.8, which we will discuss in ESOP taxation. That you leave. But here coming to that, we are now not talking about taxation of ESOP for them. We are talking about for the company. Let's discuss that. So if an Infosys employee gets an employee stock option plan, let's say he gets it at nil, free he will get, or he will pay, let's say, 100 rupees. The FMB as computed under rule 3, which we will see later. Today only we will see, this class only, 2000. Here also it is 2000. What would be the perquisite? So guys, this will be in the hands of the employee, a perquisite. So here it would be obviously 2000 will be perquisite. Here it is 2000 minus 100, 1900 would be perquisite. So I'll say ESOP slash sweat equity. Because this, when I say nil, this is the sweat equity. Generally, it is for consideration other than cash. So this will be taxed as a perquisite in the hands of the employee. We are not even talking about that. We are talking about what? We are talking about what if these shares are bought back. What if these shares are bought back? What will be the tax on the company? I showed you section 68. That's why I showed you. The buyback can happen from the open market, or it can happen from those where I've already given as ESOP and sweat equity. That's why I showed you, right? So now let us discuss from the company's point of view. Okay, don't get confused. This is what ESOP taxation. This will be handled in ESOP taxation immediately after this session. In this session only, immediately after discussing this concept. Which concept? We are doing rule 40BB, right? Now let us talk about if the company now buys back this ESOP. Like for example, this fellow or sweat equity, this fellow has got 2000 rupees, this fellow had 1900. Let's say they pay 4000 rupees. What would be the, what do you say? Tax is the question. So that's what the difference that FMB, or if you see the FMB or the, here you see share capital including securities premium, whichever is less. Anyway, give an example because little bit a split also has to be made. Check it out. See there, those examples are for one day before the exam. That's why I've given in the book. Everything we can't put in the book, guys, because that book has been designed solely for, 1.5 days before the exam. But everything else will be done in class, as you've been seeing, which will actually give meaning to that book in a much, much larger way, right? So let's say, suppose a company issued ESOP or sweat equity. 10,000 shares to Mr. A at rupees 100 per share, being the face value. Fair market value as on date of exercise of option is 1000 rupees. So what is the perquisite, as I told you, in the hands of the employee? 1000 minus 100. Already discussed the same stuff. 900. 900 into 10,000 shares. 90 lakh rupees. Fair enough. Now, the company, little bit of accounting also will come. Company can pass the entries in two ways. Case number 1, case number 2, accounting entry. One, ESOP expenditure debtor, 90 lakh because this is expenditure. Bank account, 10 lakh because I'm getting this, 10 lakh. 2, share capital account, 10 lakh. 2, share premium account, 90 lakh. The other case, direct bank account, 10 lakh. 2, share capital account, 10 lakh. Direct. Here, I'll write company wants to buyback price 1300. So in this case, guys, it will become what? Share capital and securities premium, both it will be. So distributed income will be what? 1,300 into 10,000 shares minus 1 crore. 1.3 crore minus 1 crore, 30 lakh. So 115 QA will be on 30 lakh. On the other hand, here distributed income will be what? 1,300 into 10k minus 10 lakh. So company will pay what? 115 QA on 1.2 crore. So it should be on what, guys? On FMV? It is 1,000 or 100, whichever is less. So ideally speaking, this is correct. This would be wrong because, first of all, this is what they do for tax planning. Because it's a share capital or security premium account, for tax planning, all this golmaal they used to, they kept doing. Come to this, I'll show you. See, the amount credited to the share capital and share premium account by the company shall be deemed to be the amount received. Shall be deemed to be the amount received. So what the companies used to do now? They used to claim this also as an expense and pay this also at a lesser rate. What they have done now in certain rules, and also this particular thing has been disallowed. Income Tax Act. When you come to ESOP taxation, we will see. The moment that is disallowed, there is no point in adding this entry. It's not an expense, first of all. So if you disallow, they will never pass any of these entries like this. So they will pass this entry only. So what will become easier? This one. 115 QA on 1.2 crore. That's the reason why I have written whichever is less actually, because this tax planning left side should not happen. That is wrong tax planning. Got it, guys? Very simple. Next. Shares issued in the scheme of amalgamation in lieu of the shares of the amalgamating company. Very simple. One company is, you will getting shares in the other company. What would be the same? Maple Limited amalgamated with Thunder Limited. Thunder Limited issued 2 lakh shares to the shareholders of Maple Limited. Maple Limited had issued 50,000 shares of 28 each amounting to 14 lakh. Issue price shall be 7 rupees per share. How? 14 lakh divided by 2 lakh. Because earlier, guys, I had 14 lakh. Now I am getting what? 2 lakh shares. So what would be the share? 7 rupees per share. Simple math. So let's take one more example. Mr. P acquired 10,000 shares of PJ Limited at 20 per share. PJ Limited got amalgamated with KG Limited, and Mr. P is allotted 30k shares at 10 each in KG Limited. KG Limited now buys back 5,000 shares at 15 each. Very simple. So guys, how much did Mr. P invest 10,000 shares into 20? Basically, he had invested 2 lakh. That's all there is to it. How much is he getting from KG Limited? 30,000 shares he is getting. So what would be the actual, value for Mr. P in KG Limited? It would be 6.67 per share. 6.67 per share. Very simple. Now you see. Distributed income, same stuff. 5,000 is buying back at 15 each. Minus what is the issue price? 5,000 shares into 6.7. That's all. This will be the distributed income. Distributed income definition is the same only. Buyback price minus whatever is given. That's the same. That is not changing. Everything else is changing. Simple. Same logic for demerged company. But in demerged company, what do you say? This will come. Shares issued by the resulting company in the scheme of demerger. Amount received by the demerged company for the issue of share into net book value of assets transferred in demerger, net worth of the demerged company before such demerger. For the demerged company, amount received by the demerged company for the issue of shares minus amount determined for the resulting company. See here, you'll understand this. ABCD Limited issued 1000 shares of 600, face value 100. During previous year 2023, D Limited was a resultant company formed after demerger of ABC Limited, now the demerged company. D Limited issued 500 shares of the shareholders of ABC Limited. Total assets transferred during demerger were 100 crore. The net worth of the demerged company prior to demerger is 400 crore. In this case, issue price for the resultant company shall be what? 1000 shares into 600. What was there before? Into what? How much of the net book value was transferred in demerger? 100. Correct? 100 crore. Out of 400 crore was transferred. This was the overall share value. This was the, basically 1/4 of the company is transferred. So what would be the issue price of the resultant company? Obviously, overall value of the company into what part of value that was transferred. That is this much. So now issue price per share will be what? It purely depends on how much shares were issued. 500 shares were issued in the demerger. So 1,50,000 by 500, 300 rupees per share would be the basic issue price. What is the issue price for the demerged company? Overall 6 lakh was there, in which resulting company took over 1,50,000. So the demerged company 4,50,000 is allowed. And what is the issue price for the demerged company per share? Same, 4,50,000 by what is the shares which were there before? 1,000. So it is 450 per share. Very, very simple. Value of the resulting company is 1. Value of this company is 1. So wherever I am receiving, that person should do the same thing. This we will also discuss when we do demerger. Separate chapter is there. You will understand there this calculation again. So it's very simple. So if you see, share issued by the resulting company in the scheme of demerger, for the resulting company is what? For the demerged company is what? In this, the resulting company is D Limited and the demerged company is ABC Limited. So first I have to compute issue price of the resultant company. Overall shares 1000 into 400, 600, sorry, the market value. In that, how much part is demerged? 1/4. 100 by 400, 1/4. So 1,50,000 is demerged. That is the resultant company. What is left in ABC? What is left in ABC? Obviously, overall value 6 lakh minus the demerged portion 1,50,000. So 4,50,000 is left. So what is the issue price for the demerged company? 4,50,000 by 1,000. What about issue price for a resulting company? 1,50,000 by 500. Very, very simple. Very, very simple. Bonus shares issue price will be nil. Guys, this has become fully redundant actually. Point number 6 not needed, redundant. 7 redundant, useless it is. 8 done. 9 redundant. 10 will do. Shares are brought back which were held in dematerialized form and the same cannot be distinctly identified. We have discussed it should be based on FIFO. ABC Limited issued 100 shares at 50 on 10/4/22, 200 shares at 55 on 15/4/22, and 300 shares at 60 on 24/22. ABC Limited decides to buy back 500 shares. In this, issue price per share will be determined by FIFO method. How? In this 500 shares, first one I will buy. How much? 100 at 50. Next, 200 at 55. Then I need only 200 now. 200 out of 300. So 200 into 60. Issue price shall be the face value of the shares. Alright guys, please come to D18. Please come to D18, income from units. It's a very small thing, we'll finish it off, income from units. Very easy. So similar to dividend, any income received in respect of. So what used to happen was, one second. Income from units. So prior to 2020, income earned by mutual funds or income earned by unit holders. Income earned by mutual fund was taxable at the rates under 115R, whereas by unit holders were exempt under 1035. So income earned by these mutual fund houses, etc., is taxable for them under 115R. So after 2020, Finance Act 2020 brought about this change. They said, now let us change the entire deal and let us make it chargeable to whom? To the shareholders, the unit holders. So after that, after 2020, units, that is the income earned by mutual fund houses is now exempt under 1023D, new section. Just like dividend, guys, is also changed. Then by unit holders, it was taxable at applicable rates. Taxable at applicable rates. Unit Trust of India, UTI, after the Ketan Parekh scam. Ketan Parekh, he was a, what do you say, protege. Protege means is, what do you say, Shishya. Shishya of whom? Harshad Mehta. Ketan Parekh scam in 2002. So this Unit Trust of India lost lot of money, guys. So Unit Trust of India Transfer of Undertaking and Repeal Act was formed in 2002. Unit Trust of India Transfer of Undertaking and Repeal. So UTI was repealed and this law came into force. And UTI became two parts. One was a specified company. One more was administrative company. Administration. UTI administration had all the children's scheme. All the children's scheme went to that. All the children's scheme went to that. Now, how much income, what do you say? How much expenses can I claim? And all these income from units, etc. for unit holder. After this one. This will be taxed where? Under IFOS. That is why this chapter here, IFOS. Mutual fund, specified company means what? UTI. Then administrator, UTI. Shall be chargeable in the hand of the unit holder under the head other sources. Reduction in respect of dividend or income from units. From the amount of dividend and income from mutual fund, no deduction for any expenses shall be allowed except for interest expense. Such reduction for interest expense shall not exceed 20% of the amount of dividend income from the mutual fund. Mr. A received dividend from ABC amounting to 20 lakhs on 28/3/2022. He has borrowed sum of 1 crore. So now we'll come to that. You have borrowed money for that. So will you get interest? So guys, all that is given in section 57, right? So expenses. Investment of units of, one is mutual funds, one is specified company. One more is what? Administration. So what expenses are allowed under section 57? For mutual funds, 20% of, you have hired some person to write the, you are giving salary to him, he will handle all your investments. Will that be covered? So I'll make it into two things. Interest expense, other expense. Interest expense, other expense. Similarly, administration, interest expense, other expense. How much will the interest expense be? How much is allowed? Is other expense allowed? I've already shown you. Let's see again. Section 57. Here you go. Section 57. In that, all these things, dividend, interest on securities, family pension, other expenditure, all this there you see, proviso. No deduction shall be allowed from the dividend income or income on respect of units of mutual fund 2023D or income from units of specified company 1035 other than deduction on account of interest expense. And in any previous year, such deduction shall not exceed 20% of the dividend income or income in respect of such units. So guys, income of, here also I'll write down, specified plus admin. It is exempt under 1035. Unit holders, definitely taxable. Now tell me guys, interest expense, how much? 20% of that interest income, 20% of income. So if I earn 1 lakh, 80,000, I should offer to tax, 20,000 is allowable deduction. Other expense not allowed. Interest expense, 20% of income. Other expense not allowed. Oops, sorry. So they'll ask in the exam one question. They can ask units of administration, income earned is 1 lakh. Interest payable is 30,000. Other expenses are 20,000. How much is allowed? Option A, 30,000. Option B, 50,000, 30 plus 20. Option C, 20,000, 20%. Option D, none of these. Answer. What did I ask? Total income earned is 1 lakh. Interest on the loan that you have taken to earn this amount is from administration unit, from the children's scheme. Interest is how much? 30,000. Other expenses 20,000. They'll ask how much expenses allowed as a reduction under 57. MCQ question. First one 30K. Second one 50K. Third one 20K. Which 20K? Income into 20%. Fourth one, none of these. Answer. 99% of the students will tick 20,000 and come. Answer is 50K, my dear friends. How? Sir, what are you telling? Please see. In 57, mutual fund unit is there. Specified company is there. Where is administrative company? Not there. Administrative company is not there. This is there. This is there. Administrative company is not there at all. So guys, good, got it? Fully allowed. Fully allowed. Important. As per proviso to section 57. All this is what? Proviso to section 57 only. Proviso to section 57. As far as taxes are concerned, that would be what? Same, TDS or capital gain as such. As far as TDS is concerned, 194K will come. Income more than 5,000, TDS at the rate of 10%. TDS at the rate of 10%. Capital gain depends if it's a equity oriented fund or it is other. If it is other fund, 112 will come, 20% tax. If it is an equity oriented fund, then you have to see whether it is short term or long term. 111A, 112A. So it would be 15%, here it would be 10%. If what? If it is two things. One, stock exchange where STT is paid. Second one, sold to another mutual fund where STT is paid. If STT is not paid, then normal provisions will come. This you have already seen, guys. I'm just repeating. So two things, stock exchange is there and STT is paid. Second one, sold to another mutual fund and STT is paid. Yes. So these two things will come. That's all there is to it. Nothing else. Chilled out. Same stuff is given here. Easy. Right? Done. Cool. So actually, guys, I thought I'll do ESOP in this only. No problem. Next session, I'll do ESOP. Okay. ESOP is immediately next session. ESOP and ESOP tax on startup. Both will do next session. Hi, guys. Let's finish off taxation of ESOP. Again, very important. So see, guys, you have income from house property and income from salary. That is also part of the syllabus. But then whatever was there in CA Inter, all that allowances, etc., and house property calculation, nothing they'll ask in the exam. What they'll ask is some higher level items. Higher level items like, for example, taxation of employee stock option plan, because this will come under section number 17, which is your perquisite chapter. So under perquisite chapter, particular thing will come. Similarly, taxation on the startups, etc., that will come. So they'll combine this. If you sell your ESOP or if you buy ESOP, what is the taxation for the company? If the person sells that ESOP, whatever he had, what is the taxation for the particular person? All those questions they'll ask, right? So that salary part comes there. If you remember in income from other sources, we had done clubbing provisions, basically not income provisions, clubbing provisions. You also did a concept called deemed donor. So it will come there. So deemed donor is section 27, which is obviously house property. So those higher elements of classes will come, higher elements of concepts will come in CA final. That basic, LOP, DLOP, all this will not come, guys. They have other things to test you and not those things. So do not worry about all those things. But nevertheless, if you want to brush through the normal salary chapter, HP chapter, I will also upload. You can check a little while later. I will upload an open PDF on higher this thing, house property and salary. You can go. That is, CA Inter stuff you can go through. But CA final student will not have the time to check all those things because so much is here only to ask. So they will not ask those things. Generally, it has never come. But I will never say salary and HOD will never come. It will come in terms of this. For example, ESOP is nothing but salary chapter. It is salary chapter, capital gain chapter. Similarly, clubbing of income is a separate chapter along with deemed donor, which is house property. So that's what I'm trying to tell. So let's understand the concept of ESOP. ESOPs are taxable as perquisites in the hands of the employees. Perquisite in the hands of the employee. So if you see section number 17, which talks about what is a perquisite. Let's see. (17)(2) perquisite. So in this, if you see here, the value of any specified security or sweat equity shares allotted or transferred directly or indirectly by the employer or former employer free of cost or at concessional rate to the SSE. So guys, what is this? Generally, let us say on 1/1/19, you are employed in the company, I work for a couple of years, let's say. So I will offer you 1,000 shares of ESOP. The fair market value of those shares are, let's say, 1,100 rupees. On 1/1/21, they will tell, I will offer you only if you work for 2 years. These 2 years are called as the vesting period. On 1/1/21, you now become eligible to buy the shares. You become eligible to buy the shares, which means vesting has happened, vesting period, eligibility. Here, fair market value, let's say, is 1,200. You will be given a period, a period where you can exercise the option. You can exercise the option. You will exercise the option, let's say, on 1/7/2021. 5-6 months will be given. You will do it on 1/7/21. Option is exercised. Now FMV is 1,300 rupees. They will immediately not allot in the moment you exercise. They will allot it sometime later. Let's say a few months later, 30th November 21. Or let's say next year, 22. They will allot. This time FMV will be at 1500. 1000 shares of ESOP, face value 10 rupees. Now guys, tell me, what does the law says? The law says that taxability will arise at the time of allotment. Taxability will be at the time of allotment, but the FMV will be the date when the option is exercised, because that day you decide to buy. Just because the company delays by so long, you cannot hold the person liable for that. So at this price, 1300. So 1300 will be the, FMV. Minus what? Face value. It's 10. So 1290. 1290. This will be the value of the perquisite, which is taxable in whose hands? Employee's hands. Right? It's an option given. So this will be taxable in the hands of the employees. So in the previous session, we did taxability. And we did ESOP also. That ESOP was what? That was buyback of ESOP. So then obviously it is taxable in the hands of the company. This is not buyback. This is giving ESOP. So when I am giving ESOP, obviously it will be liable in whose hands? It will be liable in the hands of the, what do you say, shareholder. That is the employee. Now many tax planning they used to do. Since this is for an employee, they used to wait for the employment to get over. After that, one day later, they used to issue ESOP or similar something to ESOP or sweat equity. What is sweat equity? That is for the sweat that you have given to the company. The sweat equity is different. Sweat equity is for the consideration already paid. So if you have worked something, if you have given know-how, if you have obviously worked hard in the company, then that is ESOP. So one of my dad's friends, he joined Infosys, true story, in the year 1986. In the year 1986, just when Infosys was forming, at the formation only he started. 1982, Infosys came. So 1986 he joined. He worked for 14 years in the company, 1986 to 2000. He was the person to construct all these, civil engineering work. All campuses were under his guidance. In 2000, Narayan Murthy went to MCA and went to the ministry and said, there is a section in, Companies Act. True story this is. This is how this entire section came about. There was a section 53 which said, any share issued by a company at a discount shall be void. Narayan Murthy went to MCA and said, sir, I want to give free shares to my employees. MCA said, not possible, sir. He said, why the hell? He said, no, sir, not possible because this is section. He said, boss, employees have given their blood and sweat for the company. He named the term actually, sweat equity. They have given their blood to the company. You need to allow me to do that. Based on strong recommendations in the Companies Amendment Act 2000, same year, section 54. That was old law, 1956 law. A different section was there. Sweat equity shares was inserted. See, 79A was inserted. 79, 80 were there. 79A was inserted in 2000, 1956 Act. Right? Yes, you're notwithstanding anything contained in 53. What is 53? You cannot issue shares at a discount. Here it says, yes, may issue sweat equity shares if this procedure is followed. And you see section 53 also. There they have said, except as provided in 54, company shall not issue shares at a discount. Wonderful. So my dad's friend, Narayan Murthy called my dad's friend and he handed over a check for sweat equity shares. That time in the year 2000, 24, 25 years ago, 23 years ago, that was valued at, believe it or not, 2 crore rupees. 23 years ago, 2 crore. He said, sir, from tomorrow I'm quitting. He said, no problem. Your wish. Please go spend time with your family because 14 years you have given your life, your sweat, your blood to Infosys. Next day he quit. After that day, uncle has never worked. And recently he passed away after COVID. I mean, not due to COVID, but after the COVID phase, he passed away because of cancer. But he lived his life. He was a very generous man. He did a lot of social service activities. If you get 2 crore worth of stuff and you invest properly 25 years ago, you just imagine how much that 2 crore would have fetched, right? Smart investment, nothing. It was a lot of money that time. Now also it's a lot of money, but think about it. So many years ago, it was a lot of money, right? So that is what it is. So what people used to scam, they used to do this. They used to tell boss, it will be tax. So the taxation also, all that came that time. So they used to do one scam. Bro, you resign today, okay? Tomorrow I'll give you. Why? Because employee stock option plan. I'll name some other thing and give it to you. Only when employer-employee relationship is there, I can give. But the employer-employee relationship is not there. So take it. Point number one. Point number two. Reliance Industries, or let's say Tata. Tata Consultancy Services, TCS, is giving ESOP to an employee. Rather than giving Tata's consultancy services shares, he will give Tata Motors car shares. And you cannot come until security is given. Some other company have given, not this. What is sweat equity? Only that company only if you give sweat equity. I'm giving some other security. Tax planning was happening. Finance Ministry did not like it. So obviously you see the perquisite here only. The value of any specified security, deadly. This was added. The value of any specified security. In 2009 Finance Act, they substituted it. Value of any, because 2000 to 2009 people played around like this. Any specified security, which can be anything, by the employer or former employer was added. Nothing doing. So even if you get 1 year ago, you were working in a company, today you get sweat equity for the work done that time, chargeable to tax. ESOP you are getting, chargeable to tax. Specified security means securities as per SCRA. That's all. Anything, guys. Equity shares, preference shares, units, everything is covered. Sweat equity means equity shares issued by a company to its employees at a discount or for consideration other than cash. You see, FMV of the specified security on which the option is exercised as reduced by the amount paid or recovered from him. If it's sweat equity, generally it is nil, or the face value. FMV means the value determined. Now this is what they give. FMV. This is all 17.2. So I told you here, no, FMV. I told you here FMV. How to compute? Summa I wrote 1300. How did I compute that? Now that is there in part as part of rule number 38. Computation of this FMV. Valuation of perquisite. This is purely salary chapter. with the rules. So check it out. ESOPs are what? So if you see, one is the, is it a option given or is it mandatory? Employee stock option plan. If I had invested, I was working in a company in 2008 wherein the stock market, the entire subprime mortgage crisis. 2007, they had given me an offer for buying at 500 rupees. 2008 crisis happened. My company tanked. And in 2009, at the time of exercise, market value was 7 rupees. But the exercise price was 500 rupees. Can the company force me to buy the share? No. That's why it's an option. Employee stock option plan. So you see, perquisites are to be taxable in the hands of the employee in the year in which shares are allotted to him under ESOP. I told you allotment here. But perquisite shall be calculated on the basis of FMV of ESOP on the date when employee exercises his option. Taxable perquisite shall be determined as under FMV of the shares on the date on which option is exercised A, amount paid or recovered from the employee in respect of the share B, value of the perquisite taxable when shares are allotted A minus B. Very, very simple. Determination of FMB. This is what, generally you need to just go through. This chart is enough. Where shares in the company are listed on a single recognized stock exchange, FMB will be average of the opening and closing price of shares. Very simple. Opening, closing, average on the date, which date? Exercise of option. But on the date of the option, exercise of option, there was no trading. 15th August, there was no trading. Then closing price of the share on any recognized stock exchange on the date closest to the date of exercise of option. Previous day, immediately preceding such date. If 15th August was a Monday, 14th August was a Sunday, then, Saturdays, Fridays, like that you should see. Where shares in the company are listed on more than one recognized stock exchange, then average of opening and closing price of shares on the date of exercise of option on a recognized stock exchange which has the highest volume of trading. You should see the turnover for those particular shares in which stock exchange it is more. So that I should take average opening and closing. Similarly, if it's not there, previous day. Where shares in the company are not listed on a recognized stock exchange. For example, Google India shares are not listed. In those cases, value on a specified date will be as determined by a merchant banker. Chartered accountant is not there, merchant banker. It is the date of exercise of the option or any day earlier than the date of exercise of the option, not being it is more than one. So basically, guys, if 15th August is the exercise date, on that day we will see, or we will go back 6 months. Any day he will take. That purely depends on the merchant banker. There are a lot of other things he will do that. That valuation and all is not important for us. That's it. When the employee is selling shares, full value of consideration, sale value, less cost of acquisition will be the FMV of such shares. LTCG or STCG will come. What is the period of holding? Obviously, from the date of allotment will the period of holding start. From this day, it will start obviously. What is the cost of acquisition? Shall be the FMV which has been taken into account for the purpose of section. So for him it is 1300. This is what is taken into account. That is all. That's all I'll have to pay. This is how it is calculated. Right? Very, very simple. Now, there were a few things also. Like for example, if I give a tea box, Tata has, exported tea. So export quality tea. Nobody else will get. Only in the AGM they have declared that, okay, tea I'm giving. Tea box. Is it 222A distribution of assets? Is tea box, it's a raw material, it's a finished goods, it's an asset. So guys, no. Why? As per 222A it says any distribution to all the shareholders. Now tell me, are they giving it to all shareholders? No. Not given to all shareholders. Not given to all shareholders. It's only given to those who actually come for the meeting. If you don't come, you'll not get T-box. And even if the person who's taking 1 share, even if the person who has 1 lakh share, he'll only get 1 T-box. What, for 1 lakh fellows, I'll get 1 lakh T-boxes? No. So since it is mentioned that, this is what we need to keep in mind. Very, very simple. And CBDT had also clarified that I told you, this one. This entry. Will you get allowance? No, disallowed as per CBDT. Remember, in ESOP, when I do accounting purpose, you cannot account like that. ESOP expenditure 90 lakh, bank account 10 lakh, to security, share capital 10 lakh, security premium, all that. It's ultimately book entry. Not allowed. Not allowed. This is the correct one. Right? So guys, this is one part of the story. This is one part of the story. What is the second part of the story? What is the second part of the story? Second part of the story is, think about it. You are a startup. Obviously, some Pani Puri shop and all cannot call it as a startup. There should be a proper startup. This startup, let's say, has around 10 employees, and they have given 50 lakh each, ESOP, 5 crore. What was the problem, guys? In a startup, no one cares about the salary. They all look for a stake. All the startups started like that only. What is my stake in the company? Because they have a vision. They know that the company will really do well. And going forward, when the company really does well, I cannot just work on some salary. So you should see an ICAS founder, after the startup became public, crazy money she made. Similarly, Zomato also. Right? Only Paytm, fellow poor guy, it did not make so much money. Then Paytm went for buyback also, all that thing happened. Anyway, so basically 10 employees of 50 lakhs, 5 CR. If I do this ESOP 5 crore and you exercise the option, whatever, first of all, guys, is there TDS on this ESOP, etc.? Yes, TDS outflow, since it's a perquisite. From the company's point of view, TDS will go. From employee's point of view, let's say exercises the option. His salary will be some, let's say, 3 lakhs per month. He exercised the option for 50 lakhs suddenly. What to do, guys? How will he pay? So that's why they requested the government that, sir, for ESOP, please do something. For ESOP, kindly defer the taxation. Kindly defer at a later stage taxation. So how will you defer? If my salary is, let's say, 15 lakh, ESOP is, let's say, 50 lakh. Now, as I told you, overall 65 lakh. Sir, I will pay tax on 15 lakh at the highest rate, 30%. 19.5 lakh I'll pay. No problem. But, sir, the tax on this 50, sorry, tax on overall 65 lakh. Tax on overall 65 lakh is how much? 19.5 lakh it will come. This one, sir, especially 15 lakh you leave, sir, but this part, that 50 lakh extra, kindly defer it. How to defer? One is 140 subsection A, self-assessment tax. Sir, tax on this 50 lakhs is, tax on 50 lakh is 15 lakhs. Overall tax is 19.5. Sir, I will pay 4.5 lakh. Remaining thing, please defer to a later date. What is a later date? We'll see. Second, under section 156, if you do not pay the tax on time, there will be a demand notice in any of the intimations. They amended that law saying that there will be no demand until that date. Which date we will see. Third, In TDS 192 1C was inserted. 192 1C was inserted. Now they say company no need to deduct TDS. You will deduct later when he exercises the option or when he leaves, whatever. We'll see at the later date you do. Immediately only don't do. Then under 191, it's a direct payment, which means if TDS is not deducted by employer, employee has to pay. This also got amended. Even if the company does not do TDS, deduct TDS, you have to deduct TDS at a later date. What is that later date? We'll see. All these things were amended to a future date. What is that future date? We'll see. See the notes. Page 12.2. See, as per section 1726, perquisites includes the value of ESOP allotted or transferred by an employer to the employee. Accordingly, value of such perquisite is taxable in the year when such ESOPs are allotted or transferred to the SSE employee. This leads to cash flow problems for the employee who does not sell the shares immediately and continues to hold the same for long term. Startups generally use ESOP to attract and retain highly talented employees as the startup has liquidity crunch. To incentivize the startup ecosystem, Finance Act 2020 has deferred the tax liability of the startup employer 192(1)(c) and also the tax liability of the employee 140A. Within, so I mean, this is important. 14 days from the specified date. 14 days from the specified date. What is specified date? Expiry of 48 months or 4 years. That is from the end of the relevant assessment year. That is year in which the ESOPs are allotted or transferred. Allotted or transferred. So for example, if it was allotted on 30th March 2022, what is the relevant assessment year? 23-24. From the end of 22-23. The end of 23, 4 years. So guys, apart from 48 months, I will get these 12 months also. So roughly I'll get 60 months. So basically, actually I'll get 5 years. I learned assessment year is 1 year plus 4 years. 5 years, deferred by 5 years. Because that is the time when I'll know whether the company will really do well or go down. In ESOP valuation, everything will go for a toss anyway at the time of exercising. Or whichever is the earliest, obviously, or ESOPs are allotted or transferred. This is vesting period if it's so long. What if it's allotted now only, or if it is sold? Then obviously you have to pay. No, you cannot transfer the ESOP to the shareholder and then he will coolly wait. No. 14 days from the day ESOPs are allotted or transferred. Third, date of sale of such ESOPs by the employee. Generally there will be a time period. By this you should not sell. If you sells before that, yes. Date on which the SSE ceases to be an employee, yes, I will leave my job. If I leave, yes, that date, whichever is earliest. Note 1, the employer shall be eligible startup in accordance with ATIAC. We have seen this that time. There is no change in the value of perquisite in the year of chargeability. That is, the perquisite continues to be chargeable in the year of accrual allotment. Only payment of tax is deferred. Chargeability will continue, payment is deferred, that's all. The effects are as under. Value of perquisite on ESOP shall be included in the income of the employee in the previous year in which the ESOP is allotted. If ESOP is allotted in 28-1-23, perquisite on ESOP shall be included in the income of the employee previous year 22-23, that is assessment year 22-23. However, as per the amendment in section 140A, self-assessment tax shall be reduced by the tax on perquisite, besides other reduction. Therefore, employee is not required to pay tax along with the return and he shall not be treated as assessee in default. Though he has to offer to tax that year, the payment will be deferred. The employer shall deduct TDS on ESOP within 14 days from the specified date. as per the newly inserted section. As per 192(1)(c) Insider Finance Act, if employer is not able to deduct tax within 14 days, employee shall pay the tax on his own within 14 days from the specified days. This was 191 direct tax scheme. As per 156(1), AO shall issue a notice of demand specifying the sum payable on which value of purchase disclosed in ROI for the year in which ESOPs were allotted or transferred. Such sum would have generally been payable within 30 days. And SSC would have been read as SSC in default. That's why one more clause was inserted in 156(2). A protection to SSC. The employee shall not be deemed as SSC in default on receipt of notice in demand. However, provisions of deeming the employee SSC in default shall become applicable only if you do not make it within 14 days from the specified date. 14 days from the specified date. 14 days of what? Specified date. So let's solve a problem, guys, so that it will be very easy for you. It is there in my compiler also, separate questions, but you solve this now. We'll write it together and solve. Mr. Ambi was an employee of Master Limited, eligible startup, gross salary 26,50,000, December 2019, granted options to apply for 20,000 shares at 20 each. All options were exercised. By Mr. Ambi on 1st March 2020. FMB was 200 each. So guys, exercise FMB only you should take. So this is an important FMB. Shares were allotted. This becomes cost of acquisition, remember. Shares were allotted on 20th July 2020 when the FMB was 230 per share. This is irrelevant, but this date is important for period of holding. Now out of this 20,000 shares, $10,000 shares were sold through recognized stock exchange on 5th August 2023 at 500 rupees each. Second, 10,000 shares were sold on recognized stock exchange, 700 rupees on May 15th, 2027. He resigns from the post on 31st March 2028. What are the tax consequences? What are the tax consequences? So check it out. First of all, what is the gross salary? 26,50,000. Value of perquisites, how much? 20,000 shares is getting What is the FMV, guys? What valuation? You have to do 200 rupees minus this one. That is the perquisite face value. That is what they are allotting him, right? 200 is giving at 20 rupees. This is the value of perquisite, 36 lakhs. So, less standard deduction. See, this is an income from salary question, 50K. Overall is how much? 62 lakh. Tax on this entire thing. Normal provisions, if you do tax, 19 lakh, 13,340 will come. Overall tax, this will come. So I need to figure out what part of it is to be deferred. See, I told you that time 30%, thinking everything is over above slab rate. Here I have to take the slab rate also. Now I have to compute average rate of tax. Average rate of tax. How much is it? 19 lakh 13,340 divided by 62 lakh into 100. 30.86%. So tax to be deferred under section 192(1)(c). 30.86% of 36 lakh. 11 lakh 10,960 is to be deferred. Average tax I should calculate. Actual calculation is like this. So what is the tax to be deducted? As per 192, it is 8,02,380 rupees. So assuming the company deducts all this, his advance tax, etc., properly, self-assessment tax will be nil. I mean, TDS only if they deduct, advance tax also will not come, self-assessment tax also will not come, nil. Now, 10,000 shares sold on 5th August 2023. Now, as per the section 192(1)(c), TDS liability will come earliest of the three. First one, when was the thing given? Year, this one. So what is the financial year? 31st March 21. What is the assessment year? 31st March 22. This comes under the assessment year 21-22. Simple. It comes under the assessment year 21-22. So assessment year 21-22 plus 48 months plus 14 days. That is 31st March 22 plus 48 months plus 14 days. 23, 24, 25, 26. 31st March 26 plus 14. So April 14th, 2026. Point number 1. Point number 2. 14 days from the day he exercises the offer. Sorry, 14 days from the day he sells or makes the transfer. That is which day? Talking about 5th August, you know. August plus 14 days, 5th August 23. 19th August 2023. Third one. 14 days from the day he leaves the job. When does he leave the job? 31/3/28. 31/3/28 plus 14 days. 14th April 2028. So what is earliest of the three? August 2023. So on 19th August, this only no, 19th August 2023 will be taken into account. So on 19th August, you have to obviously deduct TDS proportionately. What was the entire amount to be deducted, guys? Tax to be deferred 1110,960. 1110,960 was actually for 20,000 shares. So it should be divided 10,000 shares out of 20,000 shares is being sold. So 5,55,480 has to be deducted. If this is not deducted, deemed to be in default. Deemed to be in default. Capital gains will be what? Sale proceeds. Sold it for what amount? 500 rupees, right? 500 rupees. 500 rupees into 10,000, 50 lakh. Cost of acquisition. As I told you, 10,000 shares into FMV as on the date of exercising the option, 200 rupees, 20 lakh. Long-term capital gain, 30 lakh. Tax on capital gain you can compute. Remaining, when should he, one is this 19th August. Next, that is done, 19th August 23. Then what should he do? The balance 10,000 which he has, that should be done same. If you see 15/5/27, that is the day he gives plus 14 days, or resigns. Come back. 14th April 28 or 14th April 26. Correct? 19th August is when he sold. You leave that. Next time when he sold, 27. So 14 days, the 27, that will not come. 14th April 28 will not come. What will come? 14th April 26. So on 14th April 26, company has to deduct the remaining 5,55,480. Otherwise gone. Otherwise gone. That's it. When you sell it, whenever it is, when you sell, how much did you sell it for? 700 rupees, 70 lakh. Minus what is the cost? 10,000 into 200, 20 lakh, 50 lakh. Capital gain on May, capital gain in May 2027 will be 70 lakh because 10,000 into 70 minus cost of acquisition is 10,000 into 200, 20 lakh, 50 lakh. That is separate. This is how we need to see. If at all they ask the question, it will come like this. This was an examination question. That's all about taxation on ESOP and startup taxation. So in the next class, we'll start off with very, very important concept of trusts. Trusts. Charitable trust, religious trust, next class. Take care, guys. Hi, my dear friends. How are you doing? Okay, guys. Today we will start a very, very, very important chapter. Charitable and religious trust. 100% 8 to 12 marks in the exam. Undoubtedly. Extremely important topic. As I told you, Undoubtedly, they'll ask in the exam 8 to 12 marks. Regularly asked in the exam, guys. So it will take some time, but then we will be doing it properly as usual. So come to page number R1. Taxation of charitable and religious trusts and institutions. Religious trusts and institutions. So in the previous session, we finished off ESOP and all that done. This liquidation, buyback, all that we had done. Bonus stripping we had done before only. So this chapter is also over. Other sources also, we finished everything, guys. There's nothing much in that. Cool. So R1, taxation of charitable religious trusts. So let us move on. So first of all, guys, generally, section 11 and 12 is a section where, the exemption is given for charitable and religious trusts, where the gross receipts will be deemed to be the income of the particular religious and charitable trust. Donation is very much part of gross assets. As basics I'm telling, then we'll go into the section. Generally, gross receipts will be what? The income, whatever income it generates. A trust will have various properties. So whatever income it gets under those various properties, it can be a school, it can be a hospital, it can be any organization, religious organization. Tirupati Balaji Trust, correct? So yes, all the income that they get is definitely called gross assets. Apart from that, any donation that it gets is also part of gross assets. That will come part of it. But if I specifically donate to the corpus. Corpus is a fund which is separate fund. It cannot be touched. It is always used for the, it cannot basically, trust cannot use it for day-to-day activities at all. It is set aside for a specific purpose. So any donation to the corpus, it is totally exempt. I cannot touch that. It cannot come under the tax ambit at all. So general rule, I'm just doing an overview. We haven't even gone into the sections. Excuse me. If the gross assets are say 1000 lakh, there is a 15% ad hoc deduction, 150 lakh. So the remaining 850 lakh will be taxable. However, that also can be applied. So full 850 lakh also will be exempt. 850 also will be exempt. 850 represents 85%. That also will be exempt. It is purely based on application. It's purely based on application. So these are the basics. So let's see with these basics, let us see the section. So we have spent a lot of time in designing this material. It becomes easy for you. Now, I have made a video whether BCCI will it come under charitable purpose. So immediately after this video, it's already that BCCI video is already there on my YouTube channel, but nevertheless for your interest, the next video I will put that video whether BCCI should pay tax. It's an interesting video. If your exam is closer, do not watch that video. But if your exam is sometime later, 4-5 months later, if you have the time, watch that video. I've given you an insight on the definition, which is of charitable purpose, etc. Extremely in-depth we have analyzed, guys. Yes, so charitable purpose means what? Includes relief of the poor, education, yoga, Baba Ramdev Ashram, medical relief, preservation of environment. Sir, I'm sleeping every day, sir. I'm doing Shavasana. Will it be covered? Hey, yes. There is one sleep well mattress or something and some Restolex or something. So they're paying money for sleeping. I'm not joking. Imagine. They are called sleep consultants. You have to go there and sleep and then tell how was your level of sleep, degree of sleep. You're getting paid. Sir, charitable purpose, yoga, shavasana, all that don't tell. Okay. Yes, yoga, medical relief, preservation of environment, including watersheds, forest, wildlife, etc., and all these things. More in depth, I've analyzed it in, what do you say, the BCCI video, you can check it. Anyway, the gist of the story is here, guys. What do you mean by that here? This is enough. This much you study, enough, guys. Relief for the poor, education, yoga, medical relief, preservation of environment, including watershed, forest, and wildlife, preservation of monuments or places of objects or artistic or historic interest. Hampi is a World Heritage Site, so there obviously people are deployed for preservation of Hampi. So that obviously would be charitable purpose. If any trust is looking after the entire upkeep and preservation, it will be charitable purpose. Advancement of any other object of general public utility. So this, to understand more in depth, watch the BCCI video. Right? It is a good video. It will give you a lot of insight on how to read the Bare Act. Right. So what do you mean by advancement of general public utility? In the gist of it, advancement of any other public utility shall not be for charitable purpose if it involves carrying on any activity in the nature of trade, commerce, business for a fee or any consideration irrespective of the use or application of the income from such activity. So if it relates to any business, etc. See, if if a trust already does charity, like for example a school or a yoga center, Isha Foundation for example. But apart from that, they also sell, right? Isha honey, they'll sell this Isha balm. I actually use it. It's pretty good. Isha balm. Then they have these other things, right? Your, many things that they sell. They have Isha dhoti, all these things. Now, those things, if it's business related, incidental to business, it's allowed because it's part of, many things. It's Isha yoga. So it comes under this charitable purpose. But purely if you are into commercialization, for example, BCCI. What charity is BCCI doing? I'm just saying, right? So if you see that case, it may not be included in advancement of general public utility, is what they are saying. So if you see, however, carrying on commercial activity shall still be regarded as charitable purpose if such commercial activity is undertaken in the course of advancement of any other object of general public utility. Like as I told you, general public utility means anything for the benefit of the public. Now the entire yoga session, if Sadhguru organizes for the benefit of everybody, that is called as, advancement of general public utility. So in the course of a free yoga, session organized, in that if he sells Isha balm, Isha honey, then it's okay, is what the law is saying. The aggregate receipts of such activity do not exceed 20% of the total receipts of the trust. So this we will see slightly later. Anyway, overall should be 20%. The aggregate receipts of from such activity, that is that selling of honey, etc., should be total receipts. If it's 100 crore, if it is less than 20 crore, then it's okay, is what they are trying to tell. Where the gross receipts of commercial activity is in relation to 1 to 4 above exceed 20%, it shall still be regarded. So this is talking about 1 to 5 here. This is different. The only problem is 7. BCCI. I told you an example, 100 crore, Isha Foundation, Isha Yoga. Even if 40 crore come from business, it's okay because it's point number 3. The 20% route is only for advancement of any general public utility. So more on that, you can check the BCCI video next. You will understand that in a much better way because only on this section I have analyzed that. That is only if you are interested. If you don't watch that video, nothing will happen. But if you watch that video, something will happen. Okay? Yes. Income from property held for charitable or religious, but this is what is the important part now. Let's go ahead. Subject to provision of 6063, the following income shall not be included in the total income. Income derived from property held under trust wholly for charitable or religious purposes. To the extent to which such income is applied to such purposes in India. So here they are saying Isha Foundation has many properties in India. Sri Ravi Shankar's Art of Living Ashram has many properties in India. And from all the properties that they hold, whatever income that they get wholly and exclusively for what? charitable or religious purposes. To the extent of such income, if it is applied in India, they are saying that yes, it will be exempt. It will not be included in the total income. So one question will arise, what about outside India? Art of Living has so many centers outside India. Isha Foundation has so many centers outside India. What about that? So to obviously cover those things also, section 12 came. Because here guys, they spoke about income derived from property. Income derived from property. But what about, other things? What about abroad? What about abroad? Income derived is one part of it. What about abroad? What will that happen? So when will that be covered? How will that be covered? That is why, as I told you, section number 12 came into the picture. Check. Section 12. Any voluntary contribution means donation received by a trust created wholly of a charitable purpose by an institution established wholly for such purposes, not being a contribution made with a specific direction that they shall form the corpus. See, not being contributions made with a specific direction that they shall form part of the corpus, because corpus is completely separate. If there is a direction that this money will go to the corpus, that will be outside the purview of section 11. So non-corpus funds, if I am receiving, shall be for the purpose of section 11, deemed to be the income derived from property under trust duty. So they are telling what? Even though you are getting any voluntary contribution, any donation, or you are giving any value of any services, this is educational services, this medical or educational service, this is the main crux guys. All hospitals, all educational institutions are running under trust. It is a, more often than not, it is a front to convert black to white. My first audit was in an educational institution which was run by 5 real estate companies, all big shot real estate companies. This only was happening there. Obviously I cannot name it. Yes, so the value of any services being medical or educational services made available by any charitable or religious trust running a hospital or medical institution, that also will come. Apart from that, any voluntary contribution received by a trust, any donation, anywhere you receive, any contribution you receive, even from outside India, it is deemed to be income derived from property held under trust. That's all. So there is a link between 11.1 and 12. 11.1 and 12. Coming to 11.1. Income derived from property held under trust wholly for charitable or religious purposes, to the extent to which such income is applied to such purposes in India. To the extent to which such income is applied to the purposes in India. And where applied means what is the question? What do you mean by applied? Correct? What do you mean by applied? So they are saying applied means what? If I give employee salary, is it applied? If I buy a building, is it applied? If I buy a car for the benefit of the, the trust, is it applied? Can I claim depreciation also? Plus, can I buy the car also to double deduction? What do you think? So we'll see all those things. If any liability is incurred, but it is not paid, liability is incurred but not paid, right? I have incurred a liability. I have bought some things worth 1 crore. I have not paid yet. It's lying in payable. Is it applied? Have they told applied or paid? Yes, guys. So employee salary is covered, building covered, car covered. Now depreciation, can you claim or not? This we'll see later. Liability incurred but not paid is also deemed to be applied. What about, can one charitable institution give a donation to another trust which is registered under both 112A, 12AB, now it's called 12AB, earlier, now it's called 12A, earlier it was 12AB, or 1023C. You can register under two sections. If I receive money, like for example, I told you this one, this 850 lakhs, if it is applied, then to the extent of application, it is exempt. If I apply to employee salary, is it covered? Yes. Buying a building? Yes. Buying a car? Yes. Can I claim depreciation also, car also? We'll see that later. If I have incurred a liability, out of these 850, 250 crores I've set aside incurred liability for construction of a school. Is it deemed to be applied? Yes. After everything, some 400 lakhs is left, 4 crores. I am donating it to one more charitable trust or religious trust registered under 12AA, 12BB, sorry, 12A or 12AB and 1023C. Is it also application? Yes. Yes. So, what exactly is application? All these things. Will be application. What I donate to a trust which is not registered under 12A, obviously it is not application. Depreciation, we will see that. Right. So here I told you, even if you incur a liability, if you don't pay also, that is application. Think about it, what all can happen, guys. I will incur an expenditure coolly and tell I'll pay later. But just because of incurrence, I used to claim as an application. Many people started doing this golmaal. So Nirmala auntie, what did she do? Like, no, this is too much. We will change it. Okay, let's see. So everything remains the same except this, because they were doing it earlier. It was allowed. Earlier it was allowed. Now we'll see. Right? Check it out. The following, this notes is very nice. Just stick to it, guys. Okay. The following income shall not be included in the total income of the religious or charitable trust. First one, 15% of the income derived from property held under trust, wholly or charitable. This is like an ad hoc deduction. Deemed application. I don't have to actually apply. Deemed. 85% of the income derived from property held under trust to the extent to which income is applied for religious or charitable purposes in India. What do you mean by applied? In India. Outside India also? Yes. Covered in 12. Any voluntary contribution. Income in the form of voluntary contribution made with a specific direction that they shall form part of the corpus of the trust, subject to the condition that such voluntary contributions are invested as per specific modes under 11.5. We will see this. We will see this. So guys, this 85%, no? This 85%, it's an option. So please listen carefully. It is 85% can be applied as per the explanation to 11.1. I'll show you the section here. This one. Explanation 1. Especially in that second one. 211, 221 and 22. 21 and 22. Explanation to which section? Section number 11. So please listen to me carefully. I can apply this 85%. I can apply this 85% under explanation to section number 11.1. In that clause A, clause B. Here. Two one two two. Okay, let me make it 2122. It will become easier. Because it is for the purpose of clause A, clause B only. Yeah, 2122. You can apply it using this. It's a little complicated, irritating procedure. You have to apply this year only. Next year you cannot. What? We'll see that. Or either you can do this, guys, or what can you do? You can simply say mother promise, God promise, auntie promise, uncle promise. What will I do? I will definitely apply this in the next 5 years. So that 150 lakhs, uske baad 850 lakhs I need not apply only. I can just say I do mother promise, father promise, auntie promise, uncle promise, Nirmala auntie promise, I will apply. So guys, one is actually apply. Other option is what? Promise to apply. Under which section? 11 subsection 2. This is complicated. This is easy. The procedure of investment is given in 11 subsection 5. What do you think 100% of the trusts in India, 100%, whatever I have seen everybody and whatever everybody else has seen everybody, what will 100% of the trust follow? Complicated one or easy one? In this, first of all, you need to apply. If you don't apply, it will be disallowed, added to income. All that nonsense is there. Here, 850 is there. I promise to apply. When? In the next 5 years. Imagine. Plus one grace here is also given. Later we'll see. If I don't apply within that time, then you can add back. But until then, I can apply. Whenever I want, I can apply. This year you cannot come and tell. Next year I'll apply. Bro, I already told you, no? So guys, obviously everybody will follow this. Nobody follows this. In the exam also, they will not ask. But is it in the syllabus? Yes, we have to do it. We are not skipping. We are doing it. But I hope you understood. 85, so the same thing is there. 15%, 85%. In that option 1, useless. Practically not feasible. This is option 2. Here you see. Such voluntary contributions are invested as per specific modes under 11.5. This is that option. And I told you in India, outside India is given here. This is section 12. Voluntary contribution. Guys, here no direction that they shall not form part of corpus. Obviously, that is not even there. Shall not form part of corpus. Obviously, because I told you corpus is not even considered in section 11. So whatever that language there is part of this only. Shall for the purpose of section 9 be deemed to be income, and it will be, followed accordingly. You see 11, 12, 11, 2. So many sections are there. Anyway. Percentage shall be calculated on gross receipts, obviously. Guys, I had paused it to go have coffee. I came back and I'm teaching. Then I saw bloody it's not unpaused. I started teaching already. What I told was, I'm again unpausing and I'm teaching now. What I told was that change you made, no, not delete that change. Delete that change. So it's correct only. Whatever is given here, it's correct. Why? I connected one more section and added it here. It will confuse you. Leave it. Okay. So I'll explain. In section 11, three things are not covered. One is that 15% ad hoc. Second, 85% if it is applied. Third one, any corpus donation will not be counted for the purpose at all. So everything is given in section 11 only. Check this. You see section 11. Any income derived from property in India held under trust outside India, I already told you. And you see, income in the form of voluntary contribution made with a specific direction it shall form of the corpus, subject to the condition that they are invested under 11.5. Correct? I made it not here for a reason. You leave it. I'll tell you later. Simply it will get confused. Confusion will get created. So basically, gross receipts if it's 100 to be counted. Voluntary donation 20 to be counted. Voluntary donation specifically saying that they are inserting into the corpus 10, that is not to be counted. This is not part of income. In this also, let us say it is 120. In that 15% ad hoc not to be counted. Remaining 85% also not to be counted if it is applied. This is what I was teaching. Then I realized, oh, I have still not unpaused it. Okay, that's all. I started writing already. This 85%, how will you, what do you say, how will you apply? Two ways to apply. One is the longer route, complicated route. One is the chilled out route. So what will everybody follow? Chilled out route. What is a chilled out route? Chilled out route is 11.2. Read with 11.5. 11.2. Chilled out. 11.2. 11 also, 2 also. See, easy to remember. 11, this looks like 11. Then this looks like 2. Correct? Chilled out route. All charitable fellows use the chilled out route. Got it? 11.2. Read with in what way? 11.5. Given in 11.5. Right. Percentage shall be calculated on gross receipt basis. And guys, this 15%, no, there's no need to set aside as such. It is directly ad hoc. Whether you use it or not, it is given. Application of income means expenditure is allowed only on payment basis. Incurrence of a liability for an expenditure would not amount to application of income. Major change by Nirmala aunty. Right? Finance Act 22. This is irrespective of the method of accounting employed. However, during any previous year, if any expense was claimed on accrual basis, shall not be considered as applied on payment basis in any subsequent year. For example, the trust follows accrual system, made a purchase of 1 lakh in March 23, for which payment was made in May 23. 1 lakh shall be applied in previous year 23-24 and not in previous year 22-23. You cannot claim any accruals because lot of scams were happening. This is the new change as per Finance Act 22. Okay. Yes. So if you see, the words applied will include what? Can be purchase of the capital assets, any revenue, expenditure, salary, donation to religious charitable trust, already discussed here. That's why I gave you a gist of everything, so it becomes easy. All this discussed already. I only have to discuss with the depreciation that you can take again. That we will see. But we shall see. Note number 4. Note number 4 is explanation 4.2. What people used to do, guys, coolly they used to take a loan, claim the interest on loan also. Loan of 40 lakh they used to take, claim interest as a reduction. This 40 lakh they used to apply in the charitable purpose, buy an asset, claim depreciation on the asset also superbly. Then on this also 40 lakh because they are applying the loan. It was deemed to be application. Deadly. When they brought in 40 lakhs, they took it as gross receipts and that was used to buy an asset. That was taken as application. Then this 40 lakhs asset, they used to claim depreciation. Plus that interest, whatever they are paying on the loan, they used to take. They said nothing doing. Explanation 4.2 of section 11.1 was inserted where they said application for charitable or religious purposes. I still haven't discussed whether depreciation on car or on any asset can be taken. That I'm not yet discussing now. We'll come to that. This I'm only talking about loan. Can I take a loan and claim it as application? Application for charitable or religious purposes from any loan or borrowing shall not be treated as application of income. However, it shall be treated as application in the previous year in which the loan or borrowing is repaid from the income of that year. Example, if a loan was borrowed by the trust in previous year 22-23 of 40 lakhs which was used for construction of a building for charitable purposes, earlier they used to take it as application, now it is not done so. But in that 40 lakh I am going to repay. I will repay 10 lakhs in 23-24, in 24-25 I will repay 30 lakhs. This year, yes. 10 lakhs can be treated as application in 23-24 and 30 lakhs in 24-25. Yes, next 11.6. If a trust treats expenditure on acquisition of asset as application of income, then the trust cannot claim depreciation on the value of such assets and such depreciation cannot be considered as application of income. Very, very simple. Corpus donations made by a trust with specific direction that they are towards the corpus shall not be treated as application of income at all. It will not be covered in that 11 only. If such corpus donations are made to, what were they doing? So what used to happen was, I told you, corpus donations are outside the purview of section 11. So what used to happen, let's say, I have a trust with 1000 lakhs, 150 lakhs is that deduction, 850 lakhs is still there. Let's say around 200 lakhs I applied properly for expenses, etc. How many is left? 650 lakhs is left. This 650 lakhs was given as a corpus donation to a trust which is registered under 12AA. It's a corpus donation. It is a corpus donation. Do you think I should allow this? People were saying, if somebody donates here as a corpus, I will not take. But if somebody from that whatever money is there, from there if I donate to corpus of some other organization, it is deemed to be application. 100% wrong. So, Finance Act 2017, Arun Jaitley said this corpus donation is not application of income. Are you understanding my point? If in this 1000 lakhs, let's say extra 100 lakhs is corpus donation, then this 100 lakhs is not counted, leave it. But of the remaining 650 lakhs in this example, right? If I transfer that entire amount of 650 lakhs to a trust under 12AA, then is that application? Ideally, people were claiming it's application because me receiving corpus is not included, but me giving is included. Arun Jaitley said no. So people were doing one more golmaal. Same 650 lakhs, instead of giving to a trust under 12AA, they were giving to a trust under 1023C. Nirmala auntie in 2020 said, boss, this also is not application. I am not opening the Bare Act and showing you because it creates confusion. That's why I have made this notes very easy in the form of notes. Check it out. Note 1, Note 2, Note 3. Till Note 5 we have cleared. Each of this is an examination adjustment. 8 to 12 marks, guys. That's why I am going slow. Coolly we are doing. Like this only you study. More than sufficient. Check this. Corpus donations made by a trust with a specific direction that towards the corpus shall not be treated as application if such corpus donations are made. Trust registered under 12A or 12AB, fund, university or medical institution under 1023C. This was inserted in by Arun Jaitley, this by NA. NA means Nirmala auntie. 2017, 2020. Got it? That's why here I did not write that word not. I had linked this and written. So you forget about this is correct. No need to make any change. It's correct. Okay. Little overaction I did. I'll insert that. Let them connect. Normal only we don't know. Interconnections and all not needed now. Okay. Cool guys. Overaction by me. Sorry. Here. Note 7. Income derived from property held under trust will include voluntary contribution except donations for corpus fund. Section 12 we have seen. Corpus donations will be exempt only if they are invested as per specified notes under 11.5. If not invested, then such corpus fund shall not be exempt and treated as normal donation. I told you corpus is set aside for a particular purpose. And what is that purpose? Until that purpose is met, it has to be invested. How it is to be invested? As per 11.5. What is 11.5? Just for your knowledge, quickly. It should be invested only in these things. So a corpus not invested in these things would be a normal donation. So if you call a corpus donation, it should be excluded from that initial money that you are getting in. If I want to subtract it, then yes. So basically, for example, if the gross receipts are 1000, voluntary contribution is 100, voluntary contribution towards corpus is 500. In the entire income, should I take 1600 or 1100 is the question. I will take it as 1100, then 15%, 85. I will do that. I will not consider this only and only if it has been invested under 11.5. If it is not invested in that, then full 1600. I will forget about the corpus word and I will do it normally. I will do it normally. Check it out. That's what it says. (7A) is not invested as per 11.5, then such corpus shall not be exempt and treated as normal donation. Got it. B we'll see later. I told you, no, 85% how will you apply? 85% should be applied as per that explanation I told you, no, that is given here, note number 8. Note number 8. Either you do as per note number 8 or you do as per 11 subsection 2. Right? So for your knowledge, in this notes, 85% should be done as per note number 8 or 11 subsection 2. Practically everybody follows this. This is a complicated procedure. But sir, is it in the syllabus? 100%? Yes, let's do that. Note number 8. If in the previous, just follow these notes, guys, just follow blindly, more than sufficient, everything I have covered. So there is 100 lakh, 15% is 15 lakh subtraction. What I have applied is 22 lakh. To be applied is 63 lakh. Now assume in this 63 lakh, 58 lakh one is not received yet. I'm supposed to get, I'm following accrual system. It's not received only, what to do? They said I'll be getting it, but they did not get it, not received yet. What to do? That is why note number 8 comes into the picture. What if it's received next year? What if part is received next year? When will I claim? Assessing officer will say, sir, 63 full, on that you have to pay tax, sir, no exemption. That's why some relaxation is there. I need to file a document with the assessing officer before the due date of filing the return. Then he will say, okay, no problem. Let's see that. Check it out. If in the previous year, the income applied towards charitable or religious purposes in India falls short of 85% of the income derived during that from the property held under trust, for the reason that whole or any part of such income has not been received. In my example, 63 out of 85 not received during that year, and the SSE submits a declaration to the AO on or before the due date that such income shall be applied to such purpose in the year of receipt or in the immediately succeeding year. I will say, sir, whenever I receive it, I will apply, sir. Or next year I will apply, sir. So I will say, let's say this 63 in this example was in the year 2023, 58 not received. I will tell this fellow, sir, if it is received in 2024, that year only I will do, sir, or next year, pakka I will do, sir. If it is received in 2026, sir, 100% I will definitely apply that year, sir, or immediately next year I will do it, sir. I should write it and give. When should I write it? Before the due date, 31st September 23. 30th September. Sorry, 31st October, no trust, 31st October. Then such income shall be deemed to be applied during the previous year in which such income was derived. In which such income was derived. So if you make that promise that you will, do it, that year only it is deemed to be applied deadly. So basically, if the income is derived on 31/3/2023, but you actually promise that whenever you receive, let's say in 2024, or 25, whatever you do, then which year it is deemed to be derived? In the previous year in which the income was derived. If such sum was not applied as per the declaration furnished, you did not apply, the amount not so applied shall be deemed to be the income of the previous year immediately succeeding the previous year in which such income was derived. So the next year it will be deemed to be your income. See the example. In the previous year 22-23, 2 lakh was not received and a declaration was submitted to the AO that such income shall be applied for such purpose when it is received or in the immediately succeeding previous year. Then 2 lakh shall be deemed to be applied in 22-23 itself. Assume now 2 lakh was received in 23-24. What should I do? I should either apply it in 23-24 or I should apply in 24-25. However, guys, one change here. In which such income was received, you make received. So you read again. In the previous year 22-23, 8 lakh was not received and a declaration was submitted. See guys, I told you no, one second. Cool. Don't worry, I'm here. Again I'll write, coolly listen, okay? Let's say income from property held in trust. Let's say 20 lakh. Voluntary contribution, let us say 2 lakh. Corpus donation 5 lakh. Expenses of running the show 4 lakh. Now tell me, corpus should I take into consideration? No. Now tell me, 20 plus 2 minus 4 I should do, or 20 plus 2, should I do that 15% etc. on 18 or should I do it on 22? That is the first point of discussion. 85% of what should be applied? Please check. 85% of income derived during that year. Did it say after expenses? No. Income derived during that year. So my dear friends, income derived is 22 or 18? 22. This anyway will come part of the application, expenses and all are allowed. So it was Commissioner of Income Tax versus Program for Community Organization. Supreme Court judgment which said should be on 22. Point number 1. This will not come. Now you tell me how to calculate 20 lakhs, 2 lakhs voluntary contribution, 22 lakhs. In that 15% is how much? 3,30,000. What is left? 18,70,000. In that you subtract 4 lakh, other expenses, 4 lakhs. What is left is 14,70,000. Now this 14,70,000 represents 85%. That's how you should look at it. This is the as per the Supreme Court judgment. Correct? These are expenditure on activities. To actually earn this income, I have expended these 4 lakhs, right? So 14,70,000 has to be applied. Now tell me, 14,70,000 has to be applied. There can be 3 scenarios. Scenario number 1, some part of it not received only. Second one, delay in applying. Year is over already. Third one also can be any reason, doesn't matter. So guys, this is option number 1. One more is option number 2. Option number 2 is 11 subsection 2. In option number 1, two things are there. If some part of it is not received, that is what I was doing. That is this subclause 1. See? This one, subclause 1. Subclause 1 of explanation 2. Sorry, subclause 1 of clause 2 of explanation 1 to section 11.1. Read with 11b. What does it say? You will give him a declaration saying that whenever you receive it, either that year or next financial year, I will apply. You will tell that. You will apply. You will actually spend it. If you give a declaration, it will be considered as income of which year? In the year in which it is derived. Considered as income in the year in which it is derived. And if it is not spent, then it will be deemed to be the income of the previous year immediately succeeding the previous year in which the income was received. If not spent, immediately next previous year in which it was received. It will be the income. You will add it to the income. Now you see the example, you will understand coolly. In the previous year 22-23, 2 lakh was not received and a declaration was submitted that such income will be applied for the purpose when it was received or in the next year. Same in this particular example. 14 lakh 70 is not received. So I will promise that, sir, whenever I receive it, either that year or next year I will apply. Let us say I received it in 2022. Which means I should either spend it in 2022 or I should spend it in 2023. Now, if I don't spend it, when will it become an income? It will be income from the next year in which it is received. In my example, when it is received? 2022. So, when will it become income? 31st March 2023. Simple. So, here you see. 2 lakh was received in 23-24. Was it applied that year? No. Was it applied next year? No. Is not applied means 2 lakhs shall be considered as income in the previous year 24-25 next year. That's why next year in which the income was received. Got it? Second part of the story where there was a delay in applying only. I could not apply on time. Again subclause 2. Before the due date. Declaration when? Before due date of filing the return. I should again give a declaration. Here what does it say? Declaration that I have already received this year, mind you. 14 lakh 70 I have already received, but I did not have the time to apply. Such income shall be applied to such purpose in the immediately following year. And the income shall be deemed to be applied during the previous year in which the income is derived. So here I will say I have already received this year 14 lakh 70 I have received, but I could not apply. So I will promise to apply next year. If I don't, so obviously it will be considered as income this year. No problem. It will be considered in the year it is received, right? So this 14 lakh 70, I will take it as 14 lakh 70 deemed to be applied already because you have promised to apply it next year. Now if next year you don't apply, what will I do? Next year, obviously, I will deem it to be what? Income. So you see here. If such sum was not applied as per the declaration, then the amount not so applied shall be deemed to be the income of the immediately succeeding previous year. In which income was derived. When was it derived? Previous year. The next year. See the example. The trust received 4 lakhs in previous year but could not apply. The trust can furnish a declaration. The immediately preceding, shall be applied for the purpose in the next year, 23-24. In this case, 4 lakhs shall be deemed to be applied in 22-23 itself. If the income is not actually applied as per declaration, 4 lakhs shall be considered as income for 23-24. What is 23-24? Income of the immediately succeeding the previous year in which it was derived. When was it derived? 22-23. What is the immediately succeeding previous year? 23-24. Easy, come on. Now this is useless section. Why? Under 11.2. This is a useless section. Why? Why is it useless? Come on. I already told you. Why is it useless? Why is it useless? Because under 11.2, I can say that I am setting aside for a particular purpose. I am accumulating the money or setting aside the money. Here I can set aside for 5 years. I should invest it as per 11.5. All those securities I have to invest and keep it there. Then I should file a declaration. In a special case, I'll get 1 year addition also. 5 years will become 6 years. These are the options. This, my dear friends, is note number 8. Hope now you got it. Very, very simple. Note number 8. I've tried to make it as simple as possible with examples like this so that you don't have any tension while studying. Note number 7B still pending. Note number 9 pending. Let's come to note number 10. 9 will do. Yes, note number 9 later, guys. Note number 10, important. Note 10. So guys, the trust income now is always under IFOS, not under PGBP. So obviously if it's IFOS, not PGBP, accounting also is not as per Income Tax Act, but it is normal accounting. Whatever you do can be cash also. So what people used to do, conversion of black money into white money, they used to start donating in cash, expenses in cash, etc. When the assessing officer said, sir, you are expending cash every day more than 15,000 or transaction wise you're doing like 3 lakh, 4 lakh in cash, what is this nonsense? I will apply 40A3. Then where TDS is required to be deducted, you are not deducting TDS only. Correct? 40A1A if you remember. What is this? So the trust used to say, no sir, 40A3 is PGBP. I am not even considering about PGBP. 40A1 is also PGBP. I am under one IFOS. So in his last budget 2018, Arun Jaitley G inserted explanation 3 to 11.1. Finance Act 2018. For the purpose of determining the amount of application under clause A or clause B, provisions of 40A1A and 40A3 and 3A shall mutatis mutandis apply deadly. Derived from PGVP, put here. What is 40A3? Cash more than 10,000. What is 40A1A? TDS for residents. Not deducted means 30% disallowed. What is 40A3A? This is the entry where you do expense to expense payable. Then expense payable to cash. Then you cannot disallow because I am paying expense payable to cash. Expenses is not disallowed. This also is disallowed if you remember. 40A3A. All the three things are given here. Sir, what if I give trust, pay some amount to non-resident and TDS is not deducted? Unfortunately, this is allowed. Because if you see here, 40A1 is not covered. Please see 40A1A, 40A1A, then 40A3 and 40A3A covered, 40A1 not covered. So MCQ question this can be. The trust made a payment of an expenditure to a non-resident without deducting TDS. Will it be considered as application? Yes. A trust paid money to a resident without deducting TDS. Is it considered as application? No. Then one more interesting thing. Trust buys an asset in cash. We had seen in PGBP, asset is a capital expenditure. So you cannot apply 40A3. This was a revenue expenditure. But we had seen 43.1. It will not be included in the actual cost. It will be subtracted if you remember. Sir, PGBP, when we did, sir? Hey. Correct? Now tell me, can a trust buy a capital asset by paying cash and still claim it as an application of income? Possible, because 43.1 is also not covered here. 43.1 is also not covered here. Where is 43.1? Not there. 43.1 is also not there. So basically when I am applying income, towards expense on which TDS is deductible. TDS first of all has to be deductible, guys. Then 40A1A will come, resident, 30% disallowance. But guys, you may also remember one thing. In the proviso to this 40A1A, there was one dialogue. If you don't deduct TDS, SSC will be called as SSC in default under 201. However, he will not be called as SSC in default if the other person to whom you have paid, he has included in his income, he has deducted tax, he has filed the return of income on time. I told you that example. I gave it to auditor. I forgot to deduct TDS. If the auditor has deducted a tax on his own, he has paid tax, he has filed his return on time and shown that he has paid tax, then he is not called as an SSC in default. So, for example, if TDS is deducted or paid in a subsequent year, then 30% will be allowed in that. So basically, what are the exceptions to the 40A1A? One is, if TDS is deducted in the subsequent year properly, then 40A1A will not come. Or one more is what? If the person to whom I have given the money without deducting TDS If he has taken it in his income, he has paid tax, he has filed the return of income on time, then 40A1A will not apply. So these exceptions also will apply to a trust. So in simple rules, trust makes a payment to a resident expense and TDS has not been deducted. Will disallowance come? Yes, 30% will be disallowed. So will 30% be treated as application of income? No. Generally, if I pay 5 lakhs, 50K I had to deduct TDS, I did not deduct. So to the extent of how much is the disallowance? 30%. 1.5 lakh will be disallowed. 3.5 lakh will be treated as application, 1.5 will be disallowed. Now, on the other hand, subsequent year, if I have actually deducted tax properly now, if I do it properly, if there's a payable entry next turn, I'm paying it, I'm deducting tax, then no problem, 30% is pardoned. One more is what? I have paid full 5 lakh without deducting tax. The person who has received that money has taken it in his income, paid tax on it, filed the return on time, then also 40A1A will not come. We had seen it that time, I'm just revising. So trust also it will not apply. On the other hand, even if I do not file a return, even if I make a payment to non-resident without deducting TDS, a trust makes payment to a non-resident without deducting TDS, still it is valid as per that in the trust's eyes, because it is full amount is taken as application, because 40A1 is not covered. All MCQ they'll ask. Got it? Simple. Then as far as expenditure is concerned, if any payment is more than 10,000, if it is revenue expenditure, then 40A3, it is not deemed to be application of income. If it is a capital expenditure, since 43(1) is not covered in explanation 3, it is treated as application. But this note also has to be written in the exam. The entire thing, ICI how to write. If they give revenue expenditure, blindly write 40A3, not application. If it's capital expenditure, say 43(1) not covered in explanation 3. Hence treated as application. However, you can also take a view. In the exam you can write. However, a view can also be taken as, since it is purchased in cash, purchase price of the asset will not be treated as application. Even though 43(1) is not covered, it's not treated as application. This you can write as a note in the exam. Completely valid. Completely valid. Check out. For purpose of determining, same thing. Application only when there's requirement to deduct TDS. Yes. So basically, guys, if where TDS only is not applicable, then will 40A1A come? No. For donations given to other trusts registered under 12AA, there is no requirement to deduct TDS. Hence, 40A1A has no application only, obviously. So if the trust pays 1 lakh to a contractor and does not deduct TDS, but the contractor is included in income and paid tax, 40A1 shall not apply. If the trust pays 1 lakh to a contractor in previous year 22-23 and does not deduct TDS, and then 30,000 shall be disallowed in 22-23, will not be treated as application. But the trust deducts and pays TDS on 1/1/2024 next year, and 30,000 shall be treated as application of income in 23-24 next year. That's what I told you. 40A3 revenue expenditure. But capital expenditure, actual cost. As for determination of application of income, 43(1) does not apply. Hence, it can be inferred that for revenue expenditure, section 48(3) shall apply. Capital expenditure, it will be treated as application of income. But as I told you, we can write this note. Write a note as discussed. 48(3)(a). If an expenditure has been allowed on accrual basis and in subsequent year if payment has been made in cash, then also such amount shall be treated as income of that subsequent year. Trust has incurred an expense of 1 lakh in previous year 2021, which has paid in 21-22 in cash. In 2021, I have treated it as 1 lakh as application of income. But since payment in the subsequent year was made in cash for an amount exceeding 10,000, entire 1 lakh should be treated as income in 21-22. But this example now is irrelevant because of this amendment. See here. Here. Incurrence of a liability for expenditure would not amount to application. Amendment by Finance Act 20. So if you see, even shall not be considered as applied on payment basis. It should be, just because you are following any method of accounting doesn't matter. You should what? Actually pay. So that 48(3)(a) has limited relevance. That's why I just stuck to 48(3) and 40(a)(1)(a). Fair enough. Now this one. This was to appease many people in the Ram Janmabhoomi case. Finance Act 22. If the property held under a trust includes any temple, mosque, gurudwara, church or any other place of worship notified under ATG donations, the trust receives a voluntary contribution for the purpose of renovation or repair of such temple, mosque, gurudwara, church or other notified place. The trust at its option can treat such contribution as part of the corpus. They are renovating the temple and building a new temple, but they are renovating the Ram Janmabhoomi there, Ayodhya. So any money that you give there actually will be option, corpus, not included. Imagine. Such contribution shall be applied only for renovation and repair. Such contribution cannot be given as a donation to any other person. Corpus is maintained separately and identifiable. But as I told you, you should always invest in 11 subsection 5. Explanation 3A to 11.1 was added. So you see here coolly. Voluntary contribution for the renovation and repair of temples, mosques, gurudwaras, churches, etc. Donations for the renovation and repair of temples, mosques, gurudwara, etc. are received for specific purposes. It is not clear whether they are corpus or they are required to be or they can be accumulated for a maximum period of 5 years. This maximum period of 5 years is 11.2. Corpus donations are never part of 11. I already told you. Now to provide clarity, 3A has been inserted, but this is actually for Ram Janmabhoomi. That they will not tell, right? Observation. Ram Janmabhoomi, their temple was already there. Now they are just innovating it. And they are telling that I am building a temple. Right, guys. Next, come to this 11.2. I told you, there's one more method. You've been understanding that. What is the one more method? 11.2. Let's understand 11.2. You see, where 85% of the income of the trust is not applied to charitable or religious purposes in India during the previous year, but it's accumulated or set apart, either in part or whole, for a specific purpose. It shall not form of the total income if these conditions are important. Condition number 1. Statement is furnished to the assessing officer in the prescribed form and manner, stating the purpose for which the income should be accumulated. Already written it here if you remember. Purpose, accumulated, 5 years, invest as per 11.5, file declaration, same. Statement should specify the period of accumulation. Maximum is 5 years. It can be 1 year, 2 years, 3 years, maximum 5 years. Money so set apart should be invested properly in 11.5. Statement should be before the due date. Same stuff. If all the above conditions are satisfied, amount accumulated or set apart shall be treated as deemed to be applied in the current previous year. Exemption or 11(2) shall not be available if statement is filed after the due date or the return of income only is not filed. One is you should file the statement before the due date. Okay. Second one, you have not filed the return of income only. In both the cases, exemption will be withdrawn. And of course, the maximum period of 5 years for which income was being set apart or accumulated shall not include the period for which income could not be applied due to order of the court. I wanted to apply, I wanted to apply the income, but then injunction court order came. The court order said 3 months don't apply. So in that 5 years, will 3 months be included? No, it will not be included. Very, very simple. 11(2). Now one more. Exemption is withdrawn if the specific conditions are not satisfied. What are they? First, it is applied for a purpose other than the purpose for which it is accumulated, then deemed to be the income of the previous year in which it is so applied. I told I'll open a school. I put it in some other religious activity. Gone. That year only deemed to be income. Ceases to remain invested in the modes. 11(5). In all these you should invest. If you have not invested, gone. Not utilized for the purpose for which it is accumulated. So this is other than the purpose. This one, 5 years over, not accumulate, not spent. This is, it's not that it is given to somebody else, but it is not spent only for 3 years, whatever I have kept. What used to happen? No, I used to keep it for, I used to tell that I need it for a school. I will build a school, I had told, in 5 years. At the end of the 5th year, rather than building a school, I transferred this to what? Rather than building a school, what did I do? Transferred it to one more trust, which was running a school. This trust was registered under 12AA or 1023C. Then I told you I have applied. The government said the exemption is granted for you to open a school, not to donate to some other thing and then call it as application, not allowed. So specifically for section 11(2) only, they said this is not deemed to be application. This is not deemed to be application. See here. Is donated to any trust registered under 12A, 12B or any institution in 1023C, it shall be deemed to be the income of the previous year and it is so donated. 15% set apart is not subject to any such condition. They can do whatever you want with that 15%. Correct? And if any amount is donated to any trust registered under 12AA out of the 15%, then it is not in violation. It can be, I already told you, it is just an ad hoc deduction. You can do whatever you want with it, no problem. %15 can be donated. DIT exemption versus Bagri Foundation. That's the name of the case. Just for your knowledge. Just for your knowledge. Property held under trust. Property held under trust will also include all business undertakings. Tirupati Balaji Temple, Laddu, where they'll buy, sell, that is business. Isha Foundation, Isha Balm, business. Sacred Thread, business. Rudraksh, selling, business. Honey, business. Yes, income from business shall be treated as income derived from property held under trust and shall be eligible for exemption 11(1) and 11(2). That's a gross receipt. Provided that the business is incidental to the objectives of the trust and you should maintain separate books of accounts. Baba Ramdev will do yoga like this. He will put his left leg behind his head, right leg behind his head. Then suddenly he will bring noodles. He will bring toothpaste. He will bring chocolate bar. Yes, incidental to business, incidental to the trust, incidental to the objectives of yoga. Yes, 100%. If the AO determines that the income of such undertaking is in excess of the income shown in the books of accounts, so you have shown only some 10 crore, but actually you are earning 50 crore, then the excess shall be deemed to be applied to the purposes other than charitable purposes, and exemption is not allowed, and it will be concealed income. That's obvious. It will be concealed income. No exemption will be granted. Modes of investment. So guys, entire income, entire funds of the trust, that is at 85%, must be invested, including the corpus. If it is not invested, then no exemption. You can just go through this, guys. Government saving certificate, post office, schedule bank, units of UTI, CGST securities. Can you do it for, can you invest in the shares of some company? Yes. Debentures issued by any company or corporation. See this also. Shares or deposits of a public sector company. Public sector company. Can I invest in Bharat Petroleum, Steel Authority of India? Yes. Bonds of approved financial institution, approved public companies, immovable property also I can do, excluding plant and machinery, deposits with IDBI. Just go through this, that's all. In that, this one is important, that's all. Here. Plant and machinery installed in a building for convenient occupation, that is, an exception. Otherwise, you cannot invest in plant and machinery. Convenient occupation. So if you are producing laddus in Tirupati, you can have a plant and machinery to mechanize the entire thing, that is allowed. Otherwise, not. Even you'll tonsure your head and give the hair, right? That hair will be processed properly and wigs are made. So you can install plant and machinery, no problem. But normal plant and machinery all you cannot install. Where investment or deposit in public sector company has been made and it ceases to be a public sector company. For example, you have invested in Air India. Suddenly Air India is taken over by Tata. Such investment shall be deemed to be investment for a period of 3 years from the date on such cessation, or 3 years from the date on which investment becomes repayable by such company. So the moment the year Air India is taken over by Tata, let's say 2022, 3 more years you can still keep. Before that you should withdraw. Or let's say they have to pay you sometime. 2023 they have to pay you. 3 years you can, 3 years from the date of cessation or the date on which investment becomes repayable by such company. They will have to repay you anyway. From that date it is gone. Very, very simple. Apart from that, other prescribed modes of appointment, units of mutual fund under 1023C, shares of National Skill Development Corporation, acquisition of shares by a depository, NSDL ka shares, NSDL and CDSL shares, gold sovereign bonds you can buy, debt instrument. Guys, just go through. This is not important. Just go through. That's it. Okay. Let's not waste time on all these things. And I already told you depreciation will not be allowed. Depreciation will not be allowed. As simple as that. Depreciation, if you buy a car, depreciation will not be allowed under 11.6. We have already seen in the note. Now you see. I had bought an asset under section 11. When I was buying an asset, is it application? Yes. Second, I sold the asset for 100 lakh. Cost of acquisition was 30 lakh. Bought it at 30 lakh. I'm selling it at 100 lakh. Now, what happens to this 70 lakh? Is this 70 lakh also income? Income. Is this income from property held under trust? Went to Supreme Court. Supreme Court said, no, this is not income. This is not income from property held under trust because it is not held. This is income from property which has been transferred. Problem happened. It was outside the purview. Capital gains was not discussed. That is why 11(1)(a) was inserted. Hope you understood. 11(1)(a) was inserted. What does 11(1)(a) say? Where a capital asset being the property held under trust wholly for charitable or religious is transferred, capital gains arising from the transfer shall be deemed to have been applied to charitable and religious purposes. So this capital gain of 70 is deemed to have been applied to the extent below. Check it out. Capital gains, full capital gain is exempt when the whole net consideration is utilized in acquiring a new asset. I'll give you an example. Capital gains is exempt to the extent of what? Cost of the new asset minus cost of the old asset. And only part of the net consideration is utilized for acquiring the new asset. I'll give you an example, you'll understand this. Cost of new asset cannot be taken as application of income. However, cost of the new asset, if it is more than the sale price of the transferred asset, an excess can be treated as application of income. For everything, I will give you example, don't worry. See here. Check this, guys. Trust holds a capital asset which was utilized for charitable purpose and was sold on 1-3 as follows. Sale proceeds 10 lakh 80, cost of acquisition 7 lakh. See, when I had bought this, no, this would have been treated as application of income. Now this capital gain, now you see 3 lakh 80,000. Full capital gain is exempt when the whole net consideration is utilized in acquiring a new asset. What is the net consideration? 10 lakh 80 only, because there is no expenses. Now, if the net consideration 10 lakh 80 is utilized for what? Buying a new asset. See, cost of new capital asset is 10 lakh 80. Full if I use it, and cost of the old asset which was transferred was anyway 7 lakh. Amount exempt is 3 lakh 80. The full capital gain will be exempt. If I sell it at 10 lakh, 3 lakh will be exempt. 8 lakh, 1 lakh will be exempt. If I sell it at 7 lakh, nothing. If I sell it at lesser cost, obviously nothing will be exempt. Simple. But now you see. Cost of new asset minus cost of old asset. Yes. When only part of the net consideration is used. We have seen all that. Now what if cost of the new asset is more than the sale price of the transferred asset? Sale price of transferred asset is 10 lakh 80. What if the cost is 14 lakhs? Last part. 14 lakhs. So it can be divided into two parts. One is to the extent of net consideration. That is 10.8 lakh minus 7 lakh. 3 lakh 80,000 is exempt. Obviously, but the excess, guys, that is 10 lakh 14 lakh minus 10.8 lakh. 3 lakh 20,000 is treated as application of income. This is treated as application of income. Obviously, I have applied, no? I bought more. Apart from 10 lakh 80, I have still spent 3 lakh 20 more. That 3 lakh 20,000 is what? Application of income. Very, very simple, my dear friends. So this completes the first class of charitable trust. Very, very important. Please go through again. In the next class, we will continue. Very important chapter. We have finished around like 6 pages, 6-7 pages. Still 10 more pages to go. Very, very interesting. Very, very important. Right, 2-3 classes we'll do. Yes, 8 to 12 marks in your pocket. Okay. See you guys. Take care. Hi, dear friends. How are you doing? So I have a little bit of a cough and cold. So please forgive my voice. I think voice also has changed a little. Okay, guys. So in the previous session, we were discussing, if you know the BCCI session I had put up, where we have discussed, advancement of general public utility means what and all those things. So nothing much there to do. I hope you watched that video and understood the real meaning of the same. So only in that 2 clause 15 in the advancement of general public utility, they have told that business things you cannot do. More on that in a while we'll do. Let's come to anonymous donations, guys. Page number. Other parts we'll quickly finish it. We'll finish anonymous donations and see other things. Here. R12, anonymous donations. R12. So in these anonymous donations, guys, section 11 and 12 are not available. This is under section 115 BBC. This was inserted by P. Chidambaram. So generally, all these trusts who run school, colleges, hospitals, they were using the concept of trust as a front to convert black money to white money. So they used to keep a donation box, or in these big large religious, these charitable institutions, you have this donation box. In that donation box, they used to keep, and in the night they only used to put money, black money. So in the morning, 2 crore, 3 crore, 4 crore, like that. So many such companies, many such trusts used to convert black money to white money. As I told you, many international schools in and around Bangalore are all owned by large builders, because they can easily use it as a front to convert black money into white money. I'm feeling a little sick, guys, so that's why please don't mind. There'll be no difference in the quality, don't worry, but then voice is a little annoying for me only, and even I have a very bad headache, but don't worry, okay? So this is what they were doing. Anonymous donations they were putting in, right? So P. Chidambaram decided to change this law, whereby he said, if there are any anonymous donations, for them 11 and 12 will not apply. 11 and 12 will not apply. And 30% for the remaining, this whatever income that you receive anonymously, how much percentage? 30% will be the tax. Now, when this happened, major consequence was all these Tirupati Balaji temple and all these temples, came to Chidambaram and said, bro, we are also a charitable organization. Obviously, in that hundi, it's called a hundi. Hundi is also in Hindi, it's different, but generally in Kannada, they call it hundi. In that hundi, in that, donation box, we all put 10 rupees, 15 rupees, like that, 100,000. Once, I think, Amitabh Bachchan was sick or something, and he went to Siddhi Vinayak temple in Mumbai, and he put a donation of 1 crore. Imagine, they saw him put 1 crore cash. So, whatever the case may be, they are also, if you are taxing 30%, then they did not like the, religious trust did not like this concept. Then Chidambaram said, sir, sorry, I did not mean to say all trust. Let me give a more better clarity. Then he amended, certain amendments are made in this section, whereby this will not apply to a purely religious trust. So if you are a trust which is purely into religion, then this section will not apply. It will be considered as a normal donation. This is an abnormal donation. Anonymous abnormal donation. Sir, what if I am a religious trust and a charitable trust, which means I have school also, and I have religion, spirituality, etc. For example, Isha Foundation. Isha Foundation not only has, obviously the trust not only works towards spirituality and religion, more spirituality than religion, to be honest. And second part, they also have school, Isha Shala, they have, whereby, you can get trained in the other life skills rather than these normal things. So that is called as the Isha Shala. So if you see anonymous donation, means, so in those cases, what will happen? So there they say, if the donation is specifically towards, what do you say, corpus of temple, etc., then you should specify clearly. If it is for corpus of the temple and other things, then it is not taxable. Otherwise, it will be deemed to be anonymous donation. That's what. And what do you mean by this anonymous donation? So what do you mean by this entire thing? Donations, voluntary donations. We will see that. Basically, voluntary where I don't want my name to come. It mostly applies to schools and colleges. So, as I told you earlier, it was just 30% of anonymous donations. Later, they said this will not apply to religious trusts only. But some of the cases were really genuine. So, even if some schools, etc., were taking money, they were genuinely taking for the betterment of education there. So, that's why after all these adjustments, they also said up to 5% of the donations, or if it is up to 1 lakh rupees of the total donations, up to that amount, I will allow. Up to that amount, I will allow. Which means if it is up to 5% of the total donations or 1 lakh rupees, no problem. Only thing more than 5% only is a problem. So check it out. Anonymous donation means any voluntary contribution where a person receiving such donation does not maintain a record of the identity. That is, name or address of the person making such a contribution and such other particulars as may be prescribed. Where the total income of the trust includes any income by way of any anonymous donations. Where total income of the trust includes any income by anonymous donation, income tax will be how much, guys? Amount of income tax calculated at the rate of 30% on the anonymous donations received in excess of the higher of the following amounts. 5% of the total donation. Total donation means what? Anonymous donation plus anything in the corpus donation plus all general donations. Overall put together, you should take 5% out. Overall put together, you should take 5% out and 1 lakh rupees. Higher of the two. We'll see example, you'll understand. Amount of income tax with which SC would have been chargeable. Normal slab rates had this total income been reduced by the amount referred to in. So for that rates on top 30%, for remaining it is normal. For remaining it is normal. So for example, if anonymous donation is 15 lakh, other donation is 5 lakh. Overall we have 20 lakh. What is 5% of anonymous donations? 75,000. 75k or 1 lakh, whichever is what higher. So up to 1 lakh, I will not consider only as anonymous. What is the remaining portion? 14 lakh. So on 14 lakh, guys, 30% rate will be chargeable. And the remaining amount, how much? 5 lakh plus 1 lakh. Here 1 lakh will come, no? 5 lakh plus 1 lakh. For 5 lakh plus 1 lakh, what is the provision? Normal tax rates. Normal tax rates. Very, very simple. So if it is just a school, then black money is routed, so it is treated as anonymous. If a trust owns both temple and a school, if a separate donation box is kept and whatever is there for the school will be taken as anonymous, but whatever is there for the temple, it will not be taken as anonymous, as I already told you. Now, ICI has one view with respect to application of income, which we'll see, no problem. If you see wholly religious trust, anonymous donation received by wholly religious trust shall not be taxed under 115 BC. Anonymous donation received by a trust owning a temple, wholly religious and charitable trust. Anonymous donation shall not be taxable under 115 BBC unless the donation is made with a specific direction. That such donation is for any university, education institution, hospital or medical institution run by such trust or institution. So only it is generally not taxable if specifically if it is given for that what do you say, university education institution, only then it will be taxable. Wholly charitable, of course, anonymous donation will be taxed under 115 BBC. Anonymous donations that are taxable under 115 BBC shall not be entitled to any exemption under 11 and 12, obviously. And anonymous donations are not taxable under 115 BBC shall be taxable under normal provisions, of course. So anything related to a temple will not go under 30%, it will go under normal slab rates. Normal slab rates, extremely easy. So, for example, two cases will take. Anonymous donation 6 lakh, 2.5 lakh. Other donation 1, will name it as Roman number 1. 3 lakh, 60 lakh. So what is the total donation? 9 lakh, 62.5 lakh. Fair enough. Other income from property held under trust. Well, limit to 10 lakhs, 40 lakhs. Application of income after application of income including 15% is an assumption. 5 lakh, 29.5 lakh. Means how it's calculated, I'll just show you. Here down I'll write. How is this 5 lakh calculated? Just an example. Here I'll write. Mind you guys, let's write here, it's an assumption. Means how? Overall is 10 lakh other income. Plus this is how much? 3 lakh, because that is how it is charged, no? 3 lakh. Overall is how much? 13 lakh. In 13 lakh, 15% set aside, that is 1,91,000. Then others, that is 85% remaining. In that which is applied, 3,05,000 is applied, you assume. That's why overall put together is assumed to be 5 lakh. This is applied. After removing 50%, remaining some 11 lakh odd should have been applied. But in that, how much has been applied? 3,05,000. So here I am showing everything applied is how much? This much. Now let's see how to tax. How to tax. This application I will make it as 3. So what would be the taxable income? First of all, anonymous donation, fully taxable. How much, guys? 6 lakh. But in that 1 lakh benefit is there, that we'll see. Then others. Others will be what, guys? See this. First is this one, other donation, plus this one, other income, minus application. 15% ad hoc, no tax. After that, remaining 85%, in that, in my example only, 3,01,000 was, applied. So overall, full 5 lakh, there will be no tax. Only in the remaining part, there will be tax. Very, very simple. So for others, it will be 1 plus 2 minus 3. That is 3 lakh plus 10 lakh, 13 lakh minus 5 lakh, 8 lakh. Overall 14 lakh. So basically, guys, 5% of total donation, 5% of 14 lakh. 5% of 14 lakh is how much? 1 lakh 40 by 2. some 70,000. 70,000 or 1 lakh, whichever is higher. Which is higher? 1 lakh. So anonymous donation which is taxable, 6 lakh minus 1 lakh, 5 lakh. Other income. So guys, other income actually is how much guys? 8 lakh. Other income actually is 8 lakh. But if you remember here, in this only 5 lakh is being taxed at 30%. What happens to that 1 lakh? That also has to be taxed under normal rates. Yes or no? Yes. So other income here, 1 plus 2 minus 3. Other income of 8 lakh I will take, plus is 1 lakh, which was an exemption given for anonymous donation. That also has to be taxed. Ideally speaking, here I have already subtracted 15%. See here, I have already subtracted that 15%. That's why after adding those only 5 lakh is coming. So in that 5 lakh, 5 plus 3, I have already subtracted. In 8 lakh, I have already subtracted 15%. But in this 1 lakh also, will 15% benefit be given? Ideally, it should not be given, but ICAI says it has to be given. So guys, let's follow ICAI. ICAI says here you have already deducted 15%, but on this 15% is not deducted. So minus 15% of 1 lakh. 9 lakh minus 15,000. So 8 lakh 85,000. On this 8 lakh 85,000, normal rates. Normal rates. This is how we need to compute. See the next one. What will be the anonymous donation? 2.5. Overall 62.5 lakh. Yeah. What is the anonymous taxable income? Anonymous donation is 2.5 lakh. Others is 1 plus 2 minus 3. 60 plus 40. 1 crore. 1 crore minus 29.5. 1 crore minus 29.5. 70.5 lakhs. Overall 73 lakhs. Now you see 5% of 73 lakh or 1 lakh, whichever is higher. What is 5% of 73 lakh? 7.3 divided by 3 lakh. How much? 3 lakh 12,500. Correct. Total donation you have to take. Sorry guys, not 73 lakh. This is taxable income. I should see this one. No, obviously. Sorry, my bad. I should see this one. This is the total donation. I should only see donation. Other income I should not compute. Previously also my bad. I'm sorry. I told 5% of this one wrong. It should be 5% of total donations. Excuse me. Sorry. Here guys, it is 5% of total donation or 1 lakh, whichever is higher. What is total donation? Don't see total income. My bad. See this now. 9 lakh. Total donation is what? Anonymous donation plus corpus donation plus other things. What is 5% of 9 lakh? 45,000. 5% of 9 lakh is 45,000. Similarly, now I should see 5% of how much? 62 lakh 50,000. 62 lakh 50,000. Right? I hope you understood. My bad. Sorry. I did 5% of this. My bad. Because 5% of total donations they are asking. They are not asking 5% of taxable income. Because 5% of taxable income, then 14 lakh is correct. My bad, guys. Sorry. I missed it out. In that flow, I is taking 5. So, like this mistakes, if we do now, we'll lose marks. So, don't make mistakes like I did now. Deadly it will be. Okay. So, 5% of total donation. What is total donations? 9 lakh. Then 5% of how much? 62 lakh 50,000. How much will it be? 3 lakh 12,500. 3 lakh 12,500 or 1 lakh, whichever is higher. 3 lakh 12,500. right? What is the anonymous donation taxable? Up to 3,12,500 it's exempt. What is anonymous donation? 2,50,000 anyway. So it is nil. That is nil. Now tell me, other income. Other income will have, after all the adjustments, 70,50,000. It will have. Plus what I should do? Up to 3,12,500 anyway it's exempt. That's why I should add this back. Correct? So it will be same. 70,50,000 plus 2,50,000, because this will be treated as normal donation, because anonymous donation is anyway exempt. Normal donation. But for this, I've already taken 15% benefit. For this, I should give 15% benefit. So minus 15% of 2,50,000. 72,50,000 minus 15% of 2,50,000. 72,62,500. So here, normal rates. This will go at normal rates. This will be taxed at normal rates. Very, very simple. So I hope you were able to understand this concept, guys, right? So normal rates will be this. One thing is, for that 1 lakh also, important, ICAI gives 15% benefit to either 1 lakh or 5% of total donations, whichever is higher. So you give this benefit, and then for the remaining amount, charge for remaining amount. Charge normal rates. Charge normal rates. So if you open the MCQ vault and the Q&A vault, you will find many questions. Every time 6 to 8 marks they are asking. You can go through that. If you have any doubts, you can ask me. It will be similar to this only. It will be easy, but please solve it, guys. Please solve it. Right? We cannot sit and solve everything. That's why I solved you this adjustment. This is an examination adjustment only. But full-fledged problems, you solve it. Okay. Later, if you have the time, this part we will do it again. But now you please solve that on your own. Okay. Any doubts, you can ask me. Please sit and solve. Only then the clarity will be there. That's about it, guys. So see here, denial of exemption under 11 and 12. That is 13 subsection 1, page R10. When will the exemption be denied? Section 13 1A. Income from property held under a trust for private religious purposes. Entire income from such property does not ensure any benefit to the public. So guys, ultimately you should benefit the public, right? It's a private religious purpose. So only one family has a trust, and only for their religious activities they do it. Many such things are there in Karnataka and Tamil Nadu, where big families, rich families have their own trusts to do some puja and all they'll be doing every day. Correct? So that's what it is. There is this hospital called Ramaya Hospital. Ramaya was one of the leading luminaries before in the entire medical profession. Once he passed away, then there are many other deaths in the family. So there was a, what do you say, saying that some bad omen is there against your family. You should never stop any construction activity. Construction activity should be going on 365 days a year. So I'm not joking, guys. You can check with anybody also. Ramaya always in that hospital area, in and around, they'll always be constructing something. Sir, everything is constructed. They'll demolish something. They'll always be, doing it. So like that, they have a trust to manage all this. Like that, if you have a trust, and they're also into all this, they'll be appeasing all the gods. So if you have a trust where all the important pujas, etc. are going on happening, it's a private trust, only private religious purposes for your family. Then what exemption you will claim? This is obviously for the greater good. Income for the benefit of a particular religious community or caste. Yes, so if you have separate trust for only Brahmins, separate trust only for Gaudas, separate trust for only Vokkaligas, these are all, subsets or, subsects in Karnataka. So like that, separate trust if you have for caste, subcaste, etc. Obviously, it will not be there. However, what if I have a separate trust for scheduled caste, scheduled tribe, other backward classes, OBC, etc., for tribals, etc.? Yes. So there is a tribe called Soliga in Karnataka. So Soliga tribe, I mean, there are many benefits given to them. There is a separate trust for the betterment of the Soliga tribe. So of course, if you see, remember in 10th standard we had a uh, what do you say, chapter on the Soliga tribe. So I always had that practical bent of mind. So I asked my dad to take me to the Soliga tribe. So I went there and observed all those things. Then in fact I came back to my school and I took all my friends also. The entire teachers also had come. It was very nice to understand the practical aspects of the Soliga community. Right? So if you see, it just struck me now when I was talking about this. So if you see, a trust or institution created for the benefit of backward classes, scheduled caste or tribes, women and children shall not be covered under this section, which means for them exemption will be granted. But if it's only for a particular religious or charitable trust for a particular religious community, then of course exemption will be not eligible. Similarly, income for the benefit of specified persons only. I have opened this we had seen in clubbing, if you remember, guys. I opened a trust only for my daughter or my son. That will be eventually clubbed, if you remember, in clubbing. But yeah, obviously, can you claim, sir, I am opening this trust only for my education? In one of my schools that I was in Mysore, there was one girl, Bhavani was her name. Many years ago, she was my super senior. So when she was crossing the road coming into school, she was run over by a lorry. And of course, she lost her life. It was spot death. So her father every year used to give around 2,000 rupees, 1,000, whatever it is, award. It's a Bhavani Scholarship Award for any person who scores whatever well. Basically, there was an award in her name. They had created a trust. There was money being pulled in and they created a trust for there. In her name, this was always happening. So if you see, if like that for the benefit of specified person or in the memory of somebody, or let's say they opened a trust in benefit of a person who was, handicapped, or a rich person opened a trust for the pure benefit of his, ailing mother, whatever the case may be, guys, then any income of religious or charitable trust ensures directly or indirectly for the benefit of any person or any property of the trust is applied directly or indirectly for the benefit of any person. Such income shall not be eligible for exemption. Similarly, these funds also, any fund should always be invested in 11.5, as I told you. Can I use that money to buy shares of Infosys? No. Entire income shall always be, used only for 11 subsection 5. Entire such income of religious or charitable trust shall not be eligible for exemption under section 10 or 11. The income referred to in clause A to D of section 13.1, which is not exempt under 11 and 12. A to D, this entire thing, guys, deadly. If you play around there, maximum marginal rate 42.744%. Now, who are these specified persons? Specified persons. Check. This is the meaning of specified person. Yeah. So, who are specified persons, my dear friends? Let's see. Specified person means these people, author or founder of the institution. So, generally, the trust, the main trustee, the person who creates the trust is generally called as the author of the trust, not author of some book and all. It is author of a trust. Author or founder of the institution. Any person who has made a total contribution of an amount exceeding 50,000, substantial contributor up to the end of the relevant previous year. So any person who has given contribution of 50,000 and up is a specified person. Where such author or founder or substantial contributor is an HUF, then member of such HUF also. Any trustee or manager of the trust or institution. Any relative of such author, founder, substantial contributor, member, trustee, manager. So basically author, founder, then anybody who has given substantial contribution of 50,000 or more, then if it's a HUF, then member of the Hindu undivided family, then trustee, manager of the trust or institution, then of course relative of such author, founder, substantial contributor, member, trustee, manager, and all these things, and any other concern in which any of these people have substantial interest. Substantial interest remains the same, that 20% thing, same, we have already seen it before, that remains the same. And relative, already discussed, guys, same. Individual, spouse, lineal ascendant, descendant, and their respective spouses, brother, sister, lineal ascendant, descendant, spouse, brother, individual, brother, sister, their lineal ascendant, descendant, lineal ascendant or descendant plus their spouse for the individual, parents, and all these things, same. Spouse, brother, sister of the spouse, lineal ascendant of the individual, lineal ascendant or descendant of the spouse. So basically your father-in-law, mother-in-law, your parents-in-law's parents, your parents-in-law's grandparents, everything is covered. And not only that, lineal ascendant of a brother or sister of the individual or spouse of the individual. So your sister-in-law's lineal ascendant descendant, your brother-in-law's lineal ascendant descendant. So basically, it is more harsh than other sections that we have seen. Everybody is covered. No need to remember all these things, guys. They'll not give tricky questions saying that your mother-in-law has come, sister-in-law, nothing like that they'll ask. But, go through that these are the areas that are there. 13.2 specifies a few instances where income or property of the trust is to be deemed to be have used for the benefit of the person. For example, if I give a loan without adequate interest or adequate security. So basically, the trust gives to one of the relatives of the author for 1 lakh rupees loan they'll give at instead of 18% interest, they will give 16% interest. That's without adequate interest or adequate security. So they have given a 1 crore rupee loan, but they have taken a 20 lakh ka security, all those things. Allowing use of property without adequate rent, of course. So where they're, using the property, rent is not being paid, those things. Excess payment for services. He is a chartered accountant. He generally charges 20,000, 30,000, 40,000 for an opinion. This company has paid him 20 lakhs for an opinion. Weird. Inadequate remuneration for services rendered. Inadequate remuneration for services rendered. Inadequate consideration of property sold, diversion of income exceeding 1,000 rupees, all these things, guys. Investment in substantial interest concerns. Yes. 13.4 also provided some respite where aggregate funds invested in the said concern does not exceed 5%. So up to 5% you can invest. So income, basically, if you have invested in a concern in which any of these people have substantial interest, up to 5% of the capital of the concern is fine. Here capital means that concern must be firm. In such a case, exemption under section 11 will be denied only in relation to the income arising out of such investment. Normal investment that to invest, it will not be just because you invested that money. So this trust invested the money in one concern in which the author's relative only happens to have substantial interest or the author has a substantial interest. The investment will not be stopped or withdrawn, or exemption will not be withdrawn. But if any income is generated from that investment, that obviously will not be allowed to claim as a, this entire exemption as such. Now, the thing is, all that they said you cannot do it. Excess payment for services, excess payment for purchase, inadequate remuneration, right? All these things. Loan without adequate interest, allowing the use of property without adequate rent. These are some of the examples, that's all. Now, what used to happen was, let us say, the income of the trust was 1 crore. Okay. When they were applying, only services to the tune of 3 lakh rupees, was given to a related party, How much did they give that services for? They gave it for 10,000, 20,000. Basically, specified persons were covered. They gave the services at a lesser rate. Will this attract the withdrawal of the exemption? 100% yes. You will not get exemption for the full 1 crore. In that 1 crore, 15 lakhs is removed, you leave. Remaining 85 lakhs. In that 85 lakhs application, you have paid 3 lakhs to somebody. Let's say you have given a loan without adequate consideration. Now, ideally, as per the law, what does it say? That the entire exemption, they have never told such exemption. The entire exemption will be withdrawn. The income or the property of the trust shall be deemed to have been used or applied for the benefits in the following cases. Which case? This one. So, if you have given the money, loan, it means that income or property of the trust is deemed to have been used for the benefit. Which means, even if you give 1 lakh rupees, it is deemed that the full 1 crore is given. And will you get benefit for the full 1 crore? Answer is no. Deadly point. I hope you are understanding. They have never told such part of the income or property of the trust is deemed to have been used. No. They have told that the income or property of the trust is to be deemed to have been used for the benefit of a person. Right. So it is not fair now, guys. 3 lakh rupees I have given, but then you are not giving me the entire benefit of 1 crore. That's why, to ensure that won't happen, there is a proviso that was inserted. Section 13(6). It said, value of such medical or educational facilities provided to specified person either free of cost or concessional rate. Especially this happens in when loan you leave, but it happens in medical or educational facilities. So my example of loan, still full 1 crore is not allowed. But what if it's a medical or educational facility? I have given the author's son, that author's son only studying in that particular school, and they have given him a discount because he is the author of the trust. Fair enough. Educational, medical, they have a hospital, it's a MS Ramaya, and the author of the trust, Mr. Ramaya's lineal descendants or their spouse's lineal ascendant descendant, they have taken some treatment, they have given 40% off. They'll never give that to anybody else. To the tune of 4 lakhs, 5 lakhs, 6 lakhs, whatever it is. Only that portion will be deemed to be the income. So if that 3 lakh example was for medical expenses, only 3 lakh will be deemed to be income, rest it will be allowed as an exemption. Similarly, educational facilities, if I have given 3 lakhs, that will be taken as income, rest will be allowed. Got it? So such trust shall not be denied benefit of exemption under section 11. Very, very simple. So before this, we'll come to R1, then I'll come to R12. See, charitable purpose means what? So basically the previous one, in simple words, provisions of that section 13, all that benefit will not apply to deny the exemption under 11 and 12 if you are giving to specified persons educational or medical services. However, any other services, those services will be deemed to be income, other services will be allowed. So 215, charitable purpose means what? We have discussed this already, guys. Relief for poor, education. See, yoga and this environment and monument, etc. were not there before. It was all deemed to be advancement of any other object of general public utility. In that advancement of any object of general public utility, the rule was 20% of that total receipts. The aggregate receipts from that particular trust, let us say I am doing yoga, assume yoga was not there here. They said, if your income from yoga classes, etc. exceeds 20% of the total receipts, if Baba Ramdev earns 100 crore, if the income from yoga and all is 100, Baba Ramdev earns 1000 crore, if the income from yoga is 100 crore, then it's okay. Income from yoga is 150 crore, then it's okay. But the income from yoga happens to be 500 crore, then it will not be deemed to be charitable purpose, and hence you will have to pay tax under the normal income tax regulations. Obviously, there is a lot of political clout by Baba Ramdev, by Sadhguru, by Sri Sri Ravi Shankar, by Dera Sacha Sauda. So many, such cults are there, and so many such Gurujis are there. Rasaram Bapu, rapist. Dera Sacha Sauda. Ram Rahim Singh Insan is also rapist and murderer. Yes, I'm just giving you. Nityananda, Swamigal, how can we forget? Right? So guys, that's why what they did, the 20% nonsense they removed and they added yoga separately. So guys, in this 20% will not apply to any of these things. That's the most important thing for you to understand. Relief for poor, education, yoga, medical relief. Yoga now you earn whatever income, whatever percentage of the total, I don't care. Only advancement of any other object of general public utility. That's all. Is here, yes. Carrying on commercial activity shall still be regarded as for charitable purpose if such commercial activity is undertaken in the course of advancement of utility and aggregate receipts from such activity during previous year does not exceed 20%. That's why BCCI also I told. It's a trust, it seems, which means all IPL and all, is it 20% of the BCCI's income? No, mint money. Anyway. But since they do it through other cricket boards, it seems dicey. But anyway, Supreme Court has already decided on those things, which I have very much in depth discussed already. Where the gross receipts from commercial activities and 1 to 4, see, I have given already 1 to 5, exceed 20% shall still be regarded as charitable purpose. This is the reason why yoga was separately given here. Similarly, prevention of environment, etc. I know this really well because my dad is a forest officer. He served proudly in the Indian Forest Service for 40 plus years, and he was used as a carom pawn and shifted everywhere. If anybody asks me how many schools I have studied, I can say 17 schools. I have no idea where. Today, if somebody comes and tells, bro, I was your school friend, I'll first question, which college, bro? I don't know. Which school? Right? So there used to be many things called Project Elephant, Project Tiger, etc., where some corrupt people also used to be there and they used to create trusts and loot all the money. So advancement of general public utility, even though it was there, it became commercial activity, etc. So that's why to ensure that they are separately given equal weightage, because it's very important for us to protect our environment in our country. So that's the reason why that is also given separately. Monuments also, you would have seen, we don't even take care of our monuments. So there are, like recently I saw, not recently, few years ago I saw in Hampi, which is a UNESCO World Heritage Site, somebody was pushing the pillar and that pillar fell down also. That was thousands of years ago, old pillar. What nonsense, right? So what happened later? Suddenly, UNESCO World Heritage Site, they caught them and they said, let us now, I mean, obviously they were fined and all that, but they create a trust now, a private trust or a trust, whereby, I mean, a little bit control is also from the government. They will run all this. They will preserve the environment. They will preserve the monuments, places, objects, artists, etc. of historical interest. Yes, that's what they do. BCCI is the other one, advancement of any general public utility. We have seen this. Now 20% for other things, it will not work. So with this background in mind, come to R12. Just before that, we are doing before that. Note number 9 was pending. Page R3. So guys, if the income was 100, 15% is ad hoc deduction, remaining is 85. The trust applies 90. Remaining 5 extra, can it be carried forward was the question. The High Court said yes in Matri Seva. trust. In Matri Seva Trust case law, they said yes, you can do it. Obviously, government did not like it. That year, if you have spent more, why the hell should I allow you to carry it forward? Not allowed. Hence, explanation 5 was inserted. Calculation of income required to be applied for or accumulated during the previous year shall be made without any set off or deduction of any excess application of any of the earlier previous years. That's why explanation 5 was inserted there. Explanation 5 was inserted. And all the corpus donations, etc., only if it is applied that year, it will be, exempt. Otherwise, no. And 2, where will it be applied? Under 11 subsection 5 only. 11 subsection 5. One more question arose. That's why I am doing it now. R12, you come. What is the entire section? Income of charitable trust exempt under 11 and 12 if it is applied for such purposes in India and registered under 12AA, 12AB. As per the definition of charitable purpose, 215, charitable trust includes advancement of general public utility. We know. Charitable trust pursuing advancement of GPU may be a charitable trust in 1 year and not a charitable trust in the other year, depending on the percentages. So this year, if I am less than 20, I am a charitable trust. More than 20, not a charitable trust. Now this year, towards the end, it so happened that it became more than 20%. Commissioner has still not cancelled the charitable. Last year it was less than 20%. He has granted me a certificate. Next year it is more than 20. So he has not cancelled the certificate yet. If he has not cancelled the certificate, some people were taking exemption. And some people were waiting for the cancellation. Is cancellation really needed, or just that the certificate will not be cancelled but exemption will not be given? I repeat, certificate will not be cancelled but exemption will not be given. Let us say last year you were less than 20% charitable trust. This year more than 20%. Are you still a charitable trust but exemption will not be granted, or are you not a charitable trust was the question. To clear that entire confusion, 13 subsection 8 was inserted. If the trust is not a charitable on account of gross commercial receipts, if the trust is not a charitable trust on account of commercial gross assets exceeding 20% of the total gross assets in the relevant previous year, does not lead to cancellation of registration or withdrawal of approval, rescinding the notification issued. So, what did they say? The trust shall not be eligible for exemption benefit under 11.12. 13.8 ensures that the trust does not get this benefit in the year in which the receipts from commercial activity exceeds 20% of total gross receipts, is what this section says. Very, very simple. So let's see. So guys, earlier what people used to do, no, they used to take exemption under section 10 also, then take under 11, 12, 13, that also. They used to get themselves registered in 1023C and 1046. 1023C and also section 11, 12, 13. So many things were happening like that. And some people were taking registration. See, what used to happen was in the previous year 31/3/20, section 10, exempt is 10 crore. They wanted to claim exemption under 1038, but they were already registered under 11 and 12. So what to do? In order to come under section 10, they used to do violations of this section. For example, they used to buy 10,000 rupees shares of Infosys. The moment you buy 10,000 rupees shares of Infosys, what happens? It's a violation of this section. So they used to withdraw this thing. What do you say? Certificate. The moment they withdraw the certificate, then I used to go here and claim all these things. Hence, to curb that from happening. And also, you can only be granted one exemption, and it is 10 subsection 1, that is agricultural income. All other exemption, this also I have written it here, but this has to be removed. This he has written it in the proviso. Though in the main section it is still available, but through a proviso he has nullified the main section 1023C and 1046. You see, when a trust or institution has been granted registration under 12A, 12AB and is claiming exemption under 11, 12, trust shall not be allowed exemption under section 10 except 10(1). 1023C also you were able to claim it before. Now that also has stopped. See this. If the trust is registered under 12A, 12AB, registration under 1023C shall become inoperative. Mind you guys, they never say cancelled. Please don't write the word cancelled. It's just that it becomes dormant status, inoperative. The trust is registered under 1023C, registration under 12AB shall become inoperative. Reverse case. So, because of this proviso inserted in 2020 by Nirmala Aunty, this provision has lost its significance. Simple rule now. If you are registered under 12A, 12AB, whenever I say 12A, you should also write 12A or 12AB because both sections are same now. And you are claiming exemption under 11 and 12, you will not be allowed any other exemption in section 10 except agricultural income 10(1). Except agricultural income of 10(1). That's all. Then if you see, voluntary contribution received by the trust or wholly shall be deemed to be the income derived from the property held under trust for charitable or religious purposes. We have seen this, not to be treated as income. All that we have seen, guys. And it should be used as per 11.5. Procedure for registration. Process of registration is completely electronic. Unique registration number will be given. And before you have started the activities, the amended law also provides for provisional registration. These are all mere theory points. Quickly we'll finish off. Registration at 12AA has perpetual validity, whereas 12AB registration is valid for 5 years. So whether you go for 12AA or 12AB, registration, depending on various factors about your genuineness of activities, etc., you can either be granted at 12AA or 12AB. PCIT, CIT can call for documents or information or make inquiries as he thinks necessary to be satisfied about the genuineness of activities or compliance of requirements. So if you see 12AA versus 12AB, all these things. Existing trust or institution registered under 12A or 12AA on or before 30th/6/2021, because these are all the new act, and they will pass the order within 3 months from the end of the month in which application was received. So if you gave it on 30/6/2021, 3 months, 7, 8, 9, 30th September. Whether PCIT can make any inquiry? No. Period for which registration shall be granted? 5 years. New trust applying for registration at 12AB 1 month prior to the commencement of the previous year relevant to the assessment year for which the registration is sought. 1 month prior to the commencement of the previous year. 31/3/2023, you are seeking for assessment year 23/24. 1 month prior to the commencement of the previous year, 1st April 22. 1st April 22 to 31st March 23. 1 month prior to the commencement of the previous year, relevant to the assessment year for which registration is sought. I am seeking registration for assessment year 23-24. So when should I apply? Before 1 month prior to the commencement of the previous year. 1/4/22. So what is 1 month prior, guys? 28th February 21. Obviously, 1 month prior. Sorry, 28th February 22. 28th February 22. So that is 1 month prior. 1 month from the end of the month in which application was received, that is the time limit for him. Here also no. And what is what period for which registration shall be granted? 3 years from the assessment year from which registration is sought. This is called provisional registration. 3 years from the assessment year from which registration is sought. So technically 3 plus 1 is what you will get. Because when I use the word from, I should exclude the assessment year. Trust which has provisionally registered under 12AB and is seeking for final registration 6 months prior to the expiry of the period of provisional registration or within 6 months of commencement of its activities, whichever is earlier. So provisional registration will be 3 years that they are given now, 6 months before it ending, or if they have already started off the activities, whichever is earlier, 6 months prior to that, you have to seek for final registration. You can't just go, tomorrow is expiring, you cannot go there today. It should be done before only. Same here also, 6 months from the end of the month in which the application was received. And here in this case, period for which registration shall be granted, guys, 5 years from the assessment year in which provisional registration was granted. Trust registered under section 12AB, where the period of registration is due to expire. In the previous case, it's already there, 5 years you are registered, it's due to expire. Then 6 months prior to the expiry. And within 6 months of whenever you have received it, they have to give. Again, for 5 years, they can extend. Trust whose registration has become inoperative due to approval under section 11.7. Right? You are playing around, going there. We explained, no, 11.7 before this one. You have shifted to 10.23C. That's why this has become inoperative. Then what to do? 6 months prior to the commencement of the assessment year from which registration is sought to be made operative. Prior to the commencement of the assessment year, 23-24, 6 months before, 30th September it will come. 6 months from the end of the month in which, so this you have to remember, guys, unfortunately. So just go through that couple of times, you will know. Trust which adopted modifications of the objects. Objects clause had some problem and they have sought for modification. In those cases, if it is not conforming to the conditions, 30 days from the date of adoption of modification, you can seek further registration. And within that, from that day, within 6 months, they will grant the approval. And here I can ask for all the documents. In these previous 3 cases, 4 cases, you can ask for all the documents. So study this chart and go, it will be easy. Check it out. Trust created on 10/6 months avail exemption from assessment year 23-24. Trust can avail exemption from 24-25 onwards by making an application 28/2/2023. That is 1 month prior to the commencement of the previous year, that is 31/3/24, relevant to the assessment year for which registration is sought. The trust is not mandated, so this is important. Follow these examples, guys, important. The trust can avail exemption from assessment year 24-25 onwards by making application by 28/2/2023. That is 1 month prior to the commencement of the previous year, that is 31/3/24, relevant to the assessment year for which registration is sought. The trust is not mandated to commence its activities or prove anything to the PCIT or CIT. Whatever example I gave you, people were following this. Now you know why it is wrong. That's why this was a CBDT clarification. That's why I'm telling it's important. This example I have copy pasted from there. So you follow this. Provisionally, they will register the trust by passing an order by 31/3/23. There's 1 month from the end of the month in which the application was received. This was the end of the month. 1 month is 31/3/23. In order to make registration final, trust is required to file application for final registration at least 6 months prior to the expiry of the period of provisional registration, 39/25, or within 6 months from commencement of activities, whichever is earlier. If the trust has commenced its activities on 1/1/2025, 3925 or 1125, whichever is earlier. So what is it? Whichever is earlier? 1125. So here, sorry, 3925 or commencement of activities, 6 months from the commencement of activities. So the trust has commenced its activities on 1125, 6 months before. Application for registration should happen 3625 or 3925. 6 months from the commencement of activity. So 3625 or 3925, whichever is earlier. So this is earlier. He has to pass an order within 6 months, that is by 31/12/25, granting the registration. The trust has commenced its activities on 1126. So that's what? 3626 or 3925, whichever is earlier. So that is 3925. Same. So follow this, guys. Becomes very, very simple. Very easy. It is trust. These are all theory stuff. That's why I am going fast. No point going slow and wasting your time. Where a trust or an institution has been granted registration under 12AB and subsequently commissioner is satisfied that there is occurrence of one or more specified violations. He has received a reference from the AO and a second proviso of 143.3 for any previous year. Notice scrutiny. Such a case has been selected in accordance with the risk management strategy formulated by the CBDT for any previous year. The commissioner can call for documents or information or make inquiry by an order in writing, and after giving an opportunity of being heard to the trust, cancel the registration for the previous year and all subsequent previous years if it is satisfied that specified violation has occurred. Cancel the registration. Pass an order in writing refusing to cancel the registration if he is not satisfied about the occurrence of one or more specified violation. The order shall be passed within 6 months from the end of the quarter in which the notice is issued or on or after 1/4/22 calling for information. 6 months from the end of the quarter in which the notice was issued by the commissioner on or after 1/4/22 calling for information or making the inquiry. Excuse me. Right? 6 months from the end of the quarter in which the first notice was issued by the commissioner on or after 1/4/22. He called for the information on 1st May 22. What is the end of the quarter? April, May, June, 30th June. From there, 6 months. It is 31st December. Like that you should see. What do you mean by specified violation? First, if it has not applied, income has not been applied for the objects of the trust. Obviously, directly it will become specified violation. Where income from business is not incidental to the attainment of the objectives of the trust. Second one. Where separate books of accounts are not maintained by such trust in respect of business, which is incidental to attainment of main objects. So as we have told, even though you have other objects, that separate books of accounts have to be maintained. Otherwise, it is a problem. What? It will become a violation. That the trust has applied any part of its income for private religious purposes, or that the trust has applied any part of its income for the benefit of any particular religious community or caste. Not allowed. I mean, you can do it, but you will not get any exemption. Where any activity carried out by the trust is not genuine or carried out in accordance with the conditions subject to which it was registered, where the trust has not complied with any requirement of law. What will happen? Trust should be registered under 12AB, basically, where total income of the trust without giving effect to 11 and 12 exceeds the basic exemption limit. Books of accounts and other documents have to be kept and maintained in the prescribed form, and also accounts have to be audited. So guys, the basic exemption limit is 2,50,000. If your total income exceeds that before giving any exemption, then obviously you have to maintain books also, and you have to get the books audited as well. The trust should furnish the return of income under section 139(4)(a) within the due date. We had seen this. Notes. Exemption under section 11 and 12 shall be available as follows. Instances under 12AB. Instance 1. For assessment year for which the trust was granted registration earlier. From the, so basically if it was granted earlier, from that year only you will get the letter today, but the granting date was earlier. So from that day only you will get. From the assessment year relevant to the previous year in which the application is made. From the first assessment year, basically they are talking about 12 AB, this one. These instances, 6 instances. So from here, from which year you will get, that's what they are trying to tell. You will get it from assessment year in which the trust was granted registration letter. Second one, from the assessment year relevant to the previous year in which the application is made. Second one. New trust applying for registration. Third one, provisionally registered already and now applying for fresh, proper registration. From the assessment year, first assessment year in which it was provisionally registered. From that year only you will get like that. Exemption under 11 and 12 shall also apply for any assessment year preceding the assessment year for which assessment proceedings are pending before the assessing officer as on the date of registration and objects remain the same. So even though assessment proceedings are pending before the AO, still you will get exemption, no problem. No action under section 147 shall be taken by AO for non-registration of trust. You cannot say income escaping assessment just because you have not registered for any preceding assessment year preceding the aforesaid assessment year. Notes 2 and 3, this one shall not be applicable in case of a trust which has refused registration or where registration was cancelled at any time. So guys, pending registration, all these you can do, but it was refused registration because it was doing some terrorist activities, for example, or it was cancelled at the last time under 12A, 12AB, 12A, 12AB. So obviously, can you go ahead with it now? No. Trust was formed on 1/1/2007. Did not apply for registration at 12A. Applied for registration at 12AB. That is for not for perpetuity but for 5 years. On 28/2/2023 and registration was granted on 31/3/23. Provisions of 11 and 2 will apply to which one? Previous year 23/24 only. That is assessment year 24/25 for 5 years. The trust claimed exemption 11 and 12 in the return of income for assessment year 17/18 to 23/24 and the objects and activities for the trust are the same and have not changed. On 31/3/2023, the date of registration, many things happened. What happened? Case of assessment year 22/23 is pending before the AO. No problem. Shall allow the exemption under 11 and 12 for assessment year 22/23 since objects and activities are the same. So that is important to see. Objects and activities of the trust must be same. Cases of 19, 20 and 2021 have been completed by AO under 143.3, disallowing exemption under 11 and 12 and assessment orders were passed. Appeal is pending. Guys, appeal if it is pending, nothing can be done, but the assessment procedure is over. Hence, no relief to the assessee for assessing assessment year 19, 20 and 2021 as the cases are not pending at all in the assessment. It should be pending in the assessment. If you have preferred an appeal, that's not called pending. You have preferred an appeal against the order. So that assessment should have been over already. Case of assessment year 2021 has been reopened under 147 for disallowing exemption under 11 and 12. The case is pending. So AO will drop the proceeding under 147 for assessment year 2021 if the case was reopened under 147 only on the grounds of non-registration. If it is not non-registration, if they say they are using it as a front, that trust, but behind they are doing other nefarious activities, dangerous activities, then nothing can be done. This is just for non-registration. Can I drop proceedings? Yes, I can drop proceedings under 147. AO wants to reopen cases of assessment year 18/19 and 19/20 on 10/4/2023 under section 147. Yes. AO can issue if it is other case, but he will not issue notice only on grounds of non-registration of trust. So this will cover almost all the cases, guys. It becomes very easy. All that we have done already, anonymous donations, etc. BBI, etc. will do. Come to this, page R13. Exemption for income arising to. This is exemption under 1023C. You can register under 12A, 12AB, or you can register under 1023C. If you register under 1023C, you follow this chart, more than sufficient. Educational institutions or universities existing solely for educational purposes and not for the purpose of profit. Hospitals or medical institution existing solely for philanthropic. Phil means love, anthropos means mankind, human being. So charitable purpose. and not for the purpose of profit. Other fund, institution, trust, university, education institution, or hospital for charitable purposes, other things. If it's an educational institution or university existing solely for educational purposes and not for purpose of profit, wholly or substantially financed by the government, 1023 3AB. If it is financed by the entire government, guys, no approval is required. Section 11 is also not applicable. It's a government run trust. What you will give exemption, what you will apply, nothing needed. Aggregate annual receipts do not exceed 5 crore. If the aggregate receipts do not exceed 5 crore, no approval or registration, section 11 also will not apply. Which means, when will it apply section 11? Only if it exceeds 5 crore. This is for which one? Educational institution. Hospital or medical institutions, wholly or substantially financed by government, again no approval required. Aggregate annual receipt do not exceed 5 crore, again no approval registration required. But this approval and registration applicable, same as 11, 12, 13, VBC, same thing. This we have seen already. It will apply. Obviously, it will apply. Registration procedure also is the same. Scenario 1 to 4, same thing. So, if an institution is engaged in imparting education, somehow makes profit also, would it mean that it is ceasing to be a, what do you say, charitable organization? No, there are many such cases. Supreme Court case also told that it is not the case. Like that. The trust engaged in execution contracts awarded by Indian Railway for cleaning train coaches and railway stations, for which it engaged poor people. It was held that the trust was not engaged in charitable purpose as the activities were commercial in nature. So they hired poor people, they cleaned, they got the money, they gave some peanuts to these poor people. No, it was not for any charitable purpose. Where seminary trainings were given to the student priests. So for the priest to give their, what do you say, seminars, that is called seminary trainings. Priests will give a lot of, talks, etc. That is called seminary training. They are given to make student priests who head churches as religious leaders practicing and propagating religion as a profession is an educational process. An institution shall be eligible for deduction under 1023 CS. It's an educational process. In the first class only I told you, if you are a priest, it will become like a profession. It's not necessary for an education institution to be established in India. However, education activity must be carried on in India. This is Oxford University Press, long back case law. Sabarmati Ashram Goshala Trust also, where the main object of the trust was to breed cattle and to improve their quality to promote agriculture, objects would fall under section 215. Merely because certain incidental surplus was generated would not render the activity commercial in nature. Exemption granted. Mere promotion of entertainment events by sport activities will not be covered under 215. So, promotion of activities, sports activities, etc. You cannot run a trust and say, I'm only promoting sports activities. 215, no. Promotion, no. Do you organize sports? Do you have a separate training center where I can deem it to be an education for the, sports person? All that you have to consider. 85% income which is accumulated, I told you, Bagri Foundation already discussed. 85% income which is accumulated cannot be donated to another charitable trust. However, 15% you can do whatever you want with it. It's an ad hoc exemption. This I told you, Queen's Education Society. Just now I told you, I didn't tell you the case law. First case is what I discussed. Where an educational institution engaged in imparting education incidentally makes profit, does not mean that the institution ceases to exist for educational purpose. Distinction is to be drawn between making of surplus and activities being carried out. So just because you are carrying on those little extra activities making money doesn't make you lose the concept of charitable organization. So other small things are there, which I think we can see it in the next class about all these things. We can finish it off. So one more session, and along with that ATG also will connect and finish. One more session of some half an hour, 40 minutes, maximum 1 hour. Trusts are over, guys. Then we will see what to be done. Okay, see you. Hi, my dear friends, how are you doing? So my cold is still not gone. I would have sensed the change of voice as well. All right, guys. So let's wind up with this particular chapter, charitable
institutions. If you remember, we had done all these things in the previous class. So today we will be starting off with special provisions relating to tax on accreted. Accreted means, accumulated or increased income of certain trusts and institutions. In simple words, trust you will get exemption always. But then when will you not get exemption? When would you not get any exemption? You would not get any exemption when the trust is no longer registered as a trust, or registration is withdrawn, or you've seen our particular conditions of registration. If you have violated any of those conditions where your registration has been cancelled, withdrawn, inoperative, all these things you have seen different wordings. So will tax come on if the what do you say, a trust becomes inoperative? Will tax come on if trust registration gets cancelled, etc.? Anyway, but predominantly yes, on cancellation it will come for sure. This entire process is nothing but the exit tax, is what we are going to discuss. Exit tax. So basically, if a trust is no longer a trust, you have to pay some tax called as the exit tax. But practically what happens, there is trust PJ. P and J are the trustees. There is one more trust, two people, KD fellows. They have some 50 lakh black money. Correct? So this trust PJ also has around assets, etc., worth around 50 lakh. This is white. So if I cancel this trust, I have to pay tax on this. Instead of that, what we do, I will coolly exit from this trust. Trust will remain. This K and D fellows will enter this trust. I will coolly exit and take this black money. P and J will take the black money and go. So for them, white money is converted to black money, and they don't have to pay any tax on this trust income. And for KD fellows, their black money is converted into legitimate white money, legitimate money or white money. They wanted that. They wanted to convert black to white. So people like this do this, guys. Many of my friends do all these things because in the center we have a chartered accountant who will do the deal. Right? That's how we know all these things. Practically this happens. So nobody will endeavor to pay 115 TD. 115 TD is what? In simple ways, if this and all was not there, PJ is now, trust PJ is exiting. They're saying, boss, I don't want to have any trust over. So whatever this income is there, on that 115 TD tax you have to pay, because all these years you have taken exemption. Now what exemption? No exemption will be granted. This was the ideal scenario. Okay. So assuming all this golmaal doesn't happen, what is the exit tax is what we need to understand. Let's see that. 115 TD. Whatever I told you now, this one is out of syllabus. Don't write all that in the exam. Right? Yes. 115 TD. Let us see. So let's try to read the section to understand the gist of the story. 115 TD. 115 TD. Notwithstanding anything contained in this act, where in any previous year a trust or institution registered under 12AA or 12AB. I told you procedure for registration is 12AA. Fresh registration has come under 12AB. Both we have seen. You can register afresh. Converted into any form which is not eligible for grant of registration under 12AA or 12EE. Means the commissioner has cancelled it. You have modified the objects clause, then you have filed under 46(3), all those things. Merged with any other entity other than the entity which is a trust. So you have merged with some other entity which is a non-trust, then gone. Failed to transfer upon dissolution all of its assets to any other trust or institution registered under 12AA or 12AB, or to any fund or institution or trust or any university or other educational institution or any hospital or other medical institution referred to in clause 4 or 5 or 6 or 6A of 23C of section 10 within a period of 12 months from the end of the month in which the dissolution takes place. Yeah. So if you have not transferred upon dissolution all the assets etc. to one more trust which is doing the same similar activity, or anything registered under 1023C which is exempt under 1023C within a period of, when should you transfer? 12 months from the end of the month in which the dissolution takes place. Dissolution is happening in February. So February end of the month plus 12 months. Like that you should. If you haven't done this, these are the 4 circumstances. So you should remember these circumstances. Convert into any other form, which means what? Commissioner has cancelled the registration because of that, or you have modified the object. That is, you have converted to any other form. If your object only is modified, which is you are no longer in the form of the charitable organization. Merge with any other entity which is not in the similar line of business. Fail to transfer upon dissolution any assets. On these 3 scenarios, what will happen? 115 TD will come into the picture. 115 TD will come into the picture. Now, you see here, will this also come? If your registration has become inoperative, most important point, if the registration has become inoperative, what do you think? Under 11.7, under 11.7 guys, so they can ask you an MCQ. We had told under section 11 subsections, and I'll show you that you will recall easily. 1 second. Yes, where a trust or institution has been granted registration or has obtained registration any time, the said registration is in force. Nothing contained in section 10 shall operate to exclude any income derived from the property. So we had discussed this 11.7. Here again, provided that trust or institution whose registration has become inoperative under the first proviso. Such registration shall become inoperative from the date on which the trust or institution is approved under 1023C. I told you people were taking double benefit. One under your 11-12 you were taking benefit, then again under 1023C you were taking benefit. Arun Jaitley cut that in 2018, said it is not possible. So then I told you, if you have already registered under 11 and 12, you will not be eligible under 1023C, or if you have jumped to 1023C, what happens to your registration in 11 and 12? It becomes inoperative. The key word here is inoperative, not cancelled. Now linking that to this, will you have to pay exit tax? Will you have to pay exit tax if your registration becomes inoperative? Answer is no. It's a very important point. Answer is no. No tax, no exit tax if it becomes inoperative, because I'm not cancelling the registration. This point number 1 is cancellation of registration. It has got nothing to do with 11 subsection 7. Okay. So I hope you understood that. It is not for inoperative. If it's inoperative, it's okay. It doesn't matter. Is what this section says. Check the notes. Trust or institution registered under 12A, 12AB shall be charged additional income tax at MMR. 30%, 12% plus 4%, 34.944% will be charged, guys, on the accreted income as on the specified date. So when case 1, trust or institution is converted into any form which is not eligible for grant of registration under 12A or 12AB, 2, trust or institution merges with any other entity as discussed. Case 3, which has failed to transfer all the assets and liabilities on the dissolution date within how many months? 12 months. From the end of the month in which the dissolution takes place. Yeah. So trust or institution converted into any other form and not eligible for registration under 12A or 12AB. This happens when what? registration granted to a trust or institution under 12A or 12AB has been cancelled, as I already told you, or it has adopted to modification of the objects which do not conform to the conditions of registration. Yes, so it has changed the objects then. And even if it's changed the objects, it's okay. But if it has not applied for fresh registration under 12AB, which we have seen, or which has filed for fresh registration and the application has been rejected. These are the circumstances. So only then exit tax has to be paid. Tax on accreted income. Accreted income means basically the value of the assets at the end of the day will be in addition to the income tax payable by the trust on its total income. Income tax calculation is separate. This is separate. This is for all the value of the assets which you are taking exemption all these years. Obviously 15% normally you will take, plus then 85% if you apply, that also you will not pay. Only extra if you would have paid, that you leave. Apart from that, all the accumulated wealth that you have made all these years, you need to pay, bro. That's all. Very, very simple. Right. How much? We'll see. So what is the entire calculation of this accreted income as on specified date? FMB of total assets of the trust. Note number 1, this one. And total liabilities of the trust. Note number 2. That's it. FMB of the total assets minus total liabilities is what you need to see. Assets shall not include, 3 exclusions are there. Just remember those 3 exclusions. Assets acquired out of agricultural income. Obviously, N1, agricultural income, any asset acquired out of that agricultural income should be excluded. Assets acquired by the trust from the date of creation of the trust to the date from when registration became effective under 12A or 12AB. Those assets also will not be taken into consideration. You were running a trust in 1980, but you got registration only in 1992. Fair enough. That time the rules were different. Registration was not mandatory. So these 12 years, whatever assets have accumulated, why the hell should I pay tax on that? That will be excluded. Okay. Assets transferred on dissolution to other trust registered at 12AA within a period of 12 months. Of course, if you have already on dissolution transferred it within 12 months, then no tax. Because if it is not done beyond 12 months, only then here. If it is not done, correct, which has failed to transfer within a period of 12 months, only then you have to do it. Otherwise, these assets are not to be included. Trust was created on 1/7/2010 under 12A, but registration became effective on 1/8/2016. As I told you, 6 years assets acquired shall not be included in the total asset. Liabilities. Liabilities are what? Liabilities related to the asset in note 1 above also shall not be taken into account. So, any liabilities associated with these assets. Assets acquired out of agricultural income. You have bought a house out of agricultural income and then there is a loan against that. So, that loan should not be taken. Like that they are telling. Right? Specified date. Now, what is the date here? These 3 dates are also important. Case 1. Converted to non-eligible form. So, date of cancellation of registration or date of modification of objects of the trust. Correct? That is the time, that is the date when you need to pay. Because if you see here, on the accreted income as on the specified date. When should I compute? First of all, what is accreted income? We have seen. Then what is the specified date? This date. Dates are also important, guys. Converted to non-eligible form means date of cancellation of registration or date of modification of objects of trust. If you are merger with another entity, date of merger. Dissolution, date of dissolution. That's all. Very, very simple. What are the due dates? So this is the date on which you will compute the accreted income. This year is the date on which you will actually pay, due date of payment. Case 1. Converted to non-eligible form. Registration granted under section 12A or 12B has been cancelled and trust has not filed an appeal to ITAT. So if you cancel the registration, you can file an appeal to ITAT against the order of cancellation. Let's say in this example, you have not filed any appeal to ITAT. Then 14 days from the date on which period for filing appeal to ITAT against the order of cancellation expires. Time limit for filing appeal is 60 days, guys. So the day you receive the order of cancellation, 60 days you need to wait. And 60 days it's not there. So when can you actually, when should you pay? 60 days are over now. So like today you received, 60 days is the time for you to file an appeal to ITAT. You have not filed the appeal to ITAT. So it has become time barred from the end of the 60th day, 14 days. 14 days from the date on which period for filing appeal to ITAT against order of cancellation expires. When did it expire? 60 days. 60th day it expired. 14 days more. Registration granted 12A or 12AB has been cancelled and the trust has filed an appeal to ITAT. ITAT by its order confirms the order of cancellation. They say, yes, you are right, it has to be cancelled. 14 days from the date on which the order of ITAT confirming the cancellation is received by the trust. Correct? It is not the date of the order, it is when you have received, trust has received. Order date is, let's say, 10 Feb. You receive it on Valentine's Day, 14 Feb. So 14 days from which day? From this day. You have to pay the tax. Registration granted at LA has been cancelled and the trust has filed an appeal to ITAT. ITAT by its order quashes the order of cancellation. They said it cannot be cancelled like that. So in this case, 115 TD is not at all applicable because it's not cancelled. Trust is not required to pay any tax, obviously. Then you don't tell 14 days from the day you receive. No, don't write all those things. Trust has adopted modification of its object which does not conform to the conditions of registration 14 days from the end of that particular previous year, where the trust has not applied for fresh registration. So end of the year will always be 31st March. So 14th April you need to pay. Trust has adopted modification of its objects which does not conform to conditions of registration and trust has applied for fresh registration but the application has been rejected. If you have filed an appeal or if you have not filed an appeal, what to do? 14 days from the date on which the period for filing appeal to ITAT against rejection expires. 60 days again time is there. If it expires, 14 days from that day. Or if you have actually, filed an appeal, then same. 14 days from the date on which order of the ITAT confirming the rejection is received by the trust. If appeal is filed by the trust and ITAT confirms rejection. Same thing. If it's merged with another entity, 14 days from date of merger. Dissolution means 14 days from the date on which 12-month period expires. 12-month period expires. Same. These dates are important. Just keep them in mind. Let's take an example of the timelines. Examples. I'll name it case 1, case 2. Registration granted to trust has been cancelled. Let us say order of cancellation 14th August 2021 received by trust 17th August 21. Time limit for appeal 60 days. 16th October 21. Under that, we can have three situations. Right, this is case 1. Three situations. In this, ITAT quashes the order. Order received on 15/7/22. No 115 TD because there is no tax on accredited income. Second, ITAT confirms the order. Received 15/7/22. So guys, important to know the specified date. Accreted income will be calculated on this date. This is the order of cancellation. Accreted income calculated as on specified date, that is 14th August 21. But tax paid on or before 14 days from the date on which this order comes. 29/7/22. 14 days. 29/7/22. Trust does not appeal. So accreted income will be as on 14/8/21. That doesn't change obviously. But tax will be from which day? 14 days from the end of 60 days. When did the time limit expire? 16/10/21. That is 16/10/21. So what is the time limit of paying 115? Same this 16/10/21 say 14 days. TD 30/10/21. 30/10/21. Very, very simple. Done. Case 1. Case 2. It has adopted or undertaken modification of objects. In that, there is no space here. Has not applied for fresh registration. Has applied for fresh registration and that is also cancelled, or you can say application has been rejected. Application rejected. So if the, let's say the trust here modified objects on 14th August 21, it has to apply for fresh registration. Time limit to apply for Fresh registration is the end of the previous year. And assume it has still not applied. Now accreted income will be the same. Accreted income as on 14/8/21, date of modification. And 115 TD, 14 days from the end of the previous year or the end of the financial year. That is 14th April 22. All examples I am giving becomes very easy for you. Last year has applied for fresh registration and application has been rejected. Fresh registration applied on 16th August 21. Rejected on 14/9/21. Received the rejection on 17/9/21. Appeal filed. No appeal filed. No appeal filed means tax will be on which date, guys? Same. On the day here you have modified. It's modified its objects on 14/8. I'll write here also. Modified on 14/8/21. So if you have not filed an appeal, accreted income as on 14/8/21, tax will be 14 days from the end of the period in which you can appeal. You can appeal when, guys? Appeal could be filed up to which date? You have received the order this time, no? See? Fresh registration you applied. You rejected it. When did you receive? Obviously, when you receive it only, within 60 days you can file an appeal. So tax will be 14 days from last date of appeal. Last date of appeal could be what? That is 14 days from 16/11/21. So 30/11/21 is the last date. I mean, that is the date you have to pay tax. This is the date you have to pay tax. If appeal has been filed, ITAT confirms rejection. On 13/7/22, received the confirmation on 15/7/22. So accreted income as on which date? 14th August 21. Tax will be 14 days from this one, 15/7/22, which is 29/7/22. All things covered, guys. Beyond this, they will not ask anything. Don't worry. All these are exam questions. The master chart, time limit. Right? Hope you understood. Very, very simple. Alright, guys. Hope you got the entire structure. Okay. Now, here we have written, no, what have we written? Accreted income on the specified date. How, what is accreted income? Fair market value of the total assets of the trust. How will we calculate the fair market value? Guys, remember we had done one rule in 5627, rule 11 UA. Same copy paste with some changes. Control C, Control V with a few changes. That's why that rule 11 UA was very, very important. We had done it that time. Same, no change. So let's see. Check it out. Aggregate FMV of total assets of the trust institution advance tax. First one you see. TDS, TCS, advance tax reduced by refund if any and unamortized deferred revenue expenditure not included. That shall be the following. Valuation of shares and securities. FMV of quoted shares and securities. Average of the lowest and highest price. So guys, in rule UAE, this was one change. In rule 11 UA, not UAE, sorry, UA, 11 UA, it was the lowest. Here it is average of the lowest and highest. Right? Where there is no trading, then the average of highest and lowest on a date immediately preceding that date. Valuation of unquoted shares. The same, A plus B minus L by PE into PV, same thing. Here, book value of all the assets other than B excluding TDS and all these things. FMB, A is the book value, same thing. B, FMB of jewelry, bullion, precious metals, artistic thing, all that similar, no change. Third, book value of the liabilities excluding paid up capital, amount set apart for payment of dividend, reserves and surplus, even if the resulting is negative, other than reserve for depreciation, provision for taxation, other than TDS, TCS, advance tax as reduced by, provision for unascertained liability, provision for contingent, same. It is the same, no change. One thing guys, here in rule 11 UA, liabilities will include dividend payable on preference and equity shares if declared before the date of gift. This extra point was there. I'll show you. Check this. Come to D11 guys. D11 we had discussed rule 11 UA. In that you see here. Lowest price. Here it is lowest and highest. Point number 1, first change. Second change in the liability part, everything else remains the same. Liability part here. Dividend on equity and preference shares where such dividend have been declared before the date of transfer at a general meeting. This dialogue was there. This dialogue is not here. Check this. Dividend point is missing here. Dividend point is missing. So book value of liabilities excluding these things. There, that part was there here, you see. But not including the following amounts. The dividend part was excluded here. Here it is not excluded. One more important change. Shares and securities is the same, FMA or NRV. Immovable property, you see. Here, immovable property, guys. STV of immovable property only. Only the stamp duty value was there here. Only the stamp duty value was there in that particular thing. Here you see. Stamp duty value or FMV of such immovable property, whichever is higher. That's the third change. First change is lowest and highest. Second change is that preference share and equity share dividend that is missing here. Third one, immovable property, it is stamp duty value or FME, whichever is higher. Other things remain the same. So capital fund, corpus fund, aggregate book value of liabilities, etc. does not include this. Obviously, capital fund, corpus fund is totally different. Reserves and surplus or excess of income, provision for contingent liability, provision for unascertained liability, all this the same, guys. The following shall be a liability: provision for income tax less excess provision, TDS, advance tax, self-assessment tax, add income tax refund, same. So, when an asset on which accreted income was computed and tax was paid on 15 TD is transferred, what is the cost of acquisition for calculating shall be the FMV of the asset taken into consideration for computing the accreted income. Very simple. So, since I am paying tax on this FMV, when I sell it off also, what will be the cost of acquisition? That particular FMV. Interest on non-payment, 115 TE, 1% per month from the 15 days calculated if tax is actually, till such date where tax is paid. So 14 days due date, 15 days onwards, interest also will come. And the particular trust will be deemed to be SSE in default. The tax is not paid on 15 TD. The principal officer, trustee, trust of such institution shall be treated as SSE in default. In case of dissolution, transfer of assets to the recipient trust, such recipient trust shall also be treated as SSE in default if they do not follow the provisions of this particular trust. The trust taxation. So that completes trust, guys. That's it. All this will come for minimum around 10 marks. So you can solve the previous year's questions. Many such questions will come. Every time they keep asking. We have solved all the examples here. So try solving the questions from the Q&A vault. You will be able to answer them. Okay. Please solve them without fail. Okay, guys. So next session we'll do some miscellaneous concepts, all chaubat. And after that we'll take a short break from DT because 60-65 marks are already over. After the next session, 60-65 marks will be over. So then what we can do is the remaining 5 to 10 marks we'll see later. I want to start off with international taxation. So let's finish international taxation and then come back to those small topics. Okay. Because we have done everything extremely in depth. So we will stop after the next session with respect to direct taxation. We'll stop. Pending will be some MAT, AMT, small things. It will not take time. And some amalgamation, demerger, small concepts, guys, won't take time. Roughly around 10 marks, 5 to 10 marks, because we have already covered major portions. But international taxation, since it's there for 30 marks, which you have to study, we'll go 20-25 hours, we'll finish that, 20 hours around, and then come back to those small concepts. Okay, fine. So next is will be all the miscellaneous, important chapter, all miscellaneous. Everything, whatever we had missed out, we'll finish it off. Apart from those other topics which we have to do later. Hello, my dear buddies. How are you doing? So, after finishing international taxation, which was 84, is done. So, 85th lecture, my dear buddies, and this would be coming back to those small areas that we had left off. We'll finish it off, okay? So, today we'll be doing something called as business trust. So, come to module number 1, business trust, investment trust, securitization trust. In that, of course, all mean the same anyway. So all these things, securitization, investment. The securitization trust was, if you remember, it was over. We have finished securitization trust before only. SPV, special purpose vehicle, and also the special purpose entities. The securitization we had done, but we had not done these two. Business trust and investment trust is what we will be doing. Right? So the securitization part we have already done, covered in the previous classes. So today session would be to cover these and some other areas like, political contribution and electoral trust and some easy stuff. Okay. This is also very easy. So we just had the, small things to finish it off. So let's, in the next few classes, let's wind up DT. Okay. DT, international tax, will finish it off. Cool. So, guys, this is called as real estate investment trust and normal investment trust. It's simply called as REIT and InvIT. These are the two things that we need to just know before we start off. Cool. So if you know, Thailand is one of the smaller islands, and it is actually the 4th largest tech hub in the world, right? So there are many things that they do, and of course one more would be Singapore. So there was a professor in the University of Singapore who wrote a concept paper in financial management. He said that something called as, you should create something called as a business trust. And this plan of him was implemented eventually by creating something called as real estate investment trust and also InvIT. InvIT means infrastructure investment fund. So infrastructure investment fund and real estate investment fund is what we are going to discuss today. So basically, there is a company called Blackstone, which is probably one of the largest real estate investment trusts in the world. So basically, guys, essentially the concept is very simple. Let's say if you have a mall, Rajinikanth Mall, Rajini Mall, let's assume. If you have a mall called Rajini Mall, right, what will you do? There will be, let's say, share capital of around maybe 10 crore, right? And of course, it would be bank 10 crore. And you don't have money now, you need a loan to buy the mall, etc. So you take a loan of, let's say, around 290 crores, correct? And you would, of course, purchase a mall. And this money you will obviously utilize. You will purchase a mall worth 300 crores. This is your simple balance sheet. And what is your revenue model? Of course, you would obviously have the asset. You would have the asset with you, that is the mall. Whereas, this you will start as a company and you will have the asset in the name of the company. Revenue model would be, you would be giving this on rent, and the rent received would be the actual revenue. Now this guy, Singapore, a professor who wrote the concept of business trust, he said, why not change the way things are done? How to change the way things are done? He said, do one thing. Create a real estate investment trust, which is actually in India, many real estate investment trusts are there, guys. So if you just do if you just search here, people are asking so many things, which are the 3 REITs in India. Though this was a December 22 listing, it's many months ago, but still you see 3 REITs. Mindspace Business Parks REIT, Brookfield India Real Estate Trust REIT, Embassy Office Parks REIT. So already the concept of REIT is, increasing a lot in our country. So what does this REIT, Real Estate Investment Trust, do? So basically, as I told you, this real estate investment trust Let's say it is owned, the mall is owned by Rajni Mall. For example, Lulu Mall is there, one of the largest in Asia. Definitely one of the largest in India. But of course, if you compare it with Dubai, the Emirates, etc., there are many other malls there. But of course, one of the largest in Asia and definitely one of the largest in India. Lulu Mall, which is there in Kochi, and then later they have also have other malls, similar malls. In Bangalore also they have opened quite some time ago. So if you see, these are all the things, right? So what does this it do, guys? So very simple. So if you see, just understand the concept quickly, then we'll do the other things are very easy. Only the concept is the most important thing. So REIT, what it does is, let us say this guy will have a company, right? Rajni Mall. Rajni Mall will be in the name of the company. Let's say Rajni Limited. So this REIT will now, what do you say, buy shares from Mr. Rajni, who, like Rajni will have shares of Rajni Limited, maybe 60%, 70%, 100%. So from this guy, REIT will buy shares. So basically the shares of Rajni Limited will now be owned by this REIT. And in exchange, REIT will give units. Will issue units worth, what do you say? He wants 300 crore, like units worth 300 crore. So basically, it's not liquid still. Think about it. Mr. Rajni, for him, it is still not liquid. He has 300 crore worth of, the units. That units, of course, you can sell whenever you want, and this REIT would be listed in the stock exchange. It may be listed, may not be listed. Now unlisted REITs are also coming. So basically now for Rajni Mall, there will be an agreement. See, the thing is, the best part of the story is he already would have given the mall to others. Would there be any change in the agreements between Rajni Limited and the, tenants? No, because here the ownership or the control of Rajni Limited is being transferred. But the agreement will be in the name of Rajni Limited anyway, that is Rajni Mall. So basically, the agreement will not change, just the ownership will change. So all the agreements with all the tenants will be intact, just that the ownership will shift from, ownership of the mall will shift from one guy to the REIT now. Very, very simple. And this Rajni Limited is now called as a SPV, Special Purpose Vehicle. SPV, Special Purpose Vehicle. And Mr. Rajni will be called as a sponsor. So the sponsor now has sold all his shares to the REIT. Sold all his shares to REIT. Now, for example, Mr. Rajni would have bought these shares in, let's say, 2018 or some 2008 he would have bought. Whereas when were the units allotted to him? Units were allotted to him in 2023, assume. For how many crores? 300 crores. Basically, that's the value of the mall, 300 crores. So I have reimbursed that money to him in the form of units, though, mind you. Is there any realization? No realization. No realization. That's the reason, guys. Even capital gain, they have exempted under 47(17). Under 47(17), the capital gain is also exempt. Period of holding would be not in 2023. It is from the original, that is from 2008 itself. And let us say he had invested 10 crore. Share capital here, remember 10 crore I had showed you in this. So the period of holding is the 2008 and the cost of acquisition for this Mr. Rajni would be 10 CR. So the capital gain of this transfer also, exchange also would be exempt. It would be exempt. Now this is what a REIT will do. Now the best part is REIT already has the asset in its hand now, and REIT can easily now all the income it will earn on it. Whatever income the tenants are giving, REIT will earn the same. And in the REIT, many people would have invested, guys. That's the best part. How does REIT get its funds? REIT is like a mutual fund house. So others would have invested in REIT. You and I can actually go and invest in REIT. I'll give 1,000, you'll give 1,000, 10,000, 20,000, 40,000, like that. All of us can invest in REIT. And the income that it earns from these, buying these malls, etc., the income, the rental income will be diverted to others. And as per SEBI regulations, REIT should divert 90% of its income. Imagine. So basically, it is pretty secure. 90% of the income it has to divert to whom? Divert to unit holders. It has to divert to unit holders. So REIT can also, instead of buying this, it can also buy property also directly. Rather than buying shares, it can buy the property also, and rental income will be there. Apart from that, the main income of REIT would be REIT would of course give this basically this bank loan, no, here bank loan, predominantly here bank loan, 290 is there. How it works actually, REIT will pay this, will actually give a loan at, let's say, 8% or 10%. SPV would have taken a loan from the bank, right? Would have taken a loan from the bank at some 12%, 13%, or 13, 14%, 13%. Now, basically, REIT will give a loan to SPV. SPV will repay this loan fully, and then will start paying interest at 10%. This is one more income for REIT, interest income. One more, interest income. So basically, guys, what are all the various incomes that it earns? One is direct rental income from all the tenants. Second is, now I control Rajni Limited, right? So it will also earn dividend from Rajni Limited. It will also earn interest on loan given to Rajni Limited. Plus all this income, whatever it gets, it can invest again. So you will also get what? Income on investments. Income on investments. So overall general rule of all these things, tell me. Rental income or the interest income. Interest income, guys, is this one is exempt for the real estate investment trust, right? Not taxable, no tax, but taxable for whom? Unit holders. Remember, I told you REIT will earn that money and it cannot keep fully. 90% it has to give back to its unit holders. So it is taxable for unit holders. Exempt for real estate investment trust, taxable for unit holders. What about the dividend? Will come to that. What about rental income? What about rental income? Rental income. All the rental income also same thing. Exempt for real estate investment trust, taxable for unit holders. Dividend. As far as dividend is concerned, what about dividend, guys? Dividend. For exempt for real estate investment trust, that is exempt. But for unit holders, it is exempt. It is exempt if SPV, that is Rajani Limited, does not opt for BAA. So if Rajani Limited does not opt for lesser taxation, then it is also exempt. See, double exemption. Double exemption. Or else it is taxable if the SPV goes for 115 BAA. That's the other thing. All other income, guys, income on investment and other income. This is taxable for REIT at MMR, maximum marginal rate, except 111A plus 112 plus 112A. This is at the capital gain rates. This is at the capital gain rates. And of course, for unit holders, exempt. Unit holders exempt. So since this income is exempt, no TDS also. Under 194A, no TDS. TDS will not come. That's all, guys. Very simple. Very, very simple. This is the overall view. I hope you understood the concept. Very simple. In 15 minutes, you finished off the concept. So REIT is like a mutual fund where I'll collect money from everybody. And then I will start investing in, either I will buy the property also, or I'll buy the company, shares of the company that buys the property. And rental income is my main thing. Or I'll give loan to those companies so that they can clear off their loans and they can pay me interest. Whatever the case may be, it should be secure. 90% should be repatriated, or rather given back to, not repatriated, given back to whom? Given back to the unit holders. Given back to the unit holders. And the capital gains from transferring or purchasing the shares of that particular company, which has the mall, etc., that would be exempt under 47. So with this same concept, InvIT is what? Infrastructure investment funds. So these people invest in infrastructure facility, infrastructure companies. That's it. No change. With this basics, let's go into this and understand again quickly all the things. Very easy, guys. Extremely easy chapter. Don't worry. So guys, please come to N1, business trust. In order to increase investment in infrastructure and real estate, SEBI has notified real estate investment trust regulations and infrastructure investment trust regulations, providing a framework for registration and regulation of infrastructure investment trust and real estate investment trust. REIT is an investment vehicle, SPV, created for making investments in real estate properties. An InvIT is an investment vehicle for making investment in infrastructure projects. Investment can be made directly or through a SPV, special purpose vehicle. Working of REIT and investment and InvIT, same guys. Unit holders will be there. They will exchange, they will obviously invest in the business trust, for which issue of units will be there, which is listed on a recognized stock exchange. It is listed on BSE as well as NSE. Exchange of shares in return for units. As I told you, Mr. Rajni had 100% shares of Rajni Limited. So basically that he will take over. So if you see here, that is nothing but Rajni Limited SPV. An Indian company in which business trust holds controlling interest, it's an SPV. Any entity in which the business trust will hold controlling interest. How will they hold controlling interest? Through the unit holders only they will take, no? A unit holder was a sponsor, Rajni. He will give away the shares. In return, what will they invest? What will he get in return? Units. Income bearing assets held by the trust. The business trust 213A means a trust registered as an infrastructure investment trust or real estate investment trust. And earlier, no, there used to be their units had to be listed. One dialogue was there in 213A. Finance Act 2020 deleted that item. Till Finance Act 2020, only listed was covered. But later, because of the demands of the industry, they went and said, sir, why only that? Why not unlisted also? Please include unlisted also in the picture. So they removed it. Nirmala madam removed. Taxability. See, taxability of income in the hands of business trusts and investors, 115 UA. So if you see, when dividend income is received by business trust from the SPV, is distributed by the business trust to the unit holders. Taxability in the hands of business trust, exempt. Taxability in the hands of unit holders, taxable. Dividend, taxable, assuming they opt for 115 BA. However, business trust is liable to deduct tax on such income under section 115 LBA as follows: 10% in case of resident unit holders, 10% in case of non-resident or foreign company unit holders. When dividend income received by business trust from the SPV is distributed by the business. SPV has not exercised option under 115BA. Here it has exercised option under 115BA, not exercised option. Both are exempt. Same this chart, guys. No change. I explained the concept with this chart. Chapter over. Actually, chapter over, not kidding. Right. Next, same dividend income. Unit holders, business trust, dividend, and from this business trust, whatever they get, no. Basically, SPV has not opted for 115BA, they opted for 115BA. Has opted for 115BA, dividend exempt under for this business trust, whereas dividend here is taxable under section 115A. For the business trust, both the dividends are exempt. Same thing we saw here. For REIT, it is definitely exempt. For unit holders, depends. So if the SPV has not opted for 115BA, dividend is exempt. Opted for 115BA, this one. And since it is taxable under 115 UA3, for resident 10%, non-resident, TDS has to be deducted under 194 LBA. You can go to the TDS chapter and check that 194 LBA. There we would have seen that it is discussed in business trust. One dialogue will be there in that. Interest income. Same, and interest income received by business trust from the SPV is distributed by the business unit holders. Taxability in the hands of the business trust, exempt. In the hands of the unit holders, taxable. This one. Taxable. How much? Same. 10% for residents, 5% for non-residents. 5% for non-residents. Rental income from letting out of real estate owned by business trust. Guys, this is only REET. Here you see, this one is for both, it's a business trust, which means here it is REIT and InvIT both. Interest income, REIT, InvIT both. Here, rental income only being REIT, important to know. You can write down here rental income of InvIT, Infrastructure Investment Trust, is not exempt. It is not exempt. It is not exempt. But for rental income from letting out of real estate owned by business trust, yes, owned by business. So I can buy also, I told you. Taxable in the hands of business trust, exempt in the hands of unit holders, taxable. 10% in case of resident unit holders. At the rates in force in case of non-resident or foreign company holders. At the rates in force. At the rates in force. So here, rental income exempt for the business trust, for unit holders, taxable under 115 UA3. 10% for residents, non-residents, rates in force. Capital gains on the disposal of assets by business trust. Business trust will hold some assets which sells. Yes, as I told you here, except 111A, 112, 112A, other income is MMR, these will be at the CG rates. LTCG taxed at 112A or 112, STCG taxed at 111A. Unit holders exempt. When here you are taxing, here it is exempt. Other income, I told you it is taxable at MMR for business trust. For others, exempt. Same. Any income distributed by a business trust to unit holders will be deemed to be the same nature and proportion in the hands of the unit holder as it has been received by the business trust. So whatever nature of income this business trust will have, if it is PGBP, PGBP, IFOS, IFOS, same thing. Person responsible for crediting and making payment of undistributed income on behalf of business trust shall be furnished a statement in 64B. on or before 30th June of every assessment year. 64A to be furnished jurisdictional principal commissioner duly verified by CA. Business trust is mandatorily required to furnish return of income or loss under 139 4E. We have seen this. Investment funds, same thing, guys. Any fund established in India in the form of a trust or a company or limited liability company, which has what? Category 1 or category 2 alternate. We had seen this in international taxation already. There they do category 3 also, if you remember. Category 3 is your money market instruments. So this also is the same. But loss incurred by the investment. So any other income, it's the same here. Income from PGBP taxable at the following rates for investment funds. Basically here, unit holder invest in the investment fund, category 1, category 2, and the money will be distributed here. PGBP for company 30% and 25% as the case may be, firm, and for others it is MMR. This we'll see in set of. Taxability in the hands of all unit holders. Income from PGBP is exempt. Any other income is taxable. Resident unit holder is 10%. Others at the rates in force. Same thing. PGBP is exempt, guys. Other income taxable under section 115 UB at normal rates only. Same. Here LBB will be taken. Resident it is 10%. Non-resident at the rates in force. All other income other than the income from PGBP will be exempt in the hands of investment fund. Tax rates for PGBP, company, firm, LLP 30%, others at MMR. Whereas other income is exempt under section 1023 FPA. Same nature and proportion, same thing. Securitization funds already done. So that same proportion and nature is there. No, we'll probably take an example to understand. So that what do you mean by in the hands of unit holder, whether it is real estate or whatever it is, how much will it be? What do you mean by that same proportion? That one example we can take. Because if for the main person, if it is PGBP, here also it will be PGBP. So basically, let's say this is the earnings of the investment fund or the REIT. They earned 4 crore towards rent. They earned 2 crore interest from SPV. They earned 3 crore, that is dividend of SPV, from SPV, 1 crore LTCG. So basically, if you see, guys, rental income for REIT, this is exempt, interest SPV exempt, dividend exempt, LTCG taxable. But for dividend SPV, assuming, he has not opted for 115 BA. For the unit holder, by that logic, for the unit holder, this is what? Rent will be taxable. Interest from SPV taxable. This will be exempt, double exemption, whereas this will be exempt. So overall it is what? 4, 5, 6, 7, 8, 9, 10 crores. 10 crores. What do you mean by same proportion? What do you mean by same proportion? It means these two things are taxable, no? So for the unit holder, let us say your unit holder who has earned 50,000 from the REIT, overall earnings is so much. So when you are computing tax, and the tax is only for these two things, right? How will you compute? This is 4 out of 10 crore is attributable to rent, and overall is 50,000. So 4 by 10 into 50,000. So my dear friends, 20,000 rupees will be treated as PGBP income of the unit holder. Why? Same is for here also. Rental income is PGBP, right? It is obviously PGBP. It's not income from house property. It is their business. There was one Supreme Court judgment, Chennai Properties. They told, depending on the nature, your nature here is obviously to do business, not income from house property. So basically, it's taken as, so for your whoever unit holder also it is PGBP. Then remaining this one, if you see, interest from SPV is also obviously IFOS. So here it is 2 out of 10 into 50K, 10,000. 10,000 would be what? IFOS. IFOS. That's all there is to it. Very, very simple. At the rates enforcement, you have to go to section 195. So the TDS rates would be what, guys? Interest from SPV portion for residents 10%, non-residents 5%. Rental from properties owned by RE80 10% as per section 195. Then dividend from SPV. If SPV has opted exercise 115BA, then 10%, resident, non-resident. Dividend from SPV, what do you say? 115BA has not been exercised. So both cases it is exempt. Very, very simple. So that's about it. Nothing much in this, guys. Very simple. So it's all about even your InvIT, it would be the similar provisions. Infrastructure investment trust. Investment funds are different. Investment funds we had seen in international taxation. So this part is slightly different. Securitization funds also we had seen before. Investment funds are slightly different. So they'll invest in venture capital fund, infrastructure fund, equity fund, debt fund. Category 3 is money market fund. So that is all there is to it. This will seem set off and carry forward of losses, no problem, easy. Next is, guys, taxation of the scam fellows. What is taxation of scam fellows? Electoral trust. Point number M, page number M, very easy. So political parties. So guys, in Companies Act, I've already discussed this in, what do you say? Contribution to CSR and all that. We have discussed this. So political trust, political electoral trust and political parties, etc. Under section 182 of the Companies Act in 1956, the relevant section, that was 292A at the time, section number you leave, that time you could only give 5% to a political party or anybody with political affiliation. Later in the year 2013, this was changed to 7.5%. Then in the year 2017 again, because the elections were coming near, this also was removed and they said any amount can be given to a political party, but cash not allowed. Only through bank. Cash not allowed at all. Companies is for company. Individuals can give, companies. But they came out with the electoral bond scheme. In electoral bond scheme, I can go to any bank, let's say SBI, give let's say 1,000 crore. I'm just giving an example, and take bonds. These bonds are like DD, demand draft. Basically, I can distribute to anybody I want, or it's like normal, sweets. I can give it to anybody I want. When I give it to anybody I want, in my books of accounts or in my, what do you say, balance sheet P&L, I will not disclose to whom I am giving. I'll just disclose that, look bro, I bought 1,000 crore worth of electoral bonds, and then I can distribute to anybody. And this anybody, when he is receiving, is it anonymous for that person? Yes. So it's called electoral bond scam. Sorry, scheme. You know what is scheme, what is scam, right? And it was not a slip of tongue. Anyway, so political party, the receiver, how much you can get, any amount, let's see. Political party section 13A, sorry. Political party is eligible for exemption for income from house property, capital gains, other sources and income by way of voluntary contribution. Exemption is, but political party, they have to pay tax for what? House property, capital gain, other sources and income by voluntary contribution. Voluntary contribution means donation. But PGBP income is taxable. One question they asked in the exam that the political party had a canteen and they were running the canteen and they were getting money. So that was obviously business. So business income is taxable, guys. Other things are exempt. Political party must be registered under the Representations of the People Act. Has to maintain books of account and other documents. A record of voluntary contribution excess of 20,000 including name and address. Excess of 20,000, name and address and all you have to write. Donation exceeding 2,000 rupees shall be received only by account payee check. Otherwise, it is taxable. Accounts of the political party to be audited by CA furnishing return. Maintenance is not necessary if the donation is received via electoral bond. See, accounts also not need to be maintained. Maintenance of records not needed if it's electoral bond, I told you. If the treasurer of the political party fails to submit the report, then no exemption in this section will be available. Basically, you have to file one return. That's it. Same trust was one, and of course, if you pay in cash, if you link it to the giver under 80GGB, this is what we had discussed that day. There is no deduction available if paid in cash. No deduction available if paid in cash. Very, very simple. So 20,000 record of voluntary contribution you have to make. Anything other than, basically I have to record, I have to maintain. Otherwise, it will not be exempt. For example, if there was one question, I think in some 2010 or something, if the question was, I have collected 21,000 each from 100 people, overall 21 lakh. Is that 21 lakh fully taxable? Yes. Why? Because records have not been maintained. They said anonymous donation. No, anonymous donation, if it is anything excess of 20, I should take their name and address. But instead of that, what you will do electoral bond scheme, or instead of that, what I will do, take 1,000 rupees, guys. Only exceeding 200, no, 2,000, no. 1,000 rupees you take. 1,001. In an envelope you give 1,000 and I will tell 1 crore people gave me a donation. Who cares? It's all scam, guys. It's on Chumma waste section, but it's there, we have to do. Electoral trust is no longer there now, because here you have to disclose everything. Practically, it's not there because electoral bond scheme has already come. But electoral trust is what, let's say Adani could have opened a trust, and from that trust you could give to BJP, Congress and all those things. Now, who will maintain a trust, guys, and who will clearly show the political affiliation to a political party? Not possible. Media will kill them, opposition will kill them, so it's one waste section. The electoral trusts are trusts considered for funding political parties in an organized manner. Section 222A defines electoral trust to mean a trust approved by the board. The trust shall distribute minimum 95% of the total donations received along with the surplus brought. Basically, along with the surplus brought forward from earlier years, along with the surplus brought forward. So basically, here you see, electoral trust received voluntary contribution of 1 crore. It distributed 97 lakhs. Has it distributed more than 95%? Yes. Since more than 95 is distributed, total contribution shall be exempt. Suppose in the next year, it receives 2 crore. It should distribute how much, guys? 2 crore plus 3 lakh surplus. That is important point. That is 192.85 lakhs at least to be eligible for exemption. This 3 lakhs is also important. That is the meaning of this dialogue here, along with the surplus. Political party receiving donation should be registered under Representative People Act. Same thing. If it fails to do so, income will be subject to tax. Full income will be subject to tax. Same GGB, same thing. Electoral trust must not receive donation from foreign entity, other electoral trust, foreign source as per FCRA, Foreign Contribution Regulation Act. This was one of the main reasons why Indira Gandhi brought about this FCRA. FCRA was actually 1976 law. There is one law called FCRA 1976. There Indira Gandhi brought about because it was alleged that the CIA of USA was funding that time Jan Sangh and also the RSS. It was alleged. Whereas the Soviets were funding Indira Gandhi. Indira Gandhi was codenamed Vano. Right? So if you're interested, you can check my FCRA introductory video on YouTube to understand what I'm trying to tell. But for examination and for income tax purposes, not needed. Leave it. Got it, guys? Simple. Now, basically, if your dad gives your mom some pocket money, it's called pin money. Basically, dad, rather than giving it to his, keeping in the almirah, or mom is working, keeping in the almirah, she gives it to you, right? You save some 1,000 rupees, 2,000 rupees every month, and in the year end, you'll get some 50,000 rupees saving. Is that income? No. Principle of mutuality, my dear friends. If you cannot earn money from yourself, is the concept. So that's called principle of mutuality, mutual concerns. There is no section on this mutuality, etc. It's a mutual association where all the contributors will come together and contribute, and ultimately it is for the benefit of everybody. All these clubs, associations will run on this concept of mutuality. Why I am doing this is the last part. If you see page number B58 in PGBP, that is P58, there was one section which you have already done, but still again revision. Trade, professional and similar associations under 44A. This will be your resident welfare association, social clubs, sports associations, sports clubs, bar association. Bar association means the group of lawyers, those people. You would have heard, CII, Bombay Chartered Accountants Association, PhD chambers, FICCI, all these you would have heard. All these are associations. We have Karnataka State Chartered Accountants Association. All these are concerns. 44A. All contributors to a common fund are entitled to participate in the surplus, and all participants in the surplus are contributors in the case of a mutual concern. Club collects subscription fee from all the members and in return provides facilities and privileges to them. Any surplus shall not be taxable as it works in a mutuality principle. However, there is one section 44A, because of which, here 44A, this one. What does it say? Any income from specific services. Under section 28, we have seen some specific services to members. For example, the member uses the convention hall of the club. It's a specific service. So that amount will be taxable for the club. Other income like interest, etc. shall be taxable under income from other sources. So if it goes and invests in excess money, it goes and invests in a bank, FD interest will be taxable. Surplus from subscriptions, that is mutuality source, shall be exempt. Now, what was the problem? Like for example, the club earned money, that is collection of 100 lakhs, and the expenses was 90 lakhs. Overall 10 lakhs. Is this exempt from tax? Yes, principle of mutuality. On the other hand, income, what they earned was 100, but the expense of that year was 125. That extra 15 or 25 in this example, sorry, will it be allowed to set off is the question. The answer is yes. If you see, subscription fee falls short of expenditure, 25. Deficit is allowed as a deduction subject to a maximum of 50% of total income before such deduction. If there is any absence of income, such deduction is allowed from income from other heads. That is the extra part. Example, guys, example. If my general receipts of a club is, let's say, 23,50,000, and general expenses is, let's say, 27 lakh. Overall, how much? 3,50,000. Will this be allowed to set off is the question. Right? The answer, for example, we have, let's say, PGBP income of 4 lakhs. Brought forward loss of previous year, 1 lakh. Depreciation, brought forward unabsorbed depreciation is 60K. And income from other sources is 4 lakh. So guys, first I have to set off the internal heads. No, these two I have to set off against this. 4 lakh minus 1 lakh minus 60,000 is 2 lakh 40,000. Now you see, IFOS 4 lakh plus 2 lakh 40, 6 lakh 40,000 overall. You see here, how much is allowed? Maximum of 50% of total income is allowed. What is the total income? 6 lakh 40. 50%, 3 lakh 20. So guys, 3 lakh 50 is there, 3 lakh 20. Can I use to set it off? Yes, that is what it means, 50%. If it cannot be set off against business, it can be set off against other heads of income. See? Very simple. And here, this extra 30,000, will it be carried forward? Definitely not. It will lapse. No carry forward benefit. It will 100% lapse. So in Bangalore, there's a very famous club called Bangalore Club. It requires almost some 30 years of waiting to be a member. Crazy, Bangalore Club. So here what happened, one of the banks, let's for example name it Canara Bank. Canara Bank also was a customer, or let's say Citibank. Citibank was a customer of Bangalore Club, means corporate member. It was a member. So all the assistant general manager were getting benefits from Bangalore Club. Now this Bangalore Club, whatever excess money it got, it invested in all the banks as FD. ICICI Bank, SBI, HDFC, HSBC, and this Citibank also. Interest earned from these, obviously, are they taxable? Yes, we have already seen. But think about it. Interest earned from member. FD interest, they were earning some 6%. They were earning some 6%, right? 1 second. Interest, FD earning 6%. They went and told, this was actually a huge amount, some, 1 crore. They said this income of 6%, I will not pay tax. Why? Because I'm earning from the member. Fair enough. Went to Supreme Court, guys. Supreme Court, wonderful thing they said. Bro, income from member not allowed, I 100% agree. But this money that this Bangalore Club gives this money as FD, no, this they will give it as, various loans, etc. They will use that money. When they give you a loan, you are getting the 6%. They will earn 12%, 13%. So isn't it extra that they are earning? Yes. The bank, that is Bangalore Club, that bank, Citibank, who's a member of the club, is taking money from you and lending it to others at high rates. How can you say that he's not making anything? How can you say that it is mutuality? The mutuality link will cut here, is what they said. Good decision. Good decision. That's about it, guys. Very, very simple. As I told you, these are all some chilled out stuff left here, and nothing great. Very, very chilled out stuff. Not many things to do. So we'll easily finish it off. Okay. So on that note, let us wind up with this class. Simple. Going forward, all small things left, all major things over. So next class will start math. Math is also very easy. Oh, math, very difficult and all. Don't think, it's very, very easy. We'll finish that also. Okay. Take care, guys. Come on, up top. Awesome. See you. Hi, my dear buddies. How are you doing? So let's start off with a couple of interesting topics today. First, let me find my pen as usual. Got it. So guys, lecture number 89, and we will start off with what do you say? Business of business reorganization of cooperative banks, and we will do set off and carry forward and all those things. So we were doing, what do you say, amalgamation, demerger. So on similar lines, we'll finish off these two. It's very simple provisions. Business reorganization of cooperative banks. So guys, this is copy, paste, amalgamation and demerger. No change, honestly speaking. There is no change here. Except maybe there are around 2 to 3 differences. So let's just figure that out. Yeah, 3 differences are there. Barring that, no change. So let me just business reorganize. This is page number 16.1, by the way. Business reorganization of cooperative banks.
same as amalgamation and demerger, except three differences. Difference number one, remember that 75% or more of the shareholding, 70% or more should come here. That is also there apart from an additional condition. Because in these business reorganization of cooperative banks, guys, generally the impact will happen when cooperative society banks come together. It is predominantly set up as a mutual benefit society where they come together and then create these cooperative banks. So there are many members also who should take the benefit of this reorganization. Hence, one additional point is added that 75% of the members holding 75% or more voting rights. In the other provisions, amalgamation, what is the additional condition? That the shareholders holding 75% of the amalgamated, of the or more in value of the shares should also hold, what do you say, become shareholder of the amalgamated company. Shareholders here, members are also there. Members are different. So members of cooperative society also should come into the picture here. Members holding 75% or more of the voting rights in the amalgamating company, amalgamating bank, should become members of amalgamated cooperative society. Amalgamated cooperative society. That is difference number one. Difference number two, that carrying forward the losses, if you remember, in normal amalgamation, it is fresh period of 8 years. If you remember, if you follow provisions of 72A, fresh period of 8 years, but here it is only the balance period. Amalgamated cooperative bank can carry forward the loss of amalgamating cooperative bank for balance number of years, not fresh. For only the balance number of years. Third most important thing is section 44 DB. So in normal section, remember, only section 32 is split, no, between number of days between the amalgamating and amalgamated company. In this, apart from section 32, 35D, 35DD and 35DDA, these three things are also shared in the ratio of days. This is pre-operative expenses, amalgamation expenses, VRS compensation. This all will be shared between the three. So basically, number of days it will be shared. So if they say that it incurred an expenditure of 10 lakhs on VRS, that 10 lakhs will be split between the two companies in the ratio of number of days based on when the amalgamation happened. Apart from that, these three are not available generally for companies, but an additional point for what? cooperative banks. These three are the important things, guys. Barring that, everything else is copy paste, no change. See, transfer of capital asset by a predecessor cooperative bank to successor cooperative bank or the converted in a scheme of business reorganization is exempt. Same. Transfer in lieu of shares of successor company is also exempt. Yes, 72AB. Accumulated loss, this is the difference here, is only for the unexpired period. Unexpired period. And as you know, speculation loss can never be set off against any of the successors cooperative banks income. Conditions, 3 years, fixed years, 2 years, all the same, no change. Demerger, it's the same, no change. 44DB, see these three things shall be apportioned between the two. So you see, Shikhar Cooperative Bank, just mark this example as important. Shikhar Cooperative Bank is amalgamated with Tony Cooperative Bank on 30/8/2022. Shikhar Cooperative Bank incurred an expenditure of 10 lakhs on voluntary retirement scheme and 10 lakhs was paid on 34/21. Reduction under 34 DDA to amalgamating cooperative bank, assessment rate 23 is 2 lakhs. 35 DDA as per section 44 DB in 23/24, because this 10 lakhs is generally given to what, guys? 2 lakhs per annum. First year they'll get full deduction. Second year onwards, 1/5, right? 1/5 is allowed if you remember 35 DDA. So in this 2 lakh into which date it is? 38/2022. So April, May, June, July, August, 5 months. April, May, June, July, August. So 151 days. August. So 151 days there. $29 days. 1 day before I have to take, right? Then the other one 214 days. Once that is over, the other companies you will get 2 lakhs. I will make this 2 lakhs size, not 22 lakhs. 2 lakhs every year. 2 lakhs every year. So page 16.2, this one here, last part, it should be 2 lakhs every year, not 22 lakhs. Just make that change, please. So 2 lakhs. And if you see, it may be noted that in the case of amalgamation of companies, in the above case, deduction is available to amalgamated company, it is not apportioned. We have seen this. So amalgamated company, the full thing is available, it is not apportioned, but here it has to be apportioned in that year. That's it, guys. In this, that is the only 3 things that you have to remember. All the 3 things we have done. Do not waste more time than this. It is not important. But those 3 differences they can ask in the exam in the form of MCQs, etc. That's why you should keep that in mind. Otherwise, really not needed. Simply don't keep wasting time on all those things. Now let's do another chapter, set off and carry forward. G1, G2, G3 onwards. In that, if you remember, guys, G1 and all we have already done. So we just have to do the other areas. So we shall finish off this small chapter, important chapter, but we'll finish it off so that it becomes very easy for you going forward. Set off and carry forward of losses. So if you see, there are two things. One is set off, comma, then set off and carry forward of losses. So set off is just setting off that particular year. So income of a particular year set off against the loss of the particular year. It could be within the same head or it could be between two heads. One is set off, one more is, one is set off, one more is what? Set off. There is carry forward and set off of losses. One is merely setting off. Merely setting off means setting off the losses of 1 year with the profits of the other. One is set off. One more is what? Carry forward and set off. Carry forward means what? Whatever loss is there, carry forward to the next year and then set off that. So that is what it is. So if you remember in this deemed income concept, we have done full charts and we already completed this 68, 69, 70, all that 68, 69, 69, C, 69, all that we have done. If you remember, this part is done. This we will have to do. And if you remember in amalgamation and demerger, we have done, what do you say? This part. This part is already done. 72A. Full we did. Till here, even this we finished. So barring this, other things we can finish it off. Very simple. In that almost 3-4 pages we have done. Remaining 6 pages are there. We'll finish it off, guys. Easy chapter. Set off of losses. So intra-head adjustment is section 76, whereas inter-head adjustment between one head and the other head is 71. That's all. Intra-head is within the same head. When the loss from one source of income is set off against the profit from another source of income, if within the same head of income, it is known as intra-source adjustment. That is long-term capital gain from shares versus long-term capital loss in terms of selling a house. Intra-head. Inter-head is what? Loss from house property. If you see loss from one house property set off against profit from another house property, intra-head. Inter-head means what? Loss from house property set off against salary income. So let's see this. Intra-head, that is within the same head, section 70. Intra-head is actually allowed, freely allowed. Except these things. Under these things, it is not allowed. That's all you need to remember. Speculation business loss cannot be set off. Speculation business is ultimately a business, PGBP income. PGBP. Generally, PGBP income loss should be allowed to be set off against PGBP income. But if it is a speculation business loss, this is actually treated as a distinct and separate loss. Though it is very much part of PGBP, it is considered to be distinct and separate, right? So speculation business loss can be set off only against any other speculation business income. Loss of a specified business, this we are done under 35 AD, will be only set off against other specified business income under 35 AD. This we are done already. Long-term capital loss can only be set off against long-term capital gains. Which means it cannot be set off against short-term. Because intra-head means what? You may say that, sir, one is short-term capital gain, one is long-term capital gain, long-term capital loss. Can long-term capital loss be set off against short-term capital gains? No. Not against short-term capital gain. Loss from the activity of owning and maintaining race horses cannot be set off against anything. That is also considered to be a distinct and separate activity. Income from activity of owning and maintaining race horses only you can set off. Loss from any lottery, card game, races, etc. is not eligible for set off or carry forward at all. Losses from lottery, etc. you cannot, set it off.
Any loss from a source which is exempt from tax, say agricultural income, it is not eligible to be set off or carry forward. So loss from agricultural income cannot go there. These are all the basic cases, guys. Very, very simple. So for instance, if I have a long-term capital gain through shares under 112A where I've paid 10%, and I have long-term capital loss again from shares 10%, I would have paid 5 lakhs is the loss, 6 lakh is the gain here. And here long-term capital gain jewelry 112 where I've paid 20%, the loss is 6 lakh. Now where should I do this loss? Where should I set off? It makes sense to set off against this because here the tax rate is more. So I can set this off, no problem. Correct? Nowhere it says it should be long-term capital gain in shares. It just says long-term capital gain should be set off against long-term capital loss. It cannot be set off against short-term capital gain. So this is very much possible. Then if there is a short-term capital loss under AAA where I have paid 15%, let's say 6 lakh is the loss, and there is a short-term capital gain where I have to pay 30%, 4 lakhs, and there's a long-term capital gain from jewelry where I pay 20%, 3 lakhs is the gain. One more long-term capital gain from shares, 112A, 10%, 4 lakh. So guys, first obviously this loss 6 lakh set off against this 4 lakh. Remaining 2 lakh is there. That 2 lakh whether to do this or this. Obviously it is better to set off this because here I'll be paying 20% on 1 lakh and not 20% on 3 lakh. So it's pure common sense, set off and carry forward. Nothing, honestly, nothing great about it. Nothing extra to think of. Right? So this is the first part of the story. Very, very simple. So long-term capital gain, short-term capital gain, all that we have to understand. One example, important. House A let out $10 lakh is the income. House B is also let out. There is a 7 lakh loss. They did not pay salary and all that. Sorry, they did not pay the rental and all that things seen happened. 7 lakh. Can I set this off and only 3 lakh can it be? Finance Act 2017 says loss from house property can be set off against other heads of income only to the extent of 2 lakhs. So this 7 lakh, only 2 lakhs I can set it off against others. But guys, section 70, which is what we are talking, has not been amended. Which means what? Full 7 lakh can be set off since it is intra-head. House property to house property, any amount. House property loss against other income, 2 lakhs. That's the golden rule. Write down somewhere. House property gain to house property loss or house property loss against house property gain, any amount. House property loss against other income, 2 lakhs. That is an amendment there. And in house property, these are some extra points from there, it will come. Okay. Salary and house property notes have already been uploaded.
So you have nothing to worry. It's already been uploaded. You can go through. These are some additional points in class only I have told. In clubbing, we did the deemed owner concept. So wherever it is coming, I'm already doing it. So there's nothing much for you to understand, right? Yeah. Similar to clubbing of income, here an assessee is eligible to seek set-off of losses also. Mr. A gives a sum of 25 lakhs to his spouse, which she deploys for commencing a business. Mrs. A suffered a loss of 5 lakhs. The loss shall be subject to clubbing, and accordingly, Mr. A could set off 5 lakhs against any other eligible income, because I mean clubbing the income, right? So even for clubbing, definitely there will be what? I can do the adjustment. So that was also held in J.H. Gotla, Supreme Court judgment. Even the brought forward losses can be set off against minor child or anything, any clubbed income. Any clubbed income. So yes, that also you can check, no problem. On the other hand, anything from speculation business, speculation losses cannot be set off against any other income except speculation income. In case of Ranjana, loss from speculation business shall not be eligible for set off against software business, and thus total income would be just 10 lakh rupees. In the case of Sanjana, however, loss from software business can be set off against income from speculation business. There is no restriction for set off of loss from software business against income from speculation business. Accordingly, after set off, total income would be 4 lakh rupees. Inter-head adjustment between one head to the other head. Inter-head. This is section 71. Section 70 is intra-head. Section 71 is inter-head. As I told you, check this. Loss under the head income from house property shall be eligible for only set off against any other head of income, but restricted to a sum of 2,71,3A. 71.1 was not amended. 70 was not amended. 70 was not amended. 71.3A was amended. Inter-head was amended, not intra-head. That's what I was trying to tell. So, house property loss against house property income, any amount. House property loss against other heads of income, 2 lakhs. Inter-head was amended, not intra-head. I am trying to make it as easy as possible for you so that you don't have to suffer, right? That's my intention. It will become easy and we can finish it off fast. The portion of unabsorbed loss, if any, shall be carried to subsequent years, where it will be set off only against what? Income from house property. Loss under the head, profits and gains of business on profession, including unabsorbed depreciation, any other head of income other than salaries. So, why salaries this was added? No, guys. Our CS only did this. Even, in the concept paper when you are checking out, I figured out why in other than salaries, our CA fellows, what they were doing. CA, let's say salary is some 40 lakh. Okay. So in that 40 lakh salary, what he'll do, he'll open one more small business and show credit of 40,000. This is some, certification work that he did. So a consulting work that he did. Basically for consulting, etc., you will not need any, COP. So then he showed expenses, car expense, that expense, this expense, like that, some 8 lakh expenses he showed. So basically, loss was how much? 7.6 lakh. This loss coolly started setting off with this. That's why they added this. Our fellows only do all this now, guys. Who else will do? Tell me.
If you remember also in 38.2, like if my salary again is 40 lakh and I have a car of 40 lakh, what I can do? I can show that same 40,000 income here, and expenses I'll just show 1 lakh because this is not possible right now. And then I'll show depreciation of the car 6 lakh rupees. That's why in 38.2 we saw if you are using it for both business and non-business purposes, AO will now say, bro, that 6 lakh depreciation is only as against what? 40,000 rupees that you are earning. And out of 40 lakh, 40,000. Your overall income is 40 lakh and 40,000. So out of 40 lakh, 40,000 only I should take. 6 lakh is a portion like this that we had seen in 38.2 if you remember. So that also is there. One controlling point and this also. Both controlling points are there. Nothing you can do. Loss under the head profit and gains of business or profession, including unabsorbed depreciation, can be set off only against any other income other than salaries. Long-term capital loss can be set off only against long-term capital gain as discussed. Loss from speculation business only against speculative business income. Specified business 35 AD only against specified business loss income. Loss from activity of owning and maintaining resources, same thing. Short-term capital loss suddenly set off against long-term capital gain or short-term capital gain. So STCG, LTCG. That's all, not any other income. Loss from any lottery, etc., that is not eligible at all. Then where law is silent on the order of set off, as I told you, may use one method, more than one method, the most beneficial method. We have seen examples here. These are all most beneficial method only. Law does not tell you how, what, etc. So I can use my most beneficial method. Law is silent. Carry forward and set off of losses. So carry forward and set off of losses. So basically guys, even if I have my agricultural income and all, that cannot be set off. Carry forward and set off of losses. Where a loss computed could not be set off against the same or any other head of income, fully or partly, such unabsorbed loss shall be carried forward to subsequent year for set off. So if I could not do here inter head also, first intra head I'll try, not possible. Inter head I'll try, that also not possible. Means I will carry it forward and then set it off. So all this I've given here. Loss from house property can be carried forward for 8 years. To be carried forward and set off only against income from house property. Whether return of income to be filed within the due date, no important. Unabsorbed depreciation also no important. In all other cases, this we had done it also in PGBP if you remember. For what you are telling, God only knows. For that, please go back and check. We had done this. Loss from house property, 8 years, set off against income from house property. Unabsorbed depreciation, number of years, indefinite period. Any head of income other than salaries as discussed. Business loss, 8 years. To be carried forward and set off against profit and gains of business or profession. Alright guys, so guys please see here, loss under the head profit and gains can be set off against any other head of income. This is for that particular year. I am not talking about carry forward. There are two things, please understand, do not get confused. One is what? Set off. Set off means what? Loss of that year set off against gain of that year. This is 70 and 71. Right? Whereas 70, if you see the carry forward and set off, that is 72. So don't get confused. So here I am telling you this is carry forward and set off. If I have carried forward the previous year's loss, etc., this year I can only set it off against what? Profits and gains of business or profession. Loss in speculation business, 4 years only. Income from speculation business only. Loss by specified business, income from any specified business only,
Yes. For this, if you remember, it is indefinite period. We have already discussed in 35AD. Loss under the head capital gains, 8 years, 8 years. Short term capital loss, short term or long term gains. Long term capital loss only against long term gains. Loss from the activity, same, 4 years. Income from specified business, 7 lakh, non-specified 10 lakh. So can I set off against this? No. Ulta, this I can. In this case, X cannot set off from unspecified business. We have seen this already. Y, all that we have seen. Loss in speculation business. So guys, if you remember in BGBP, page B4, we had not done this part on purpose. And I told you there, we will see that later has come. So whatever I have left here, almost everything we would have covered. In fact, everything we have covered. So whatever we have left, wherever the different places, we would have covered in some other area. So once you sit for revision, everything will come to you easily. So where an SC carries on speculative transactions is constitute a business. Such business shall be considered as a separate and distinct business. As discussed, it will not be taken as the same. It is separate and distinct business. Speculative business will be separate and distinct. So speculative transaction means a transaction in which contract for purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by actual delivery or of the commodity or scrips. So otherwise than by actual delivery, if you have done, let's say a normal contract where today I have asked that I will buy raw materials from you, let's say at 1 lakh rupees, or rather I will sell raw materials at 1 lakh raw materials at 1000 rupees. And I'll say, let's keep the deal for 2 days. You have to actually buy it. So I've already bought it. You will be paying in 2 days. In the next 2 days, the raw materials have, the material that I'm supposed to give you, the rate has come to 950 rupees. So now I'll say, boss, I'll do one thing. Anyway, I was supposed to sell you at 1000. Are you okay selling to me at 950? If you're okay with it, you're incurring a loss. But we already had a contract where I told you that I'll sell you the goods at 1000. And since now it has become 950, going forward further, the market will go down to 900, 800, whatever. And the contract now, whatever entered into, you will only suffer a loss. You will do one thing. I was supposed to supply that at 1000 today, but I want to buy it back. Though the goods are with me only, I want to buy back at 950. Are you okay with it? I will take the loss of 50, no problem. Are you okay with it? Or you should take the loss of 50 rupees. You will be protected from further loss. But this 50, are you ready to take? You will say yes. Then that is called a speculative business. Is derivative transaction speculative business? No. People always misinterpret that derivative transactions are speculative business. Way back in 2005 only, amendment had come saying that speculative business is not, derivative business is not speculative business. Only the cash segment, intraday. That intraday only speculative, nothing else. Intraday is speculative, nothing else. So if you deal in derivative instruments, forward contracts, etc., they are not speculative, right? So if you see, speculative and non-speculative transactions on a composite basis and maintain common accounts necessary to determine the income separately from speculative and non-speculative. So if you do derivative trading, normal forward contract, and you do intraday, then you need to figure out, you have to separate properly. Loss from a speculative business cannot be set off against income from regular business. Against such income or any other head, such loss can be set off only in 4 years. Where any part of the business consists of purchase and sale of shares of other companies. Reliance had manufacturing profits of 10,000 crore. Then they started buying and selling shares. And they said speculative business, this is also part of business. Then they made it business loss. Business loss was set off against business income. So 10,000 crore was, was used to set off these speculation losses that they were making. So to curb that practice from big companies from doing it, this provision was inserted.
Where any part of the business of a company consists in the purchase and sale of shares of other company, shares, not derivatives, then such company shall be deemed to be carrying on speculative business, which means, again, I'm telling you, derivatives is not a speculative business. Derivatives is not a speculative business. Intraday, speculative. Simple words. Intraday is speculative. Derivative is not speculative. If you have one of the businesses manufacturing, etc., other part of the business is buying and selling of shares, that shares part is deemed to be speculation. To the extent to which the business consists of purchase and sale of shares. Transactions not deemed to be speculative. 1, 2 has become redundant because of 3. Any eligible transaction in respect of which trading in derivatives or commodity derivatives subject to commodities transaction tax on a recognized stock exchange. So earlier they used to do forward contracts, they used to do buying of raw materials, etc. Now everything will be treated as commodity derivatives. You can do it in MCX, and also you can do trade in derivatives forward contracts. So A and B was there earlier, C was introduced later, sometime in 2018. By insertion of 2018, this A and B have almost become redundant. So you can just remember 3 and go, it's fine. Any eligible transaction in respect of trading in derivatives or commodity derivatives subject to commodity transaction tax. If you see, commodity transaction tax was not applicable to agricultural products, agricultural commodities. So agricultural commodities, many judgments came that agricultural commodities are speculative business. These people went and told, sir, first of all, just because your commodity transaction tax is not applicable on agricultural products, you are making it speculation. So who will, first of all, agricultural products, no one will buy the commodities. If you put, this condition of speculation, nobody will even touch that. So please change it. So again in 2018, they amended it. CIT is not applicable on agricultural commodities. Trading in such commodities is not a speculative transaction. I am reading the PGBP notes, my dear friends, B4. That time if you had studied, nothing you would have understood. Now you are in a good position. What is eligible transaction? Eligible transaction in derivatives means any transaction carried out electronically on screen-based system. So till 2005, everything was deemed to be speculation, but then SEBI got a lot of control in 1992. 1992 to 2005 is almost 13, 14 years. So they said, no problem. Now everything is happening through a screen-based mechanism. So it's okay. Even if we, there is no chance for any false derivative transactions to happen because everything KYC, etc. is very strong, and SEBI registration is mandatory for everything. So we are sorted. That's what it says, SEBI and all these things, because it has to go through a stockbroker. When all transactions are disclosed with the transaction fee, it shall not be treated as speculative transaction. Same thing. When a party in breach accepts claims for damages, what actually happens is disposal of a dispute and not any settlement of any kind. So because it says here, no, here, settled otherwise than by actual delivery. I do not deliver the goods to you. So I'll say, bro, let's settle it. I'm sorry, I had agreed to sell you at 100. Now the commodity is not with me. I'm sorry, you please buy it from outside, 110. 10 rupees I'll pay. Is it otherwise than an actual delivery? Went to court. They said, no. That is like a penalty in nature, damages. Amount paid as damages could not be disallowed as speculative loss. That is what we had seen there. So come back, guys. I hope you got that. Speculative business. Come to this now. Where part of the business consists of purchase or sale of shares of other companies, such company shall be deemed to be carrying on speculative transaction. We have seen this already. However, this is for Reliance type of companies, but this will not apply to where gross total income consists mainly of income on securities. income from house property, capital gains, income from other sources. So if more than 50% of your income is from these areas, then you cannot say that this company is doing speculative transactions. Even if they are doing these transactions, you cannot say that the main business would be speculative transaction. Company whose principal business is trading in shares or granting loans. Main business only is that. 90% of their business is that. Then not possible. But in these cases, some other companies, what they were doing, equally they were doing, and actually more they were doing speculative and ensuring that other things were less. So that will not be allowed. Number of years for which any loss is allowed to be carried forward for set off starts from the immediately succeeding assessment year. So if there is a loss in assessment year 22-23, shall be carried forward 8 years, that is still assessment year 30-31. It shall start from the immediately succeeding assessment year in which the loss was first incurred or computed. So same 8 years. So from 23-24, 24-25, 25-26, 26-27, 27-28, 20-29, 29-30, 30-31. 1, 2, 3, 4, 5, 6, 7, 8, 30-31. Order for set off of losses, first current year depreciation, then brought forward losses from business or profession, and then unabsorbed depreciation. That's the best way to do so. And I am carrying forward the losses on 24. Suddenly I close my business. What to do? No problem. Continuance of business is not a precondition for carry forward of losses to the subsequent year. Even if business in respect of which loss is computed is discontinued also, no problem. The carry forward benefit shall not be denied. Loss from the activity of trading in derivatives is not to be treated as speculative loss, because the loss or gain from activity of trading also is not considered speculative income. That is why loss also is not considered as speculative loss. Loss from specified business, unabsorbed family planning expenditure, etc., and unabsorbed scientific are at par with unabsorbed depreciation. We had seen it during that time only. The requirements of section 80 to file the return is only applicable for carry forward of the loss. It does not impact the carry forward of loss of the previous years. It also we had seen. And this does not impact also depreciation. Depreciation, unabsorbed depreciation can be carried forward. Similarly, if you don't file the return of this year's loss cannot be carried forward. But last year's depreciation, this year's unabsorbed depreciation can be carried forward. Last year's loss for which you had filed the return can be carried forward. This year's only is not allowed. This also we had seen. That's fine. Amalgamation we had done. This also we had done. $72 double A also we had done. In this PGBP, come to page B57. Profits from discontinued business. So guys, basically you discontinue the business and you get remission, return from bad debts, etc. Under 41.1 you are charged, 41.3 you are charged, 41.4 you are charged. Any profit or gain after discontinuance of business shall be deemed to be the income under this section. We know that. Any loss incurred in the year in which the business was discontinued shall be allowed to be set off against such profit, and only the balance shall be taxed. This part also we hadn't done that time. Example. Business of the SSE discontinued on 28/2/1999. Business loss assessment year 99 2000 was 5 lakh. Brought forward business loss 96/97 to 98/99 8 lakh. Today I recover the bad debt on 31/3/21 7 lakh. What is the tax treatment? So if you see for assessment year 21/22, PGBP under 41/4, it's the recovery of bad debt 7 lakhs. Can I set off this 8 lakh or can I set off only 5 lakh is the question. Read that carefully. Page B57. Any loss incurred in the year in which business was discontinued. In this example, 99/2000 5 lakh only shall be allowed to be set off against the profit. Only 5 lakh is allowed, my dear friends. So 2 lakh will be the scene. Suppose, instead of this 7 lakh, you got 4 lakh in 1 year, 3 lakh in the other year. Then in that year when you which got 4 lakh can be set off. And the year in which get 3 lakh, next year if you get 3 lakh, 4 already set off, no? 1 can be set off here. So that is what you need to keep that in mind. These are all exceptions where losses can be carried forward to 8 years. No, this is an exception. This can be carried out multiple, number of years, all those things. One more. We had done section 33B, which is no longer there, if you remember. Rehabilitation allowance. It was only there till 1984 and 85. Leave guys, not relevant, leave it. Simply, can do everything, but then it will simply create confusion. So leave that, no problem. There was one more case law. BCS Kartar Chit Fund. When the losses sustained are not set off against the profits in 1 year, you cannot choose to set off in the another year. Example, with an example, we'll find out, don't worry. Assessment year 1920. Carried forward loss, PGBP, 1,60,000. Assessment year 2021. Income is 2,50,000. Assessment year 21/22. It is 13 lakh. Since you are an individual, assume it's 2,50,000 anyway. It's below the exemption limit, so you will not set off. You will ignore. Next year, can you set off? There is no rule, nothing in the entire Income Tax Act. So here they said nothing doing. Loss of 1,60,000. If you miss out in 1 year here, cannot be done at the profits of the next year. This was one case law. BCS Kartar Chit Fund. Since a little bit extra, I thought I'll do it. Commodities and all we saw, nothing to worry. Intraday, interday. And anything if it is derivatives marked to market, because of accounting standards, if you have to mark to market and if you have to show the loss, that loss and all cannot be called as speculative loss under income tax. Only at the time of selling, you should take into account. These things are some basic points.
So activity of maintaining race horses also, basically if I, what do you say, maintain the race horses in every race, I will get a percentage. I'm not betting on it, but if my horse wins, I will get 10%, 20% like that. So that should be set off only against the, losses in that particular business cannot be done in other cases that we have seen already. So if you are selling shares only, guys, one important thing that I told you here, only if you are selling shares, come here. Shares, not derivatives, not units. So because there was an Apollo Tires case law. In Apollo Tires has got nothing to it, it's a tire company. They were purchasing some units of UTI which went to a loss. They decided that's PGBP because they are trading and they set it off against the Apollo Tire ka income. Assessing officer said, no, this is speculative business. It went to court. They said, no, it's clearly written shares, not units, not derivatives, nothing. All this we did here. Yeah, accumulated loss and unobserved depreciation of predecessor firm or a proprietary concern. So sole proprietor or a firm converting to a company, that happens. Deemed to be the loss and unobserved depreciation of the successor company. It will go there. Set off will be for a fresh period of 8 assessment years. So this also we had seen that it should go there properly. Similarly, private limited company, unlisted company into LLP also same, fresh period of 8 assessment years. This is interesting, guys. Carry forward and set off of losses in case of closely held companies. So guys, public company merging, amalgamation, demerger, etc. is there. So they do it only so that they can take the benefit of carry forward. Private companies, we have other conversion of into LLP and all is there. But now, closely held company. So one closely held company basically means it's almost like a private company. Either it's a private company or it's a public company with only few number of members. So what happens is, a company which was doing pretty well goes into losses and it's already further into losses now. Shareholders A and B are there. Those shareholders, the shares are sold to a better company which is doing well. So by this what happens, all the assets go there and basically the shares, 100% shares are sold to that other person. So then he will use, these assets, etc. will, all the losses here he will take over and he will set off. That used to happen. Whereby a closely held company which was going into losses was taken over by another person by taking over the full 100% shares of this company and thereby using the benefit of carry forward set off. This had to be nipped properly in the bud. So section 79 was inserted saying that, boss, if you do this golmaal activities for tax planning, more than tax planning is more of tax evasion, I will not allow. Or, instead, no problem, you sell it off. I am not saying no to it, but carry forward benefit I will not give. If you want carry forward benefit, let us say a better management wants to come and take over your company. But that be the case, you still want to be the shareholder, but you still want to take all the benefits. Then I will give you one condition. And that condition is, if you are holding minimum 51% voting power, that same you should also hold. This is at the time of incurring of losses. Same you should hold even later, whenever you are availing the benefit of set off or carry forward. Startup scheme. Startups are predominantly private companies, closely held companies. They said, sir, we have 100% share today, but tomorrow we will sell 20%, then we will sell 20%. So eventually, though we have 100%, lot of losses, sir, in the startup field, 5 years full loss. 6th year, a venture capitalist will come and then he will, less than like 3 years, 4 years, venture capitalist will come. You are going for funding. He will give super funding and he will take a stake. 4, 5 capitalists will come and take a stake of 51%. They'll take over the company. Then will you get benefit of set off carry forward? No. So startups did not get this benefit. So the other VCs, in that VC, V is useless only. It's capitalists. There's a show called TVF Pictures. Watch it. In that only I learned this dialogue. Good show. First came out in 2015. Now it came in, I think, 2023. One more. So you check it out. So what I'm saying is this taking over. No, startups also will taken over by other companies for this benefit of set off. Now this is not allowed because the founders only don't have 51% stake. So they went and told the government, do something about us. So for non-startups, that condition is there. If you held 51% before, now also you should hold 51%. But for startups, 2 they gave, guys. One was this 51% rule. If you cannot follow that, one more rule. One more rule was what? The shareholders of the company, when at the time of incurring of the loss, should remain the shareholders of this company. They did not specify the percentage. They said the shareholders who are holding some shares, let's say 10 lakh shares, should continue to hold the same shares. Because you would have given more, issued more shares, right? You have issued 1 crore shares now, or you have issued 80 lakh shares now. Earlier 10 lakh out of 10 lakh you held. Now you are holding 10 lakh out of 90 lakh. So they said the shareholding should continue. Then the issue comes, what if there is a death and you are getting the shares in succession? Legal hair. What if there's a gift? What if under insolvency and bankruptcy code the shares are taken over by somebody else? What happens then? So for that there are some exceptions. So guys, very simple. For non-startup this is the scene. For startup this is the scene. Check it out. The unabsorbed business loss of a company, depreciation 79 will not apply. Important. Kalpaka in Enterprises. Supreme Court decision. 79, no restriction for unabsorbed depreciation, only business loss, in which public are not substantially interested, closely held company can be carried forward and set off against the income in a subsequent assessment year, provided that on the last day of the previous year, the shares of the company carrying not less than 51% of the voting power are held by the persons who beneficially held the shares, carrying not less than 51% of the voting power on the last day of the previous year in which the loss was incurred. See, shares of the company carrying not less than 51% voting power are held by the persons who beneficially held the shares, carrying not less than 51% on the last day of the previous year in which the loss was incurred. The same fellow should be there. Same fellow should be there. Right? So, for example, previous year 31/3/2019, current year PGBP, in that year PGBP. So 2 lakh was loss. 31/3/2020, 3 lakh was loss. 31/3/2021, 10 lakh profit. This 2019, it would be carried forward here if 51% same people are there, shareholding, voting power. Similarly, this will also be carried forward here. The same thing happens. Whoever were there here, 51% should come here. Similarly, this 3 lakh will go here if 51% is there. Otherwise, not possible. Otherwise, not possible. So, for instance, 31/3/2019, 31/3/2020, 31/3/21. A, B, C, D shareholders, 30%, 25%, 20%, 25%. Here, 30%, 25%, 20%, 25%, 30%, 25%, 20%, 25%. Here A, B, E, F. Here X, B, E, F. 2 lakh loss, 0, 7 lakh profit. So you see, this 2 lakh will go here if people holding 50% is there. A, B is there. 55%, no problem. Will this again be carried forward to next year? I need to see. Here you see AB. Only B is there. (31/3/2019) will be carried forward here, but this will not be carried forward here because even though 31/3/2020 as on this year end, these three are the same. I should not see this. See the rule in which the loss was incurred. In this, when was the loss incurred, my dear friends? 2019. In that, who is the only common fellow? B. What is the shareholding? 25%. So, are they held by the same guy or guys holding 51%? No. So, this 2 lakh will not be carried forward here in a closely held company. But if A had gifted his shares to X, his relative, then I told you gift will not be considered as change in shareholding. So, it's as if A is holding. So, AB, AB, AB. Instead of AB, XB, then it will be a yes. So, I hope you got the point. Startup. In case of eligible startup, operates an exception to 79A. To promote Startup India, permits deviation in shareholding, provided an eligible startup. All the shareholders of the company who held the shares carrying voting power on the last day continue to hold the shares. Shareholders should be the same. Means if company was started by AB, here you can have A, B, C, D, E, F, X, I don't care. And the shareholding of 51% can be 20% also, I don't care. But the shareholders must be same. Basically, promoter should not exit. That is the crux of the startup. No promoter exit is allowed. If your promoter exits, you will not get the carry forward benefit. And such loss has been incurred during the period of 7 years beginning from the year of incorporation. Only 7 years loss is allowed. As I told you, exception is 79A and B. When share change in the voting power and shareholding takes place in the previous year due to death of the shareholder, gift of shares by a shareholder to his relative, there is a change in the shareholding of an Indian company, a subsidiary of a foreign company as a result of amalgamation or demerger of a foreign company. Change in the shareholding of an Indian company which is a subsidiary of a foreign company. Practical example. Brook Bond foreign company as a subsidiary, Falcon Private Limited, and Lipton Incorporated foreign company. So this will get demerged and it will come here. So now, what is the rule here? Where a change in the shareholding of an Indian company, Falcon Private Limited, it's a subsidiary of a foreign company, Brook Bond, as a result of amalgamation or demerger. However, 51% of the shareholders of the amalgamating or demerged foreign company, demerged foreign company is Brook Bond, shall continue to be the shareholders of the amalgamated or resulting foreign company. That is your Lipton Falcon. That actually practically happened. So 51% if they remain the same, then this benefit is allowed because it's a private company, remember, Falcon Private Limited. If it was a public company, already covered in 72A and all those things. Either way, the change in shareholding happens through resolution plan through IBC. When IBC, guys, a new management will come and take over the old management. That be the case, obviously shareholders will change, everything will change. So that's okay. Then 47, 7AC, 7AD we have already seen. In those cases, if it happens, absolutely no problem. Where your NCLT has suspended the board of directors, all those things. Here. 47, 7AD, 7AC already seen. Will not apply to company, subsidiary, etc. if NCLT has suspended the directors under 241. 241 is operation and mismanagement. Under operation and mismanagement, I have thrown out the old directors, brought in new directors. In that be the case, appointed new directors, then no problem. Similarly, change as shareholding also has taken place through 242. Thereby, they will in NCLT can, these directors only will hold the shares in closely held company, no? So I will take away from them and give it to somebody else. So all that is fine. Unabsorbed depreciation already discussed. An LLP is also eligible for reduction at ATIAC. Change in constitution of LLP in view of a fresh induction of partner does not affect the position of carry forward. Just because a new fellow comes, reconstitution, but doesn't mean that carry forward benefit you will not get. A company which is an eligible startup but ceases to be a startup, position of carry forward shall be as follows. Where there is a change in shareholding, 72A. There is no change in shareholding, normal 72 will apply if it is no longer a startup. Because for only for startup, 72B will come. Carry forward and set off of loss for discontinued business, already told you this is what we had discussed. Up to 8 assessment years in which the business is discontinued. Beyond 8 assessment years shall be set off only against the income of discontinued business for an indefinite period. This is what we saw, 41.5. Set off, no set off of losses consequent to search, requisition and survey. We had seen this in assessment procedure. Where consequent to search under 132, requisition 132, this thing, total income of the previous year includes any undisclosed income, then of course it has been recorded, disclosed. We had seen this already in assessment procedure, 79 capital A. Please recall. That's all, guys. Chiller chapter. Very easy chapter this is. Set off and carry forward. Some small things are there. We'll finish it off. That's it. One more session. We will wind up with the chapters. Very easy. We will do some small areas. We'll finish it off. Okay. And then that's it. Nothing more. As I told you, all the major stuff is already done, guys, before international taxation and international taxation came. These are all small areas. We'll finish it off. Okay. See you.